Welcome to the Momentum Metropolitan Investor Conference 2021, streaming to you live from our regional head office here in Park de Kaap, Bellville, Cape Town. My name is Charlene Lekay, and on a normal day, I am the head of Momentum Metropolitan's Group Corporate Social Investment Team, but for today, I will be steering you through the program. A special welcome to our investors, our clients, our non-executive board members, and also the members of the media joining us today. Also, welcome to our virtual attendees that are joining us from across the country. We'd like to thank all of you attending physically for adhering to all the COVID protocols, and we encourage you to continue to do so. And may I also please remind you to keep your phones on silent. Okay, so the purpose of this conference is to outline the group's strategy for the next 3 years, as our Reset and Grow strategy will close off at the end of our financial year 2021. Now, our Group CEO, Hillie Meyer, will kick off with a group overview. He's sitting over there to my left, while Risto Katola, our Finance Director, will explain how capital management will shift gears. Then our business unit executives will give their overview of their strategy or their strategic focus for the next 3 years. So we have an exciting day ahead. There's about 8 presentations, and we have made provisions for Q&A sessions that will happen after the 3rd and then again after the 6th presentation. And we also invite our virtual audience members attending to post their questions throughout the day. Right, first up, our Group CEO, Hillie Meyer. As many of you know, this is Hillie's second round as Chief Executive, having led at least half of the company as MD from 1996 to 2005. And so we were very sad to see him go, but very, very happy to have him return in 2018 as CEO. And I think it is maybe like the fine wine he makes, that he had to step to the side and breathe a bit before he could come back to the table, and what a tremendous impact he's had since then. He's the architect of the Reset and Grow strategy. He has laid a strong foundation that is leading the company through a global pandemic, but also setting the group up for future sustainable growth and success. Hillie, please come to the stage.
Thank you, Charlene. What's it? Strike one, strike two. I know there won't be a third chance. Morning, everybody. Really nice to have this opportunity to share our strategy with you. I mean, all of you would probably by now have seen that, our new strategy is called Reinvent and Grow. And I'll just quickly kick off by maybe just explaining how we came onto that new, what will be our war cry for the next few years. As you know, and as Charlene mentioned, Reset and Grow is coming to an end soon. Now, Reset and Grow was about fixing the basics, addressing the cost base. In other words, a lot of internal things that we had to sort out. But we realized at the same time that we can't lose the external focus. In fact, we had to double up on external focus in a way. And that's why, Reset and Grow, the growth component also involved re-establishing our external focus and increasing our footprint. Now, the logo we used mostly internally for that was, you can see a spanner and a gear, whatever that. It's almost like, if Reset and Grow was we in our own engine room to a large extent, and obviously the Grow is the external focus. Then I think with the new strategy, we know that we have to focus externally, and that we have to up our game and be a bit more imaginative. I mean, if to some extent we had to do some catch up, I think looking forward, we've got to look at the future, how things are changing, and we've got to prepare ourselves for, I think, some of the very interesting challenges lying ahead. And I think we're in a good position to do that. So with Reinvent and Grow, which we will unpack in a lot more detail throughout the day, we're going to reposition, as I mentioned, for the future. Digital transformation is like a golden thread running through everything. I think it's going to change, and we all know it. It's going to change the business world, financial services, fundamentally. We also want to, I think we're going to be a bit more ambitious, in terms of product and service, what we call product and service leadership, where we actually want to stake our claim as a leader in many of the fields that we operate. And then on the, your right-hand side, we obviously have some stronghold, and we've, I think, re-established our presence in a number of existing distribution channels. But we need to be, I think, not just stronger going forward. We've also got to be a bit smarter. The external world out there is changing, and we need to adapt to that. And in fact, I think we can play a leading role in some of those changes. So yes, we're not going to neglect existing channels, but we will also start focusing on some alternative channels a lot more than we did in the past. And ultimately, it's around, growing market share. I think that's the ultimate test for whether our plans are working or not. So, that's the reinvent and grow strategy in a bit of a nutshell. And as I mentioned, our reinvent and grow will be our sort of rally cry going forward. Reset and grow worked very well for us. Every person in the company, in the group, knows about reset and grow. And each and every, business unit's got their reset and grow targets. And it's almost like you say reset and grow, and people can actually play back what they understand by it. It's not necessarily the same by everybody, but it is a sort of a unifying force, and as I mentioned, the rally cry. And I think sort of internally, to some extent externally as well, it is nice to have a, sort of a name for the strategy, and that's why we decided that, we're going to make it easy for everybody to just get onto the new bandwagon, which will be reinvent and grow. And I think it summarizes the essence of the difference between the old strategy and the new strategy. But hopefully after today, it'll be a lot more meaningful to you all. I'm going to just recap a little bit on reset and grow. Probably the last time that we'll talk about reset and grow. Then I'll spend a few minutes just on strategic context, just to explain, the process a little bit, and maybe some of the sort of big issues that we looked at from, as a group in our strategic planning. And then very, very high level, I'll share with you, or begin to share some of the detail around the reinvent and grow strategy. I just also want to give you my flavor of how we planned the day. We deliberately decided not to almost, have sort of a program where every business unit will talk about, almost like in a similar fashion, the same 6 or 7 headlines or main topics, products, this and that, or whatever. And also we didn't necessarily, cover all the business units. You will see, for example, we would have loved to, feature India quite strongly, but India, their year-end is 31 March, and the holding company of our health initiative got a results announcement in the next 2 weeks, so they're in a closed period. So unfortunately, we would have rehashed things that you already know, so we thought that wouldn't do it justice. So unfortunately, we won't talk much or anything really unless there are questions about India. We also decided that we're not going to go into detail on Africa. I think Africa is to some extent an extension of what we're doing here, and I think if you've got a flavor for the South African strategy, which we'll focus on here today, I think you'll have a sense of our plans around Africa, and obviously there will be many opportunities, to talk about more detail there. We're also not going to talk about Multiply. Multiply, we will over the next few months reposition Multiply, and it's a bit awkward because there are some sensitivities there that we're not in a position to share with the market, so we rather decided to take it off the agenda for today. So Risto after me will, I think, hopefully illustrate to you that there's going to be a change of gears in terms of our capital management. That's going to be a major, major theme the next 3 years. After that, Peter will talk about Metropolitan. I think hopefully after his talk, you'll also agree that there's still some fuel in the tank. I think there are further opportunities to improve and increase growth. After that, Herman and Lawrence and Brandt will talk about the short-term cluster. That will be followed by Dumo, who will share with you the future of how we see employee benefits. Hannes has delegated his talk to Damien, and this is this federal operating model in practice. You'll see also that it's a little bit sometimes, but we like it that way. But it is a little bit like herding cats. All the guys had the same brief, but you wouldn't say it when you hear the presentations today. So Hannes decided now he's going to outsource his completely. Dumo will show you a video, so he doesn't have stage fright today. He's prepared everything beforehand, and the rest of us, need to put up our best show. But also, Jeanette and Johan, I think, some of what Jeanette's going to say is actually what Johan's doing, and some of what Johan's going to say is what Jeanette's doing. So I hope you're in for a bit of an exciting day. I think importantly, we just like you to get a bit of a feel of what this strategy is all about. That's why, the final session is really about enabling digital-led distribution. And that distribution is what? It's not only sales, it's also the distribution of information, putting ourselves in a position to almost like distribute service and engagement and so forth digitally. So hopefully after the full day, you'll have a good flavor of what Reinvent and Grow is all about. Okay, Reset and Grow. This is the signature slide. I think all of you will know that there was quite a big miss in 2020 in terms of our normalized headline earnings, which is the one, we were basically working towards 4 billion in 2021, this financial year. I think after the half-year results where we had to, further strengthen our COVID provisions and so forth, it's common cause that we won't achieve the normalized headline earnings target for 2021. But I think I'm all for bad performance plus good excuse doesn't equal good performance. So we're not trying to pretend that we had a great performance, but I think what we can say, with conviction, that as a group, as an entity, we're very, very proud of what we've done over the last few years. And I think we've re-established in this, call it franchise, or I'm not talking brands because there's more than one brand, but I think we've basically put the group into a position where we can really perform up to the levels that we set out there. I think we've ticked just about all the boxes that we want to in terms of what it is that we needed to fix and what we needed to improve and so forth. And let me just maybe spend a few minutes just reminding everybody about some of those things. We started off quite early with a bit of a drive to, I think, energize our people and make sure that we all align behind a common vision. And I think staff responded magnificently. It was really heartening to see, and it's almost as if the staff was actually waiting for, call it, executives just to point them into a direction so that we actually could get going. And a big part of the focus was on delivery. And in order to deliver, you've got to empower and you've got to make people accountable. And that we've done, and hopefully that will stand us in good stead going forward. The operating model is really working for us. Over the period, we improved our BE positioning. Recently we launched the ESOP share option scheme for staff members, which is sort of the most recent thing we did. I think our brand visibility increased significantly, and also, we've done some very good things in Africa. So all in all, I'd say we, at least as far as the reset component is concerned, our own engine room and so forth, I think we achieved what we wanted to, but we did that without losing the external focus, which was always our intention. So yes, we did increase our footprint in all the channels that we present, except for Metropolitan, where we deliberately decided to reduce agents from about 4,000 to 3,000, while we were sorting out the channel, and we will probably move into a bit of a growth phase again now. IFA support, I think you would have seen from the latest results. I think we're back. We are, I think we've re-earned a lot more support. Our supporting IFAs have increased significantly. Health is winning business. I mean, most recently we won an open tender process for quite a sizable closed scheme, which was awarded, since January this year. So again, in a very difficult environment, and you'll see from the health presentation, to show a little bit of growth, and we did show a little bit of growth, I think is not to be sniffed at. Guard risk, I think, continued to be a stalwart. I mean, they growing from strength to strength. Yes, there were one or two curveballs, one of them being COVID over the last few period, but guard risk is growing from strength to strength, and the very deliberate strategy they had in Reset and Grow around growing their proprietary business, I mean, that's been hugely successful. As far as personal lines insurance is concerned, I think the AFI transaction puts us in a good position going forward to be more competitive and to be a bit more of a seeded player. Yeah, and then as you know, India I think is tracking the plans, and you would have seen that Africa is actually quite a reliable source of, I think, some very good financial results lately. I will just close off with 2 slides, and these are from Michael Christellis's report, a recent report, where he looks at market share statistics. And I think, if you look at the affluent APE, this is risk and investment business, I think we could, at least, I think he only looks at the basket of the 5 biggest competitors. Then we've increased our market share from 14 to 21, which I think, obviously, I think that's sort of the proof, and proof is in the pudding. So that's the pudding, not the proof. And as far as the low income market is concerned, as you will see, I mean, we contracted from 17% was in 2015, so that's 3 years. But I mean, lately I think we're in a very different position. Okay, in terms of strategic content, I'd just like to go through, the process we followed, how we went about our strategic review process, and then I'll also, just highlight 1 or 2, call it more general issues and topics that we allowed for. Now, we did follow, like we do everything else here, we followed a bottom-up approach. I mean, we're basically following a portfolio strategy approach. We see this group as a portfolio of business units that are, basically controlling their own destinies, and and we expect from them to be competitive wherever they operate. So that's the sort of approach we followed. But there are some golden threads that pull us all together. And we just, as part of this process, also reminded ourselves of what that is. I think, first of all, I mean, what's our purpose? We enable our clients to achieve their financial goals and aspirations. Not too complex. We all can, remember and understand all of that. And our strategic DNA, again, with the strategic process, it's good to remind yourself of those things. But we in protection business, and then we in investments and long-term savings business. That's really what we do. We focus on South Africa. I think, I think if we believe that we have and if we're confident that we can be successful in another market, we'll try it. Now, I would say with India, it was probably the wrong way around. It looks like we are successful, so, it now fits the strategy. But we all know it was opportunistic, but it was, I think, a bit of a blessing that we are there, and we're very, very happy with that. But it's probably more appropriate when we talk about, let's say, our presence in Africa. We're not going to be in a market in Africa if we don't think we've got a very good chance of winning. So as you know, we've reduced our presence in Africa. We'll only return to countries where it really will make sense and where we have a reasonable chance of success. And then I mentioned that, we execute through this federal approach, empowered business units that really, go out there close to clients, full value chain responsibility. The strategic approach, as I mentioned, was, looking at it as a portfolio of businesses. I'd just like to unpack that a little bit more. There are basically 3, almost call it pillars, that we look at when we look at our portfolio of businesses. The one is, does it make strategic sense for that business to be here, for us to have that business and so forth? And that's really, are there some synergy opportunities? But also we expect from our portfolio businesses to contribute, to things like brand. So we would like to ask any business unit, what did you contribute to the brand the last year or the last 24 months? It's not one-way traffic because, we all need to, do our bit if we want to improve the brand strength, as an example. Also, we look at capital allocation from a corporate point of view, and then we will, I think, allocate capital where it makes most sense. So we will optimize capital distribution, and generally we'll leverage our strengths. And brand is a good example. The value creation bit in the middle is really where we spell out to our business units what we expect. What does this, in order to belong to this club, what are the requirements? And also, it's up to business units to obviously make their own plans, but we want to see clear goals. So that's part of the process, almost like we have return on capital, return on equity requirements. We want all our businesses to show real growth in earnings. But yes, as far as performance targets are concerned, they set their own targets or whatever, but it's a bit of a top-down, bottom-up approach. And then finally, sustainability is another of the pillars where we look at, the diversification in the portfolio overall. Are there gaps, Does it make sense from a diversification point of view? Obviously, we'd like to always see a pipeline of new opportunities. And then, things like culture, we can't emphasize enough, but we have this culture of empowering our people, and then also, there's accountability for what they do. We are a proudly South African company, and that's why we want to be authentically transformed business, and that will continue going forward. And for me, it's the importance around transformation is that we as a business internally, all our staff members must actually believe and buy into our transformation plans. And like we do with everything else around, let's say, employment equity, it's a bottoms-up approach. So each business unit's got their own employment equity targets. Senior management level, middle management, the whole works. That's just the way we get results, is if business units, make their plans and then work their plans. And then finally, the whole issue around digital transformation, I can't emphasize enough. Look, I'm not going to go through all the trends, but right up there is advances in digital and data analysis. I think what can be automated will be. End-to-end digital value chains will fundamentally change the way in which we do business. I think right at the bottom we've got risk selection, where I think it's just getting a lot more sophisticated. Now a lot of our business is in the protection arena. So this is very, very important for us. And that's why, for example, the things around risk selection, pricing, underwriting is of utmost importance. We can't be a follower. We need to, be a leader in that arena. Then some more trends, advice. We believe that there will always be advice, but the nature of advice will change. The nature of our advisors will change, and we need to be part of that change. Some of it we might lead, some of it we will just align very strongly, but adapting to changes in the market doesn't mean that the importance of advice will reduce, but the nature will certainly change a lot. And then, we all know that the economy is in a, quite a tough position. It's amplified by COVID. But in all our plans, we're basically not bargaining on any tailwinds, certainly not. We're not too sure how strong the headwinds will be. But like in the reset and grow plans, going forward, we know where we're going to grow. It's not that the market's going to give us that growth. It will have to be a bit of a competitive play, a market share play. I'll now move to the reinvent and grow strategy and unpack it a little bit. Look, it was a little bit of a debate. I know a year or two ago, I said that when we do the follow-up for reset and grow, we're definitely not going to throw an earnings target out there. We had our backs against the wall. That's why we had to do it. We didn't have a choice. But you will see we are throwing some targets out. And I think it's just maybe worth, just discussing that, because, there are one or two important things that I'd just like to point out. I think the targets, that we will share with you today, it shows our intent. I think we all know and understand that and that's why also we're not focusing on short-term targets. And the targets that we set are almost like, what do we foresee in 2024? And we try to unpack how we believe we will get there. And these targets are, some of them are more stretching than others. But I think there's a nice balance of prudency and whatever in the group. And by the way, I don't know whether it'll give you guys comfort or not, but Risto is becoming more conservative, okay, which is why I'm becoming less conservative. So 3 years ago we argued, him in this direction, me in that. We now swapped roles. Okay, no, not only, it's a joke, Risto. You still, I'm still more conservative than you, even though, yeah, okay. Now, more seriousness, if I had to put myself in an asset manager or an analyst's shoes or whatever, I think unless we articulate our plans and make it tangible and make it real, you would find it impossible to measure our performance. And I think in that sense, it's only fair to try and articulate what our plans are and how we want to get there. We all know that the market's a dynamic place, and we'll see how we do, and maybe hopefully we'll overachieve on some and not miss too many of the others. So in that context, that I think in the end, we just felt that we will share some of the detail with you. So this is a bit of the signature slide, which you'll probably now see more often going forward, the reinvent and grow strategy. In a bit of a summary, if we have to put it on one page, I'm going to unpack each one of those circles in more detail. So I'm not going to talk too much about them now. I've got one slide on each of them, with one exception, which I will talk to. But we're going to, on the top left is basically around distribution channels. And yes, we will grow in existing channels. But as I said, we're going to box smarter. We just not, it's not only about strength, it's also about, I think, being creative. We will put a lot more emphasis on new channels, alternative channels. You'll see that digital is a common theme. It is a business imperative, and in fact, it creates fantastic opportunities. And then, as I said, product and service leadership is not just going to be talking around it. We're really, going to up the game in our expectations around that. On the other side of the slide, I think there, it's a bit more tangible. You'll see that we're targeting normalized headline earnings of 5 billion. I'll unpack that a little bit. We baked into our plans for the next few years a savings of more than 500 million. And I'm not going to unpack that. It's made up, different business units have plans, but we're not on a cost-cutting drive. It's more that, we're doing certain things we can see that it will result in efficiency improvements. So we're not targeting efficient improvements. Well, we are targeting efficiency improvements, but the measure is more the earnings. Our business units have revenue and cost. So it's not necessary for us to have almost like, cost targets anymore. It's in the context of what happens with the revenue targets. But just baked into their plans and some of their transformation plans and so on, talking digital transformation, there are opportunities to reduce the cost base. So that will certainly contribute. But I think the more important thing is, we really have a culture of financial discipline now. And we know and appreciate, we appreciate how difficult it is, and that for every rand that you spend, you've got to earning somewhere. And sometimes it's just easier not to waste money rather than it is to, sell another policy or whatever. Although generally speaking, we're all in favor of driving revenue rather than cutting costs. Non-life insurance will be a bigger contributor. We foresee that in 2024 it will contribute 20% to our normalized headline earnings. We've got some market, and we'll share some of it, but we have some market share targets for the different business units. In fact, all the business units have some targets. And we'll just share some of that with you. But for some of them, especially a business with a relatively low market share, then 1% could be meaningful, but we'll give you the detail. And then finally, and I think that's, I don't know, that's one of the things that excite me. The actuary in me now probably comes to the fore. But this ROE target of 20%, which is very achievable, I'll show you that later, is the one thing that I think really excites me. I think we're in a position to play a leading role as far as capital management in the South African insurance industry is concerned. Okay, so let me go into some detail. This is a flavor. I mean, you can imagine, we've got, 10, 12 business units. They all have their plans to grow channels. I just want to point out on the right-hand side, the two blocks on the right. The top one you'll see, we're going to continue with footprint growth. MFP got plans to grow to the 1,400 agents, which has been part of the plans all along. Momentum Consult, that grew very nicely up to 300 advisors. They want to add another 100. You'll see that we eventually passed the 2,000 IFA supporting brokers. Remember, we've got a definition of what a supporting broker is, and it's now consistently more than 2,000. I think the latest is around 2,200, but we foresee that could grow to 3,000. If we implement the plans that we have, it certainly will. And then the Momentum Insurance, they've got their own tied agents, the old sort of Alexander Forbes agents. Currently, there's about 135 of them. We'll grow that as well. That's the plan. At the bottom, I think, and that's, Peter will talk more about Metropolitan, but we will, I think, in a very responsible way, grow the agency force. We foresee that it might grow back to 4,000. We're not going to be, we don't want to necessarily be held to that number, because quality is almost more important than quantity now. If we improve the productivity and continue to improve productivity, we'd rather increase our sales volumes in that way, because it's a lot better for V&B and all the other metrics if we can actually reach some of our growth targets with less advisors. But because we're in a better position, just from a management point of view, our activity management's up there and so forth, we foresee that there will be opportunities to grow the agency force. As far as new channels are concerned, again, I'll just highlight two things. On the top right, you'll see that Momentum Corporate, the admin-only large administrative portfolio of businesses, we've combined that with Momentum Consultants and Actuaries. So in a way, it's a more of an end-to-end, and it's a business with more of their own income statement that they can actually work on. So we believe it's more of a viable unit than the two independently. And I think it's already unleashed a fair bit of energy and so forth. And that will be our direct play. That's an opportunity to broaden our direct distribution and so we rely on that to reduce our dependency on intermediaries. But again, in corporate, like in everywhere else, we're not going to neglect the strongholds that we've already established. And then the bottom left, for Momentum Life, there's already what we call Velocity Club. I don't think Johan's going to say anything about it. It's I'd say, up to 12 months or so ago, it was what we would call a bit of a skunk works, but it's beginning to get a bit of traction. But it's an alternative distribution channel, quite small, but we're learning very, very interesting thing. It's almost like Momentum Life's version of Get Up, which is a alternative distribution initiative in Metropolitan that Peter will unpack. It's quite different, but Velocity Club is something that will receive a lot more attention going forward. In fact, in total, you'll see there that Myriad target 7.5% of API, annual premium equivalent, API, annual premium income, to come from alternative channels, in other words, not IFAs. Now that's 7.5% in API. In terms of policy count, it'll obviously be a lot more than that. And I'd say that's not an insignificant objective. As far as Accelerate Digital is concerned, there's a whole lot of things here. I mean, I think one of the most important things, because it is such a challenge in a federal environment, but Johan will unpack it more. But the bottom left, where Momentum Retail is working towards a open API platform, that's really the platform that we take to advisors, IFAs. So we have a common platform, IFAs, our own consultants and so forth. That's where we actually bring together, all our different product houses where they play on the same field where we actually, pitch for business in a similar fashion. So it is we've done a lot of work on that lately, but Johan will unpack it in more detail. And that's just one example. I mean, there are digital stories right through the business. And then finally, product and service leadership. As I said, we're just going to expect more of our businesses, and I think businesses are ready to, I think, play a more proactive role. And also, keep in mind, a lot of the innovation will now almost be process innovation rather than, there will be product innovation, but it will be, almost like the packaging and the servicing and how we deliver is going to be almost as important as the product itself. And in fact, the way in which we deliver it will create innovation opportunities on many fronts. So that's that. So as far as the circles on the left, I'll now turn to some of the targets that I mentioned. Currently, and we've shared that with the market at our interim results stage, we believe that, if we sort of normalize our normalized headline earnings, we're probably good for 3.6 billion in 2000 or in this financial year. It's the lower end of our target. Risto, as I said, he's now more conservative. So he will tell you why it's somewhere between 3.2 and 3.6. And this is how we see how we'll get to the 5 billion. Now, I mean, obviously, we had a fair bit of debate around the 5 billion because, I mean, looking at it sort of at face value, if we're now good for 3.6, 5 does not sound ambitious. And yes, I mean, I would have liked to see a range north of 5 if we had to go for a range. I think there are some valid issues that we debated internally. COVID is one of them. It makes it extremely difficult to plan with a lot of conviction. But over and above that, there are some structural shifts in here. For example, in Metropolitan, a fair bit of Metropolitan's current earnings is from savings products. But that basically disappears over the next 3 years. So for Metropolitan and that's not an annual growth, the total growth is 15%. For Metropolitan to grow the earnings by 15%, they probably have to grow the risk business by double that. But again, Risto will unpack this in more detail. Also, for example, in Momentum Investments, there are, for example, we foresee that we will actually spend a bit of money on technology there. Plus, we haven't rolled out all the fee adjustments right through. So there are, again, as I said, some structural elements. But you'll see as we move down, there are some exciting growth numbers. Momentum Life, that will be quite a stretch, and it will rely heavily on Myriad being successful. So all in all, I think we settled on 5 billion. We couldn't agree that we'll have a range above 5 billion. We could also not agree that it will be a range below 5 billion. So we settled for the 5. We'll see where we end up. But again, as I said, it shows intent. And also, I think, keep in mind, if we're good for 3.6 billion now, then 5 billion in 2024 will basically represent 12% growth per annum, which I think in the market that we foresee, it's not going to be a walk in the park. I mentioned that the short-term side will play a more important role, and whereas it was 10% of normalized headline earnings in 2018, it's now close to or around 15%. In another 3 years' time, it will probably be at 20%. Another interesting point, just more relevant to the previous slide, but I'll mention it now. That sort of insurance business, if we look at Momentum Life, Metropolitan Life, and corporate, if we see that as insurance, it currently represents about 60% of earnings. That will drop to 50%. As you see here, the short-term business, the non-life business will grow from 15 to 20. And then also on the previous slide, let me go to the previous slide. Sorry, it's 2 slides. New initiatives was a drag of 15% on earnings. And we foresee that will basically be no drag in 3 years' time, plus 150 minus 150. So those are the big factors, I think, that boost the earnings meaningfully. I mentioned that we have market share targets for the different businesses. If you look at the total risk market, and Johan, it includes banks, and it includes direct, it includes everything, because there will be some other stats later today, which is maybe only IFAs or whatever. But if you look at the total risk market, our current market share, Myriad's market share is 8%. But we foresee that we can probably gain 1% per annum over the next 3 years, which will be, some achievement. And really, I think that's what we hope will drive the growth in earnings for Momentum Life. And you can go through it. For the wealth platform, investment business, really, that's almost a doubling of market share, which is quite bold. But I think we've seen lately that we're doing very, very well there. Guard risk, that's the proprietary insurance business where the current market share is just below 2%. So that represents a 50% increase if they can grow that to a 3% market share. And all the other numbers are there. You can see Metropolitan, it's difficult to say. If we look at right now, the last few quarters or whatever, our market share is probably more than 15%. And that again is now not the whole market. It's almost like the emerging market share. But I think sort of, a good starting point, because I think some of the companies will make a bit of a comeback, but we're probably starting off with a 15% market share. And again, we can take that to, I think, close to 20%. And then finally, return on capital. If you look at 2020, that was, as we said, unfortunately spoiled by the COVID provision. So if we look at 2021 again and we normalize things, then I'd say, our return on equity is probably somewhere between 15 and 17%. If we sort of achieve earnings of, 3.6 or let's say 3.6, our NAV is about 21 billion. That gives us a 17% return on equity. And you'll see that, if the earnings can grow to 5 billion, that's the 40% over the 3 years increase. The NAV increases by about half of that. That's what we foresee. That's what our models tell us. Then we will sit with an ROE of 20%. Again, you'll see Risto's got a range from something to 20. Okay, I'm about to conclude. In 2018, this analogy we used especially internally, we talked about the truck and the load. We had a huge truck, especially after the merger, and we lost market share. So huge truck, small load. Now, if that was what applied to 2018, then I think going forward, we'll have to reinvent the truck while we're adding load. You can see there's already a bit more load, but we're going to have some electric lorry or something emerging out of this thing. We're going to reinvent this over the next 3 years. I think if you ask me, in a nutshell, what are the challenges? What do we have to do? I think there are 4 things that, for me, almost like I would say would stand out. We'll have to master digitalization. We have to beef up distribution, and that's what I mentioned earlier. We can't do just what we did in the past better. We do have to do things differently. That's where a bit of reinvent and leadership in the distribution arena. And it's existing channels and new channels. Then I think, there is a bit of a diversification shift happening in the business, and I think we'll have quite a healthy and quite a diverse group in 5 years' time. So for me, that's important. And then finally, just all the things we're doing in terms of capital management. And it's a process that started a while ago, but I mean, we now have, capital deployed through the group. Every business unit now have their own capital, and they know what their return on capital is, and they know what, and they're setting their targets, and they know what we want from them. And it's it's one thing if you've got a very high return on capital, but the businesses that are not really delivering up to the required return on capital, they also know it. And that's where we probably will see some of the shifts. So that concludes my presentation. Thank you very much.
Thank you so much, Hilly. Yeah, luckily Risto is up after Hilly. He's differed with him so much, so Risto, you'll have an opportunity to correct some of that if need be. Risto Katola, our Group Finance Director, commands our respect, not only as the man who holds the purse strings very tightly, but also because of the wealth of knowledge he brings to steering business performance, balance sheet management, mergers and acquisitions, and a particular skill set, which is capital management. Now, as an ex-analyst, you could say that Risto today is among friends, and he's been looking forward to this conference for the last 2 years since we had our last investor conference. Risto, the stage is yours.
Let's hope this works. Yeah, it does. Okay. No, Charlene, thanks. I have been looking forward to it. Maybe not 2 years, but a couple of months. But what I find interesting is Charlene makes it sound like it's weird that I'm looking forward to it. But I think I probably spend most of my days at work thinking of shareholder value creation, so it's pretty natural wanting to talk about it to shareholders. So Charlene, I'll take exception to you finding it strange. Glad to be here. Okay. I'll talk about 4 things. 1 slide on reset and grow. Then we'll talk a bit more about earnings. So there you might want to make some notes. A lot of the business units will present their plans later. So I will just give you 2 or 3 key bullet points per business that may be worth keeping in mind. I'll give you our first official stab at cash generation. Now, it's an interesting topic. I mean, I told Leonard earlier that if you ask 50 actuaries about how much cash we made last year, you'll get 70 answers. It's like cash generation in life company is tricky. But we'll show you what we think our cash generation is at the moment, and that work continues. And then I'll make some statements towards the end about capital management. So in a lot of our meetings with investors, people ask us questions, and we answer them honestly. But I think it's also fair that we bring a lot of that together in one place, so we can just tell you guys some of the big picture thoughts we have around capital management. Okay, so 1 slide on reset and grow. When we spoke here, actually in this podium 3 years ago, we made 3 promises on a financial perspective. We said we'll target normalized headline earnings of 3.6 to 4 billion. The reality is, unless something really weird happens in the last quarter, we're not going to make that target. Okay, the external environment just ended up being even worse than we ever predicted with COVID. So there's no way of arguing that we made it. Now, me and Hilly agree that we probably got quite close if you add back just the COVID-19 impact. So it's not a bad swing at it over a difficult 3-year period. The one that is very green is cost efficiency. So the way we looked at that cost efficiency 3 years ago is we took our group controllable expenses of just under 10 billion and we put them in 3 broad buckets: distribution, sort of product and service, and then head office. And we modeled roughly what could we do in each of those line items. And we thought we could save 700 million pre-tax versus inflation, which would have been a 500 million rand saving in real terms. In the first 11 quarters of the 12 quarters, we saved 1.3 billion against inflation. Our cost base of 10 billion is almost unchanged over the last 3 years. It's amazing how in 3 years, you're basically building billion rand annual earnings run rate difference versus had we not done the cost savings. So That's probably the biggest achievement we have had from a financial perspective. Also, what I'm quite liking is quarter by quarter, I'm not seeing any areas where you get these bounce backs where people have cut too deep. It's consistent quarter on quarter, very limited growth, and quite stable. The one where I gave ourselves a yellow is non-life insurance. We said we're going to take non-life insurance from 200 million a year to 500 million a year. We will get to the 500, but when we said that, we didn't have Forbes in our plans. Okay, so if you take Forbes out, we're a bit shy of the 500 million. At the same time, in guard risk, you had business interruption claims. So it's like you swings and roundabouts. I gave it yellow because there's no doubt that our short-term insurance earnings potential has grown a lot over the last 2-3 years, particularly in guard risk. I said this at the interims, I'll say it again now. Guard risk has had a series of one-off events in the last 18 months. So I think people haven't really seen the true underlying potential of guard risk earnings for a while now. And I think you guys will be pleasantly surprised when they have a clean 6 months coming up. Then the one where I did give ourselves a clear red is on new initiatives. We always acknowledged that we were maybe over-investing in new initiatives, particularly at the same time. So we were making a very steep J-curve in 2017, 2018. And we thought we could reduce new initiative losses by 100 million, which I didn't think was such a massive target at the time. But in reality, our new initiative losses have actually increased a little bit over the last 3 years. Now, India has actually delivered to plan, which was by far the biggest factor. So India is a good story. But 3 years ago, we had 3 other businesses in there. We had the lending business, the joint venture with African Bank. We had Momentum Money, which is a little bit of I hate to call it a transactional banking play, but it's in that sort of field. And the other one is IO, our joint venture with MTN. So India did to plan, but the other 3 ones, for example, the lending one's been discontinued. So we thought by now we'll make a small profit out of those 3 smaller ones. And we're not. We're still making a loss on those 3 cumulative. So new initiatives, a bit of a red one. Okay, let's talk about earnings. So there is a range there. I told Hilly yesterday, he reminds me of Steve Jobs, that every time I show him a number, I'm saying it could be from 500 to 700. Then Hilly goes out of the office saying, hey, it's 700. It's very dangerous showing him a range. I think I'm going to have to just show him the lower number going forward. Okay, so he's a natural at setting stretch targets because he ignores everything below the high point of the range. Also, if you summarize it on the right-hand side, my split is a little bit different to Hilly's because I took the investments business, the annuity book, as life earnings. So I get 70% for life rather than 60 if you include the annuity book. Non-life is already 15, and the last 15 is really split between traditional asset management and health administration. I suppose the point of that split is I would say we're a bit underweight asset management profits compared to some of our peers. And we're also very much a life insurance company at this stage. And even though we're going to be growing non-life insurance activities, I think if you put them both under the moniker of insurance, we're going to be increasingly be underwriting business. More and more of our earnings are going to be underwriting premised, which I think is a good thing. I think it's a rewarded risk still in this day and age. Okay, now there's something new stuff here as well. So like the interims, I always said, I always try and include something new, keep you guys interested. And what I've done here for the first time, we're actually showing you how we internally allocate our IFRS NAV by business unit. So on your own time, you can go and have a look. For example, here, we allocate 1.6 billion of capital to Momentum Investments and 4.5 to Momentum Life. Now, sometimes it's easy to allocate capital, like guard risk is a separate license. I can just pick up their balance sheet, their numbers. When it's divisions within a big business, there's quite a bit of judgment and debate of who is responsible for what capital. But this shows you largely the life license and then health, how we allocate it. Now, the nice thing about this is you can see the first half of our capital, the first 11 billion of our capital, earns a return in the high 20s. So our core life insurance businesses are extremely profitable and cash flush. Again, that shouldn't be a surprise, but it's nice to actually put it down into actual numbers here. The other thing you'll see later is the head office, the shareholder cluster, is treated as a separate cluster here. If I added that back here, the ROE would still be mid-20s. So even if we sort of made these profitable businesses pay for the head office fully, we'll still have a 25% ROE in sort of life insurance. Then we bring the two yellow ones, so the average returns. Now, I'll start with Africa. So 3.6 billion of capital, earning about 11-12% ROE at the moment. That's improved by selling out a lot of the loss-making, more troublesome businesses. But we still have some big businesses like, let's say, Botswana, that has, I don't know, 600-700 million of capital earning high single-digit returns. So in some of these markets, we have really struggled to build economic profit businesses, even though they're sort of running along, making 50 million a year, 100 million a year. You know, it's an interesting theme that we often debate internally, like which of these African countries are big enough to build a proper at-scale business, and which are the ones where you almost have to acknowledge extended periods of weak ROE and take a long-term view that eventually it will become bigger. Okay, so Africa is receiving quite a bit of attention. Non-life is also interesting in that, obviously the one thing depressing that ROE is we just spent 2 billion on Forbes. Now, all of you guys will acknowledge that one of the first things when you talk about ROE is it tangible or total IFRS NAV, okay? And the reason we did this work is mainly to measure our own performance in terms of capital returns. So clearly we need to take into account that we paid something, even though a lot of it's goodwill. You know, so this is like a fully, you know, all the investments are treated as invested capital. And Forbes is a good business, but we did pay more than a 10 PE for the business. So the ROI for now is quite modest. The other one that is often not obvious to people is Guardrisk is a great business. It's probably the best franchise, sorry everybody else, it's probably the best franchise we have in our group, in its own marketplace. But the ROE is below 20. It's sort of 15, 16, 17%. You know, so Guardrisk is a good business, but there's a lot of capital optimization that I think can be done there. Remember, they do two things for capital. One is they take underwriting risk, but they also solve other people's capital problems. You know, so I don't want to get into too much detail, but one interesting one, for example, is what do we charge the clients in Guardrisk who need capital? Are we charging them enough? You know, are we solving their problem at our own cost? You know, those sort of things we need to think about in terms of ROE. And then the last two small ones here is shareholder portfolio, which, like I said, could have been maybe allocated somewhere else. And the last one's new initiatives. So we only have 800 million of capital invested in new initiatives, but that dilutes ROE by 3%. Okay, so it is interesting when you start investing in new initiatives, just how big the marginal delta can be in that J-curve phase at your group ROE. In fact, that brings me to this slide. We had a lot of debate internally, should we keep the slide in or not? I was the only one who wanted to keep it in, and it's my presentation, so I kept it in. But this shows you cumulative ROE. So as we move from our highest return business to our lowest return businesses, you know, you can see our first 5 billion of capital earns nearly 50%. You know, once we add the next 5, that gets diluted to 40, and then it gets diluted to 30, eventually gets diluted to sort of 16.5%, 17%, or whatever it is here. So the obvious question I had is like, why do you want to show the big negative effect of the tail here? And the answer is that to me, it's actually opportunity. I would much rather have these big core businesses pumping ROE and then have a small tail to deal with. You know, effectively just by moderating new initiative spending and fixing one or two obvious things like in Africa and so on, waiting AFI to grow to its targeted ROE. You know, if I had a core business making 15%, I would be scratching my head here how to get to 20. Whereas with this picture, I think the 20, I agree with Hilly, the 20 is achievable because this is the ROEs and ROE targets with today's capital management plans. There's still additional work we're doing, which I'll talk on the last slide. You know, so we have a few more things up our sleeve in terms of ROE. Earnings, I don't have anything up my sleeve. on capital, I have a bit. Okay, where to from here? So this is Hilly's slide. I'll briefly talk through each of these line items. Now, starting on Momentum Life, we're expecting about 5 to 10% earnings growth for that business unit. On Myriad, we're expecting closer to 15% per annum earnings growth. So we believe our current market share on Myriad and the current margins of Myriad, combined with the current size of the book, enables us to grow in-force premium quite strongly and underwriting profits quite strongly. I think it sounds like an obvious point to make, but I'll make it anyway. At our current level of new business, the book is still growing. People often ask, like, why didn't your sales grow? The reality is that if your book is of a certain size and your sales volumes are X, you can still keep growing at X. until the book gets bigger. And Myriad's in that phase. Myriad also has very good experience in terms of premium uptake of escalations and increased benefits and so on. So if you think of what is the one ambitious plan in Momentum Life, it is really around Myriad. Okay, we're targeting good mid-teens growth in Myriad. Beyond that, Investo, which is our savings product range, we think earnings there will be sort of quite sideways, maybe up a little bit. It's quite different to Metropolitan Life, where we expect savings profits to decline. In other words, the gap between current products and old products is narrower in the affluent market than it is in the entry-level market. So Investo will probably grow a little bit in nominal terms over the next 3 years. And then we have the traditional book, which will be shrinking in sort of single digits over the next 3 years in terms of profitability. Okay. Then going to Momentum Investments, and Hilly stole some of my thunder on these. So Momentum Investments, we're expecting modest growth, but that business is becoming a much better business at the same time. So beyond modest earnings growth, we're expecting that business to have more competitive pricing and much better technology to build off on. So in 3 years from now, I wouldn't be asking the question so much in terms of earnings. I would be asking, have you actually got what you wanted in terms of the offering and the technology and the platform? We're in that phase where we need to reinvest a little bit more to make sure that we remain one of the leading players. Metropolitan Life, sort of decent clip on earnings, 5 to 10%. But again, funeral and risk is growing in double digits, in fact, close to 15, 20% in these projections. Savings profits, we're expecting to go backwards by 100 million. So that was the point that Hilly made, that savings profits are going to decline substantially. And the reality is that the new business we sell today, the charges to clients, is just chalk and cheese to what it used to be. Also, a lot of you will remember the whole statement of intent and the surrender penalties. That's all coming to full play now. So we're not really making any surrender profits anymore here. Then we get Momentum Corporate. Now, this is also interesting in that the actual earnings growth you're going to see is going to be massive because the current earnings are being pummeled by COVID. Okay, but if we add back the COVID losses, the earnings for corporate is about 450, 500. We're expecting quite modest growth there. And the reason is that what is the primary assumption of growth in this business? It is the growth in the risk book, which is a function of employment and salary growth and so on. So we're taking quite a conservative view on the in-force book growth within Momentum Corporate. The other one here is there is nearly a 20 billion rand annuity book. So we did a couple of big annuities over the years. Those profits are slowly shrinking until we find the next big annuity. And in our projections, we don't want to put in another big deal where we don't know of one. So I think the annuity profits will decline a little bit over the next 3 years unless we sign another mega deal somewhere. Okay, health. I think this will be a positive surprise for quite a few people. We're sort of expecting 5 to 10%. So we're expecting real earnings growth in health. And this is a very difficult market. And it suffers from some of the same employment assumptions and so on as we had on EB. This assumption shows that we believe we're going to retain GEMS, okay, for the 3 year period, which we feel quite comfortable on. It takes into account that we have won some business lately. Okay, so I think it shows that we actually think we're in quite a strong position to defend and grow a little bit our health book. Also, the business is comfortable that its efficiency ratios will remain same or better over the 3 year period. So in health, we're expecting quite good things, and that is obviously our share of earnings. So the actual health business is nearly double the size, before minority interests. Africa, we're also expecting okay growth, 5 to 10% per annum. There's a couple of different themes in here. So there are some real growth stories like Ghana. When I joined, Ghana was losing 50 million a year, and now 5 years later, it's making more than 50. So Ghana is growing linearly at quite a nice sort of slope. So we expect Ghana to continue generating good growth. We also think the Namibia profitability can be improved further. So Namibia has been receiving a lot of TLC over the last few years. There's been a lot of, I would call them almost like operational issues that have also made it difficult to really optimize profitability there. So I think Namibia will improve. On the other side, we do have 80% of the Lesotho market. So it's a bit hard to expect very rapid growth in that business. The other one is that we do have quite a few bank assurance contracts across Africa. And on those, you need to be careful what you assume in terms of profit share going forward. So we are allowing for the fact that we might make a little bit less on bank assurance going forward. Okay, then we get to the more exciting stuff. So non-life, we're expecting very good growth, 15 to 20%. That growth is actually both across guard risk and momentum insurance. Now, guard risk is a lot of just pure gaining of additional clients and underwriting exposure. There's two angles to it. The underwriting one, I think most people get it nowadays, that guard risk has been in the market for 20 years. They know the underwriters, they know the different market segments. They can sort of pick and choose a bit who they want to partner with, who they want to buy, who they want to share risk with. And so far, they've done it quite well. And we'll continue providing capital for them to do that. So we're happy with that part of the strategy. The other part that surprises me, well, I don't know, it doesn't surprise me anymore. It surprised me a few years ago. There's still very good demand for self-captive solutions from big corporates. You know, you always think to yourself, why don't these guys do it themselves? But the reality is, Guardless does it well enough that I don't think it's worth the effort to try to do it themselves. You know, I think it is a really good offering for the corporate segment. Then you got momentum insurance that Brunt will talk about a bit later. You know, the earnings growth is really driven by two things. One is extracting the synergies, both revenue and expenses, from the merger of AFI and Momentum Short-Term Insurance. But there's also genuine growth expectations in that the business are complementary. You know, so Momentum can bring technology and more modern way of underwriting and thinking about the business. You know, AFI can maybe bring a better product offering for the broker market. You know, maybe a slightly different client perception and so on. You know what I mean? So we are expecting quite good growth in short-term insurance as well, the retail side. New initiatives, we're expecting a R500 million delta here. Now India will account for about 350, 400 off that. So India is a big swing factor here. As Hilly said, we actually had planned to bring the CEO of the India business here, but because of the timing and the results in India, couldn't really do so. The other thing that you need to note is we're also assuming that the IO losses and multiply money losses will go basically to zero. So that's also assumed there. And the last one is shareholders. We're going to try to keep the head office expenses flat for the next 3 years. Yeah. Okay, and I get a range of 4.6 billion to 5 billion. You know, so Hilly thinks it's 5 billion point estimate. I'm telling you, it's a bit of a range here. And you know what? Hilly has been moaning a bit that these growth rates are quite modest, but I think in the current environment to grow at 10, 15% is no joke. You know, so I think these are quite good numbers. Now, clearly, it also has an impact on our ROE projection. So I only have one slide here. I don't want to bore you by stepping through everything. But on your own time, you can look at some of these numbers here. I mean, a couple of things happens here. The green blocks, if you look very carefully, the average ROE declines a little bit by 1 or 2%. You know, so we're assuming that some new business margin compression and typical actuarial assumptions is that if you made a positive variance of 170 this year and your model it's 150 next year, 150, you know, so we have got the ROEs falling a little bit on the green block. Within the yellow blocks, both Africa and non-life are going from 11, 12 to 14, you know, so they're moving up within the yellow block. The big one is new initiatives. It goes from being a drag on ROE, a big drag, to being a modest drag, sort of slightly below the average for the group. And we get to a ROE of 18 to 20%. But like I said, I'm also quite confident on the 20 because there's a few things on the NAV. Also, if you start looking carefully at the bottom, you will see that the African NAV, for example, is hardly growing. It's because we're busy with a project where by September, October this year, we would have extracted R1 billion of capital out of Africa through special dividends. You know, we already extracted about R500 million to date as we speak here. You know, so we're doing quite a big capital sweep of the Africa businesses to get them to be a bit more efficient. Whereas on non-life, you know, as an example, we're thinking of recapturing quite a bit of the reinsurance we're currently utilizing. So that requires a bit of capital. You know, so the NAVs will tell you also some story if you go think about it in terms of what we're planning. Okay, and then we get to this sort of consolidated view. The three bullets on the left are quite a nice summary. So two of them are similar to last time. So last time we said we'll improve new initiatives by 100 million. This time we're saying we're going to improve by 500 million. Okay, so particularly in India, we're getting much closer to that steep part of the J-curve. Non-life profits we expect to grow by 300 million, again quite evenly between Godric and MSTI. And the last one that is, Hilly alluded to it, If you look at our life insurance projections, our savings profits are hardly growing, but our risk profits are growing substantially. So we're expecting 600 million more life underwriting profits in 3 years. As a percentage of profit, that means we're expecting, literally 30% growth in life insurance underwriting profits. Yeah, 30 to 40%. Okay. Now, I also had the privilege of doing the most technical presentation today. So now we warmed up on the numbers. Now we can go to the slightly more detailed stuff. As I mentioned, asking people for what is cash generation in a life company is an interesting exercise, but you will never get an answer. So you need to decide somewhere what is cash. We have taken a very puristic view of cash. It is the maximum dividend you can pay from company A to B and from B to C and ultimately to holdings. So I had quite a few of the finance guys, and I think Gerbe is here, for example. I asked the guys to go and say, okay, go and interrogate potential dividends from every business for the next 3 years. Because the dividends really take into account earnings projections, capital requirements, liquidity requirements, business as usual projects. So rather than having a nice formula across everything, it was a bit more bottoms up again, which we do in a lot of things, is we wanted to say, okay, what are the dividends you can pay? Okay, and then we modeled dividends that can be paid up to holdings. One very important part of that is internal capital targets. Basically, how much the business units feel they need to retain, just business as usual basis. Then we obviously have some specific capital investments that fall a bit outside of business as usual, like India. There was no point in asking India for dividends. We just basically modeled how much dividend goes to holdings and then money goes out to support India. And there's also 1 or 2 planned projects that we asked the business units to give us dividends without them, but we have subsequently approved all the way to board level some technology projects without a few hundred million. Those were deducted from the cash generation as well. I showed there it's critical, the internal capital targets. So the one thing we also did is we looked at the main business units, and the largest by far is Momentum Life. So we have totally reviewed our Momentum Metropolitan Life, the combined life business, our view of target capital there. Now, if you go back the last time we spoke, we said we're targeting SCR cover of 1.7 to 2.1 billion. Okay? That's been our official target for a couple of years. That basically tells you that we want to have SAM capital of 25 billion to 30 billion. Straightforward, but that's quite a wide range. At 25 to 30 billion is not very useful for modeling dividends and things. So we had to dig a little bit deeper. And the first thing you do is you look at the quality and the nature of the capital. So if you look on the left-hand side of the slide, when you pick up our SAM returns, you'll see we've got 31 billion of capital. But in reality, half of that is future profits. Okay, it's the margins in your book. That could be converted to cash through reinsurance, but it's quite expensive. So we said, okay, let's ignore that. We can't pay out the VIF. The other thing that's interesting of the VIF, and this was to me the most interesting part of the recent modeling, it has a very nice correlation to required capital in that, let's say we grow our business a lot. The VIF grows, but the lapse risk grows. Let's say interest rates go up. Interest rate risk, decreases, but so does the VIF decrease. So that VIF component of your available capital actually fluctuates very much with the required capital. So it's not distributable, but it's a very good hedge for your regulatory capital. Then you have a strategic and restricted capital. So the life company, it's a separate legal entity, so you can give a loan to, for example, Guardrisk. Guardrisk go do some premium financing, 300 million. But now we're not going to pull that financing from Guardrisk overnight to pay claims. So some of that capital is quite locked in to support the group strategic initiatives across other business units. Okay, that block will also contain fixed assets. Okay, so half the capital is future profits, can't distribute. 5 billion of the capital is stuff that I can't really access because A, it's either not in liquid form, or accessing it will destroy another part of our group in terms of complications. It leaves you with 12 billion of what I call high quality liquid NAV. This is sort of using the, I don't know if you guys remember that ex-Prudential guy who was the CFO of Old Mutual. And the one time he got so upset about asking about cash, he said, I'll bring you in a truck tomorrow. So I don't know if we can, but we can probably bring 12 billion in an armored van here if needed be. Okay, so that's the high quality NAV. So once we determined what is the real NAV we have access to, on any given day. We then did new modeling of saying if some of the volatility is absorbed by the VIF component and some of it's absorbed by the strategic component, what is the remaining volatility we're happy to take on the high quality NAV? And we came to a view that we would never want less than 8.5 billion of this high quality NAV on our books. Okay. The second thing we realized is because a lot of the volatility is absorbed by the VIF component, we can have quite a tight range of 2 billion around it. So we're saying it's 9.5 billion to 11.5 billion. That is our range of what I call high quality NAV. I think the guys call it something else in the actuarial team. Okay. Now, it also means when we model the dividends, any money, any good quality capital above the 11.5, we model as being distributed immediately out. You will see there's a small surplus right now, and obviously that will be topical in the next cycle of board meetings leading up to the year end, and we'll look at that. Okay, now, because this is a nominal rand value, and it's not all of your capital, it's a bit hard to. How does this compare to the previous 1.7 to 2.1? You know, there's not a formula answer between the two, but I would say that it equates to a slightly lower cover, maybe a cover of 1.6 to 2 versus 1.7 to 2.1. Okay. Okay, so once we had a good hard look at of how do we model capital requirements going forward, that 11.5 billion also grows over time. So this is where the guys go wild and do very impressive modeling, and then they come with a good common sense answer anyway. That 11.5 billion will grow at about 300 to 500 million a year. So that is our best estimate at the moment of the upper end of the capital target migrating over time for the next 3 years. It also means we need to retain 300 to 500 million of earnings every year. Now we're expecting earnings of about 3 billion rand a year from this life legal entity. You do simple maths, 3 billion less 500, you get to, 82%. So we estimate that in the life business, on average, we'll be able to distribute 80 to 90% of earnings to holdings. And that then being the cash generation estimate for the life business. The bullet point in the middle is also quite important. Our negative reserves are very small. In MetLife, it's like 1 billion. In Momentum Life, it's less than 3 billion. You know, we have very little intangible assets that impact our earnings. Okay. Also, we have historically not used reinsurance to convert it to cash. So that's the other thing I told the guys is that as Myriad grows and whatever, one day we might need to look at how do we become more active in converting earnings to cash. But for now, all the earnings are quite easily, or not easily, but are distributable with the cash available on the balance sheet, in the policy of the funds as well. Okay, so that's the big business. Then we get to the smaller businesses, and I think I will finish on time. So we took the remaining businesses, you know, we have 140 legal entities in the group, and Momentum Metropolitan Life is one, but it accounts for like 80% of everything. Then we took those remaining businesses and we put them into 3 buckets. There's the mature, established businesses like Health. Health actually has an official dividend policy to its board of paying out 80% of earnings. Okay, happy days. Then we have businesses like MSTI in the middle block. They're now profitable businesses as part of with Forbes, but they're still growing. They need to reinvest capital in terms of being able to recapture reinsurance. There, the payout ratio gets to be quite low quite quickly. Then, and this is one of the unfortunate realities of finance, businesses that make losses, you have to fund 100%. In fact, 110%, because quite often they're growing while they're losing money. So you need to cover the operating losses and the capital requirements as well. Okay. You combine all this, the cash generation of the remaining business are quite low, sort of between 0 and 30% over the next 3 years. Okay. So a very cash generative core business and quite modest cash generation outside of that. Now you bring it together, and I'm not going to repeat too many things here. We estimate that for the next 3 years, we'll average 50 to 60% cash generation to NHE. Okay. Now, if you look at our dividend policy, we pay out between 33 and 50% of normalized headline earnings. It means that between 17 and 10% of earnings that are in cash are not paid out. So there's about 500 million a year on average of cash in excess of the dividend that ends up coming to holdings. Now, I'm quite happy with that buffer because obviously the world doesn't always go like in the movies. So if there's another COVID wave, it might be nice to have some money to rebuild the balance sheet ratios and so on. I think once that buffer becomes more like $1 billion and stuff, we will have to go and revisit the dividend policy at some stage. But I think it will only happen once India becomes self-funding. So maybe that's for the next strategy day that we'll talk about the dividend policy. Okay, so we're giving you a bit of a stab now at some of these numbers. Yeah, I mean, you're welcome to obviously send questions through, and the finance guys can maybe answer some of the more detailed questions if you're interested. Okay, and I'll just finish off. Like I say, this is the last slide, is really a bringing together the most common questions we get asked, and how do we answer them? Usually we answer them the same, Hilly, so that's good as well. Okay, the first point sounds obvious, but it's not. We will not hoard capital. When you're sitting on excess capital, you know how lucky it is to sit there and think, okay, let's just keep it for another 6 months, 12 months, maybe something happens. You never know. You might want to have a war chest in case you want to do some M&A. I think we have decided that the cost of holding cash is just so hideous that we will be very strict in terms of any capital above that 11.5 billion in the life business, and any capital sitting in holdings that is not needed in the next 12 months will be distributed. Okay, we're going to try and hold ourselves very strict not to hoard capital to dilute returns. I suppose there's two angles to it. Is if we ever need more capital than, let's say, 2 or 3 billion, we might need to, if it's for an acquisition of some type, and I can tell you now there's nothing going on, we might have to say, guys, because we didn't hold a war chest, we need to talk to you, which my view is always that shareholders will be willing to support you if it makes sense. Yeah. The other side is obviously if earnings are very weak, we won't have much surplus capital to pay a dividend out of the balance sheet. So dividends will have to follow earnings quite carefully in this model as well. The second point also important is 3 years ago when we changed dividend policy, at the same time we also said no dividend, we'll do a buyback program. Now, some shareholders didn't quite like that, and to be honest, different shareholders have different views on dividends versus buybacks. And we sort of acknowledge the fact that we need to keep both types of shareholders satisfied with our capital management policy. So we're also making a firm statement that we will never suspend dividends to a buyback program. It will always be an and on top of normal ordinary dividends. Okay, when I say never, I mean obviously if the share price discount is 80 or 90 or something, who knows, but for now, under all normal scenarios, we will pay a dividend and do a buyback together. Then the third point, and I always invite people to give us feedback, the third point comes from shareholder feedback over the last year. When our rating went down to 50% of EV, whatever, a couple of shareholders asked us, what is your hurdle rates in terms of acquisitions versus buybacks and so on? And we always sort of looked at our own share price, but it wasn't a direct input into our cost of equity. So again, in this audience, you guys will probably understand exactly what I'm talking about, but we're basically taking market implied cost of equity in ourselves into our hurdle rate framework continuously. So the weaker our own share price becomes, the higher the hurdle does come for M&A, and more attractive buybacks, for example, become. So if you went back a couple of years, you would have think that any deal at 20%, 25%, you'll look at doing it. But now we're saying that if our share price is implying a cost of equity of 30 because the market's collapsed, we might want to hold back and rather do buybacks than M&A. Then also the fourth point is quite important, is once you decide you have surplus capital, then you get into a long debate, how do you deploy it? So we have set up a slightly more formal policy of how we compare buybacks versus special dividends. And it's not just a price to EV rating, it also takes your ROEV forecasts and EV profits into account. I think that step is also useful, that it will speed up. So once you decide that you have surplus capital, I think it becomes almost automatic immediately what the process would be. So maybe you save yourself one round of debate and everything else. Then the last point, it feels a bit out, but I also want to land the message is that the numbers we have shown today is really the work we've done to date. We're still busy with other work. And there's three things we're looking at the moment. The iterative risk margin is probably the biggest one. So it's been quite topical in the industry because some of our competitors have spoken about how beneficial it is to them. So we're busy doing that work. And our current estimate is that it will reduce our required capital by R1 billion or so. Okay. So again, we've been historically quite conservative in the way we calculate our capital, and the iterative risk margin is the next step that we're going to do. So that will help in terms of capital. And obviously the required capital, I'm talking about solvency capital. You know, if it's R1 billion lower, there's a ratio. It might be R1.5 billion less of capital. The other thing we're looking at is there are some business units where internal models would be much more reflective of reality than the current standard formula. You know, now we have parked that work for a while because we also felt that maybe the regulator had its hands full. We will slowly start picking up that work again. So that's a bit longer term than the iterative risk margin. But that could also result in quite good relief in terms of capital. And the last point is that we've done a lot of work, and Jack is here as well, in terms of reinsurance. So historically, we have not used reinsurance at all. Well, very minimal reinsurance to manage our capital position. And if we look at the overseas market and even some of the local competitors, you know, we need to examine whether we've been overly conservative by not, because sometimes the reinsurance has a real economic advantage. So we will investigate that a little bit more. Besides capital, it also has a liquidity issue. You know, so better use of reinsurance will also make it easier to convert profits into cash, you know, at any given time. Okay, so we'll continue doing that work. Okay, and that brings me to the end of my presentation. The guys took good notes here. That's good, because when I did this presentation internally, the guys fell asleep. You know, so at least I found a good audience for the financial stuff. Okay, thank you, Charlene.
You did something. Thank you very much, Risto. It now gives me great pleasure to call to the stage Peter Chiguvo. He's the CEO of Metropolitan Life. If ever there was a successful turnaround story to tell, it is this one of Metropolitan. And who better to tell it than the person who was spearheading that turnaround? Peter joined Metropolitan in 2017 to head up distribution and then became CEO of Metropolitan in 2018. And he always tells the story of how when teams work together in unison, the outcome is bound to be positive. So it's only fitting then that Metropolitan, under his leadership, has the slogan, "Together we can."
Thank you, Charlene. Let's try again. Thank you, Charlene. And a very good morning, everyone. So I will be sharing with you the Metropolitan business ambition. And then I'm also going to take you through the reset and grow journey. A very good journey, if you were to ask me. And thereafter, I'm going to spend time to talk to the different strategic objectives for the reset and for the reinvent and grow. And I'm also going to go into some of the details when it comes to how we're going to be growing the business going forward. Now, our vision is to be the household name with a policy in every emerging market home. And at this, I know it is a tall order, because currently we're sitting at about 2 million policies. But the key thing here is we're galvanizing everyone who works for Metropolitan to say, how do we make sure that we put one step forward towards the goal that we have really set for ourselves? And now this vision, it also allows our own employees on an ongoing basis wherein you have to reflect and say, is what I'm doing today taking us closer to what we really want to achieve? For me, every one policy that we get, it is very much aligned with our purpose, because we are helping another client to achieve their own financial life goal. And in doing this, we need to make sure that we can continue to create value, not only for our clients, but for the shareholders, employees, as well as the employer. Now, for us to be able to give life to the vision that I just articulated now, and now we look into the product basket that we have. When I look into this, I know in many instances, when you talk about Metropolitan, the first thing that comes to mind is funeral policies. Yes, there's a lot of margin there. That's where we go. But there's other protection solutions that we have. We have got the post-retirement solutions as well, which to me, this creates an opportunity for us. More so given that currently we have got an economy that is really limping. That being the case, it gives us an opportunity to go back to the clients that we already have a stronger relationship with and be able to give them different solutions that we're sitting with. It is a very competitive product basket that we do have. Now, let me talk a little bit about the reset and grow. And I said earlier, this is a good story. But now, I'm going to go back to about 3 years ago when we started with the reset and grow. We were changing the operating model, which on its own, it pushed us to a point where we find that we really needed to make sure that we can restructure the distribution channels. After restructuring the distribution channels, we realized that we were sitting with a different challenge. We had to come up with a RAM structure which will be in line with that. Immediately coming up with a new RAM structure, we lost some of the key salespeople from our business. After losing the key people in our business, productivity went in the wrong direction. And then we thought, let's quickly go and get new advisors who can be able to help us solve this issue. Somehow we relaxed our own minimum requirements on how we really bring people into the business. We ended up with new people in the system. We were not even onboarding them appropriately, and that created even bigger issues for us. And now these issues, you'll find that they are very much interrelated. In trying to solve them, and without a clearly defined way of doing it, you end up creating even more issues for yourself. Those new advisors who were not onboarded, in the end, they didn't have a work site. And if you don't have a work site as a new advisor, who do you go and write a policy? You go your mom, your dad, your granny, you also write your friends, and then your ex-girlfriend, ex-boyfriend. And in no time, you've got no new people that you can be able to write. You're sitting with a bigger issue. And then we continue to see the churn in the business that we brought in. And that to us was a challenge that we were sitting with. Very encouraging at the same time was, we knew there were certain things which were really going for us. I mean, you look on the right-hand side, we continue to win the Sexy Awards, which to me was a very good thing to say, there's something good that we're really doing, more so to the customers. That's why they were really saying, we are a good brand. And then we were also saying, the fact that we still have got more than 2 million customers, there is something there. And what is it that we can do? And then we look into the team that we have, more so the indoor staff. They were very much aware of the challenges that we were sitting with, but they were also aware that we can be able to turn this business around and be able to create value for ourselves. And that is when we came up with the other point here is the relationships that we had with the unions. To me, that is value. But if you do not know as to how can you be able to extract value from there, you're as good as you don't have anything. And now this led us to the strategic objectives, which were very much embedded in the reset and growth strategy, to say these are the things that we need to do as a team if we were to really get the business, turn the business around. Also, we needed to understand as to where do we really start so that we can be able to have a domino effect. We didn't want to find ourselves trying to do so many hundred things without necessarily knowing as to how can we be able to move to the next level. Key thing was we need new business because that is the blood of the organization. For us to get new business, more so the right business, you need to have a stable sales force. And for you to have a stable sales force, you need to have the right leadership who are going to help you to do that. Normally, when you have got good regional managers, good sales managers, they will also bring the right people into the business. And that's where we really started to ensure that we can have the people that we can equip and make sure that they can be able to take our value proposition out there. Because we're not making money in the past, we were sitting with some of the dilapidated offices across the country. I remember immediately after joining, I went to a meeting in Ladysmith. And as I was driving there, I drove past this shopping center in Ladysmith. It's the Metropolitan shopping center. I thought our offices would be there. It wasn't. And then I went to some corner there. We had a meeting with the team. I mean, we were in a small room, 16 of us, almost like sitting on top of each other. And then when you walk outside, you would see the branding. I mean, it's supposed to be blue. It was so old and tired. It was like the ABSA or Metropolitan. And that to me was a clear indication that we were somehow not necessarily looking after some of the things that we had because we didn't have the money. So yes, Risto and Healy gave us some money. We managed to spend some money on this. We have got beautiful offices out there now. Clients are happy to go there. Our own employees, they are happy to be associated with a company that has got such beautiful offices. Yes, given the COVID-19, this may not necessarily continue as we have been doing, but key for us is to make sure that we can be able to balance the money we spend on this with the return on investment, as well as the service that we give to the customers. So yes, we will still be able to look into areas where we have to do that. If we have alternatives that we can be able to utilize instead of a POP, we should still be able to do that. System migration. This has been a journey. And now, the one thing that we have done to date was the migration of our funeral book, which was plus minus million policies that we have migrated successfully. And yes, post-migration, there were still some hiccups, but I can confidently say that what we have done here, it was a success. We still have the savings migration that we still have to do by 2024, and that will remain a key thing that we need to deliver on during this planning period. And then on the right-hand side, we look at the advisor productivity. There was a time where we used to do 1.37 policies per advisor per week. To look like it was far off for us to be able to reach at that stage. Today I can tell you at the end of March, we're already sitting at 3.4, 3.5 policies per advisor per week. So we have more than doubled. And it is not only one thing that has really gotten us to that point. It's so many different small things that we had to do to make sure that we can bring the sustainable business going forward. I'm also happy to see productivity going up. And at the time, you are also bringing new people into the business, which wasn't necessarily the case in the past. And we never compromised on the quality. And that, to me, it talks to building a sustainable and profitable business going forward. The market access was the key contributor to ensure that we can be able to really get the productivity I'm referring to. This is where we have a team that go out, make sure that they can be able to get the new work sites, so that when we bring someone into the business, we already know as to where are we going to place you. And that individual can be able to build their own name and build the relationship in the work site so that they can be able to sell. And the business that we get in the work site, it's stop order business. And that, to me, it is also linked to the profitability of our business. The value proposition. We continuously look into what we have. In the last 12 months, we have had the cashback that we put through into the system. It was very much encouraging to see how the salespeople were so happy to see new solutions, saying, you know what, it's been 3-4 years that we have got a new product. They were happy to see that happening. Now, we have just launched MLCP, which is the Metropolitan Life Cover Plan. And with this, it is the limited underwriting kind of a solution, which is very much in line with what the customers are also expecting from us. And this creates new energy in the channel. Also, advisors can be able to go back to the same clients they have and be able to sell additional solutions. And these are the things that will make sure that we continue doing. Yes, Risto and Healy mentioned the saving solutions. I fully agree with them. Yes, now we are coming up with a new saving solution, but the key thing for us there was, let's make sure that we can be able to create value for the customer. But we're going to be taking a knock on the VNB, just because Now we want to try and make sure that the customers who take this up, they can be able to get value back. Whereas in the past, we have got some of the solutions that we have sold out. You have an advisor who sold you a saving solution. 5-7 years later, you realize that I've contributed about 200,000 as an example, but we couldn't even give them the 200,000. And now, as an advisor, you find that you're no longer comfortable to operate in that work site. And that is why the new solution has taken that into consideration. Sales and service efficiencies. There's quite a number of things that we're doing in this space. Very exciting stuff that we're going to be launching in the next month or two as well. But some of the stuff that we started to roll out a while back, which contribute to efficiencies and ultimately to the profitability, were digital enrollment. And that to us was such a big thing. Yes, it was limited to the funeral solution, but we'd like to see this also go into the other solutions that we have. We have got the cashless claims where you just give us the policy number and then we can be able to do your claim and without having to do any other thing. And this to me, it talks about creating efficiencies. And now the cashback as well as some of the maturity claims, they have to be now dealt or managed by the robots, which in my view, that also talks to efficiencies. And there is some saving that we generate just by doing that. While we were on the reset and grow journey, and now there was a time where we realized that's why you would see the Metropolitan get up. It's in blue, light blue. When we started, it wasn't there. We reached a point where we realized that we were very much internally focused. Because we are internally focused, the world is not going to sit and wait for us to first restart our business and say, let's go again. That's when we said, let's start up with something that will be focusing on trying to create growth for us. Also to try and future-proof our business. And what we also had at the time was about 49%, not 49%. It is the average age for our book was 49 years. And now that meant we're sitting with people who are really on the wrong side. On the other hand, we were not necessarily getting the younger generation. And when we look into what we have, we realize there may be other reasons why they are not necessarily coming to us. It's not only the solution, it may also be how you engage with them. With the Metropolitan Get Up, which is a digital outfit, we realize that this is going to create a new revenue stream for us, and this will continue to build going forward. Come H1 financial year 2021, that was in December. I mean, when we got the results and then we looked into this as a team, we said, you know what, we have really done very well. More so given that this past financial year, we have been sitting with a challenge around COVID-19. To see ourselves having been able to grow and be able to get some of the numbers that I'm sure reflecting here, it was clear that we have really done so many other small things which has really gotten us to this level. Should COVID-19 have hit us in 2017, 2018, I don't think we would have been able to survive. That would have decimated us. The fact that we could still be able to see some of the growth under these difficult conditions, it's a clear indication that we have really solidified or built a solid base from which we should be able to build from here going forward. VNB growth at 70%, and then we look at the operating profit. Yes, if you were to exclude COVID-19, we managed to grow by 9%. That to me, it's a big thing. And then on PVP, first quarter of this financial year, we were 15% down year on year. And by the end of the second quarter, and then H1, we're sitting at +1. And I can assure you, this trend that you're seeing here, it is continuing into Q3, and I hope it continues up to the next 2 years or more. And then let me share with you some of the metrics that we utilize to try and track as to how did we really perform when it comes to the reset and grow. Market share, 2017 or thereabout. I mean, the market share for Sanlam as well as ourselves was 17%. And now you fast forward, you can see that Sanlam was the biggest gainer compared to the competitors that we have on the list. But for me, the big thing here is if you were to remove the capital contribution to Sanlam, And then ourselves in Sanlam, we are almost the same, which means we are there as Metropolitan. And even important, the last 2 semesters, we have started to see a turnaround when it comes to the market share, which is good, and we need to make sure that we can continue to build on this going forward. The number of advisors. Hilly mentioned that there was a time where we decided we're going to go back, and we went as low as 3,000 or just over 3,000 advisors. But when we started to build up, we knew exactly how we were building the new sales force, making sure that we have the profile of the advisor that you want. There was a time where as long as it walks and it's got a heartbeat, it was an advisor. We realized that wasn't necessarily helping us. We needed to define the profile of an advisor that we want. And also key to this, HC has to assist us to make sure that we can train them appropriately. There was a time where 4 years ago, training was about 2-3 days. Now it is as long as a month. And if you were to look into what we're achieving now, it's because of all the different things that we did to make sure that we grow the business. The graph on the right, there was a time where advisors who have been with us for 4 months and above was only 37%. Today, the same group, we keep more than 60% of those. And that has got so many other multiplier effects. But these results we're getting because of all the different things that we have done to date. Productivity. Advisors stay with us if they are earning. If the productivity is good, you know that they're also going to earn. If the quality of the business they're doing is good, you know that they're going to be with you. And which is why when I look into productivity today, productivity used to be very, very low when it comes to the new advisors. Now, even new advisors who have been with us for less than 6 months, they manage to really deliver more than 2 cases per advisor per week, which is such a big thing. And the good thing is we are getting this productivity with the stop order, and which also means because it's payroll deduction, the chances of getting your premium is much higher. This is where we see the quality of our own business. Now, this was not only limited to the tied agency space. In the call center, we have seen a huge improvement on the productivity. And now, in the past, all the business that we got in the telechannel, it was debit order business. And now, with some of the digital enablement that we have introduced in our business, we have now the people who are working in the call center, they can also write stop order. The new business we're getting in the call center, between 10 and 15% of the new business, it is stop order, which is also going to try and make sure that it helps on the quality of business that we have. Now, looking into how we improve profitability. Now, here we looked into what are those profitability levers that we need to look after. One, we needed to make sure that you have got the right manpower. 2, retention key. And then we also needed to make sure that we have productivity, so quantity as well as the quality of business, which we measure through the stop order. And now for each one of these, there's a rating. Based on that, we will categorize and say this is a poor branch, and this is an average branch. This is a branch that is performing to expectation, and exceptional branches. What is exciting to look at here is, there was a time, if you look on the left, we used to have 159 branches which were falling into the category of poor performers. We have really knocked that down. It is currently sitting at 28. And that, to me, is such a huge improvement that we have really done. And now those are the branches who have now moved up. And now if we left with only 28, yes, you may find that some of those 28, they may be vacant. And that, to me, it's a clear indication that we have really turned things around. Again, when it comes to the branches, if you're a regional manager, because you've got these branch managers reporting to you, you cannot rely on 2 branches to be carrying you for it to be remunerated. It is the average of all the branches, which means you need to look after each and every branch and make sure that they're really performing to expectation. We have managed to do that. You look onto the call center space, there's not even a single branch which falls within the category of poor performance. And that is solid, and we need to make sure that we continue. What is even more encouraging is when we're doing all of this, we were not dropping on other elements which are key to really drive our business. Now, here we're saying there's so many things that we have been doing, and now they culminate in VNB growth, the PVP growth. If you look here, you will see that protection business has been really growing. There are a number of things that contributed to that. One, the digital enablement, which during the COVID-19, we could still be able to really sell the funeral policies. That helped us a lot. Secondly, Telechannel was not performing as it is now. And now the products that we sell in the telesale, it's all protection business as well. And the fact that we are also getting the stop order from there, that contributed to that. And then you also look into the annuities and structured solutions that we have. And now there's quite a lot that we have done to ensure that we can be able to drive that. And now that really changed the mix of the products that we're selling. We find that we were selling the products that create more margin and value for us. That's why the value of new business has really gone up. Yes, saving has taken a dive. And then the other element here is, if you check the stop orders, it used to sit at about 32% of the new business we're getting. Now we get 43% of the new business is payroll deduction, which on its own, it increases the DMT, which will also mean that now you have got an opportunity to get your premium, and then that will also be reflected on the profitability that you get going forward. And now all of this, in my view, it was not only one thing that we did, it was a combination of different things that we made sure that we introduced to manage the business and understand exactly what was happening. Key was the BI, which we continue to get on a daily basis, even for salespeople. At any given time, with the daily cadence solutions that we have, you know who is behind, you know what the challenges they may have, so that the intervention can be able to assist them. Now, the reset and grow is all in the past. They say you are as good as your previous sales, so now we need to focus forward. But the most important thing, we have built a solid base from which we can be able to build from. We have learned so much, and now with all the lessons that we have got, we should be able to build an even better business going forward. Now, as for the reinvent and grow, for us, this is a more distribution-led strategy. And I look into what are the things that we're going to do in core. We need to make sure that we maximize and entrench all the lessons that we have got to learn to ensure that we can be able to build from here going forward. And now, with our digital outfit, we also need to make sure that we can future-proof our business so that we can be able to remain relevant in the future while we are also getting value from the business we have had for a while. How are we going to do that? There's quite a number of things that we're going to have to make sure that we attend to for us to be able to deliver on that. And now the starting one will be cost. Cost is key. Earlier on, I was talking about the different efficiencies. There's a lot more that we're going to have to do to ensure that we can create efficiencies. In doing that, it is definitely going to contribute into reducing costs. We also need to make sure that we understand the value chain of our business. I mean, with COVID-19 and some of the things that we're doing now, we do training for the new advisors, and then it's done digitally now. You get to be employed. You don't even have to go to the office. And yes, it's not ideal. Sometimes they complain, I work for this company, but I don't even know where the office is. But that's what we're doing. We're saving some money when it comes to that. The world has changed. We need to make sure that we can adapt what we have so that we can remain relevant. Talent management and transformation. As Metropolitan, Healy said, no, each business unit is responsible for their plan. Yes, we are also very much responsible to really have plans of our own, and we also need to make sure that we deliver on that. We don't necessarily have got a transformation issue when it comes to the people in our business. This is something that we have managed to really fix. If you were to look into my own ExCo, we have got a diverse team that feel very much part of the team because we are on the same table and your voice will be heard so that when we move forward, we are fully aligned, we are one, and we can be able to take the same message to the rest of the team. With the results that we have been getting, there is an issue which we have been sitting with in the past where people used to doubt to come and join us. When we recruit and say, why Metropolitan? I mean, I spoke to my wife, and then they don't even understand why am I going to Metropolitan. But those who have really came to join us, now after spending some time here, they say, this is the best place to be. This was the best decision I made for myself. As we see the results that we see now, the people out there, they know that now this person, when they look what is happening there, I've been getting a lot of LinkedIn requests from the competitors. The moment I accept, they ask me for a role, and I don't have. Migration and automation. Yes, I mentioned we still have the savings migration, which we're going to be doing during this planning period. Automation, there's quite a few things that definitely are exciting, which we're going to be rolling out. Metropolitan Get Up plays a role in reinventing how we sell the policies, as well as to contribute into the growth that we want to achieve. We want to make sure that we can have the double-digit growth of gross APE in the next 3 years. And when it comes to policy retention, we are very much aware of the dynamics that we find of our business now. We have set ourselves up to make sure that we can be able to really assist our customers, also assist the sales force to remain here by retaining the business that they brought in here. And then the last one is, I mentioned people didn't want to join us now. Now that people can notice what we're doing, and we need to build from here going forward, I also want us to now go out and make sure that we can share our story with the market, be it for someone who wants to join us or for the clients who would like to engage with us. Because yes, we have really had so many feedback to say we are an aloof brand, and sometimes we don't seem to understand we are too old brand. We're going to have to change all of that. And there is a responsibility for us as a team to ensure that we can do it. The double-digit growth, this is going to be driven by the different items that we have around our distribution. Key here is the broker channel. Up until now, I think we have really, I would say, ignored or neglected the broker channel. The focus was very much on the tied agency, and that has really given us the results that we want. And now with the basket of product that we have, as well as the lessons that we learned from the other side, now the focus is shifting into the broker channel. Yes, currently the contribution is on the low side. And then, yes, so I had Healy and Risto playing around who's conservative and all of that. And then the 6% is the one that Etienne said we should deliver. And then I said, how about 10? And then we have even now appointed a GM for our brokers. And I can say, if we can be able to find the broker contributing 10% to our overall gross APE, I'll be very happy. And I also chatted to Yapi. Yapi felt like Yapi is our head of distribution. He should be able to deliver that. So there is some work we need to do here. We need to strengthen our value proposition, because most of the brokers who are really supporting us, you find that these were tied agents within our business who reached a point where they said, I want to start my own business, and then they left. Because this is all they know, they continue to support us. We have got some stuff that we have done, and then just like marketing what we have, and that's why you would see the growth that we have seen on single premium in the last quarter, and we need to make sure that we continue building on that. The Metropolitan Get Up. Now, this is the full value chain business that we have built. And now there are 4 capabilities that we have built so far. One is around the market access in the digital world. And now also sales as well as service, it is going to be done by the chatbots, which we already have, which is very much encouraging to see what we have done. And now we look into the website. What we said here, we want clients to be able to do self-help. But over and above that, we're going to use the website as a thought leadership thing, wherein on an ongoing basis, we come up with topics to be able to engage with the market, more so the generation that we're really targeting. When it comes to the solutions, so far we are still selling the solutions that we have always had in the core business. But now we are spending a lot of time to try and engage with the youth, to try and see as to what are the relevant solutions we can be able to take to them. As an example, the younger than 30, they always think, you know what, I'm invincible. I mean, I'm never going to die. Others will tell you, you know what, I don't want to live until 70. I want to die at 50 or so I don't need insurance. And then instant gratification is what really sits in this market. Wherein if you were to go and put your 1,000 rand today, you want it to be 5,000 rand tomorrow. And now how do we really understand them as well as educate them so that we can be able to come up with solutions which will be aligned with them? That's where we're going, that's what we're going to do. And the reason why we want to do that, I mean, if you look into the South African population, I mean, the biggest percentage, it's made up of millennials as well as the Gen Z. And that on its own, it clearly indicates that we need to do something and make sure that we can be able to grow with them. Happy to say, so far, nearly 80% of the business that has been sold by GetUp, it's for younger than 40 years, which is something that we didn't have in the past. And that, to me, it means we're getting new revenue stream for the market that we were not necessarily really optimizing. So we're going to continue building on this. As you can see, the trend line there on the right, it's clearly indicating that we're starting to see the number of policies that we can generate through the bots, and we could continue to build from there. Yes, the insurtechs are there. Now, this also allows us to play in the space with some of the insurtech. The same with the banks who play in the digital space. And now this is our outfit, which should be able to really protect us as well as to try and build from there. Compared to the traditional competitors, I think this puts us a little bit ahead of the curve, and it is a good thing, and we will ensure that we build from there going forward. And then from the tied agency space, we still want to increase the sales force to about 4,000. And the key thing and what we have learned up to now, when we grow the sales force, we have seen that growing, productivity also not being dropped, and the quality not being dropped. So those are the lessons we need to bring with to the future and to ensure that we do not drop the ball again so that we can build a solid team. Earlier on, I showed you a slide which showed that more than 60% of advisors who have been with us 4 months or more, they're now staying. That on its own, it's got a multiplier effect because those advisors, they know where to get the business. They also know the quality of business they need to bring in. We need to make sure that now we stretch them a bit to get higher productivity from them. We're going to do that. The client value proposition will continue to really analyze what is happening out there. We have set up a team that is currently spending time to research and understand what is it that customers really expect from us. With so many things now changing, we thought we have got our own value proposition. We can continue to sell what we have, but if we're to go out and understand what customers expect and want from us, and make sure that we can be able to give them that, that will give us an edge, and that's something that we're doing, so we'll continue to work on that. The product mandate, this is an internal issue. Earlier on, I showed you the product basket, but we need to make sure that we get our advisors, more so those who have been with us longer, to understand and get the mandates for the different solutions that we have. That is also going to enrich the engagements that we will have with the different clients. And that's what we're going to do and make sure that we can be able to support them. And then expand the market access opportunities. We're doing well with the unions. We're doing well in the government sector. But there is something we need to do into the private sector now to say, how can we be able to now open new websites in the private sector space? Because that will be where we can be able to get additional growth. With all of this, we need to make sure that we can be able to take our business forward. In closing, I just want to say, at Metropolitan, you would know the tagline being, together we can. It talks to the power of the collective. And now, we're currently running a campaign which talks about my colleagues, my everything. It's my people, my everything. It talks to the power of collective, wherein we say, each and every one of us, if you were to reflect and look backwards, you will realize that there were so many people who have really contributed to who we are. As much as society really encourages individualism, but there is an element of different people impacting you positively, some of them nudging you into the right direction. And with that in mind, we said we need to build our brand. We need to make sure that we take our brand out there. So this is a start where we're saying, can we get South Africans to talk about reflecting of where you come from and the people who contributed positively into your life? Because when you do that, you would be able to acknowledge them and at times show gratitude for what they have really done for you. When you also do that with them as well, they will become very much intentional in making sure that they can help others. When we become intentional, the impact is much bigger. And this is where we're starting to build our brand, where we're getting South Africans to share their own stories so that we can see as to how can we be able to lift each other up. So I'm going to share with you the advert that we'll launch mid-April. Yes, there will be quite a number of other things that we're going to be doing which are very much aligned to this campaign, and we need to make sure that we can be able to build from there going forward.
Yeah, ne. Motho tswa hole. I mean, people who meet me now think I've got everything. But the truth is, without you, my people, I wouldn't be standing here today. You all became my parents after I lost my parents. Tatin without you, where would the transport money to go to my interviews have come from? You were even the only reason Thabo Letshepo had school uniform every year. Mam Zuli, the way you fought to keep me in school taught me more than just maths. Osmatshepo, my Metropolitan financial advisor. Without you, I would not have the right cover to take care of me and my loved ones. Yeah. Majita go Koneng, walking me home after late shifts. I mean, without all of you here, I wouldn't be the first Hamukwena to start a family business.
Fakabantu zobona.
Yes, Fakabantu zobona, because my people are my everything. And this is what I wanted to show you today.
Thank you, Shirley.
Thank you so much, Peter. That was quite inspiring. But I must say I was a bit sad to hear that I'm on the wrong side of Get Up as an over 40. But you have to do what you have to do, and we wish you all success. It's now time for our question and answer session, as we promised. So we have microphones on the side. If you could please just indicate your name and the name of your company, we'll get to your questions. Any takers in the room? Okay. Sorry, Healy and Risto, if you could also come to the stage, please. You also have something to say.
Good morning, everyone. Thank you very much for the presentation so far. I'll start, Peter, with Metropolitan. And just thinking about the evolution of Momentum Metropolitan and the merger and the synergies that have come out of that. And listening to you today, it sounds like there's a very clear and defined strategy for Metropolitan, which differs maybe from the rest of the group, given the fact that you've got a specific target market. And I'm just wondering whether there's still synergies to be extracted out of the merger that you can see still, and whether there is complete independence in terms of your business, in terms of setting strategies as to how sort of federated the group structure is. And then, I mean, for instance, if we look at, your Met advisors, are they able to sell Momentum product? Are they equipped to be able to sell Momentum product? And is there opportunity in that kind of strategy?
Okay. The one thing I can say is there will always be synergies that we have to explore together. But I wouldn't want to do that at the expense of what we're doing or someone else is doing. As an example, you would have seen on the slide from Healy where he was talking about retailization. And then that is something that we're still exploring as a group, wherein we would like to get to a point where Dumo has got to allow us to go to some of the corporate clients that they have. I also spoke about would like to go into the private sector. If Dumo has got a relationship with a corporate client, there's an opportunity for Dumo to allow my advisor as well as Johan Leroux's advisor to work together with a corporate lead to ensure that we can be able to really maximize on that. And then that is an opportunity that I still see that we can still be able to work together. As for my advisors selling the momentum solutions, no, we're not going there. And already you saw, I shared with you a slide which says, I sit with quite a number of solutions in my basket, but you would find that they were not selling enough. So I need to make sure that I can at least accredit them with what we have, get them to sell more. That may only happen maybe in the future, but for now, that is definitely not on the radar.
Thanks. Maybe just one more for now, Hilly and Risto. Just in terms of maybe distilling the strategy, you have set out that you're going to need to grow market share, which makes absolute sense. In terms of sustainably growing market share, effectively, you do need to have a disruptive strategy. And there's very few financial services businesses that don't have a digitization strategy. So maybe if you could just distill why your digitization strategy will differentiate you sustainably into the future. Thanks.
Look, I think also, in a way, after, let's say, all the presentations today, you might have a better idea. There might be some meat added to the bones later today. Look, I'm not, just philosophically, I'm not sort of a huge believer in, that there's only one right way of doing things or that there will be only one winner. So I would almost rather change the question and say, could we be, let's say in our digitalization plans, could we be one of the seeded players? And I certainly think that, we would be able to do that. A lot of it will, I think, come down to just small incremental steps, delivering what you set out almost on a continuous basis or in a sort of an agile way, adding small increments. And I think with our sort of delivery mindset, the way in which we almost take small bets and, and where it works, do we, take the next step, that kind of approach. I think that works for us, and I would like to believe and, that it will continue to work for us. I think some of if we start almost like, looking at some of the initiatives, what we have in mind with a platform. Now, if we have a platform that we roll out to, let's say IFAs, in order to be in a position to make that work efficiently, there's a lot of things that need to happen in the background in terms of data quality, in terms of the design of your systems to interface. But what we will have is we'll have sort of call it an open architecture type platform that brokers will put brokers in a position to self-service their clients. Onboarding will be immediate and automatic or whatever. Now, once you've created all of that, you just need to tweak the front end and you have something that clients can engage with directly. In fact, that's part of our plans. And also, now you just need to say, okay, if we now develop, sales tools, sales capabilities, maybe package some advice into some of our products or whatever, you've got the interfaces. So it's really creating, I'd say, those technological solutions with very wide applications. That's really the key. Look, I think there are challenges in our group with a federal setup. But for example, again, in Metropolitan is a much more integrated business, sort of almost like a narrower product set in a certain way. So we don't have it there. But I'm quite impressed by the way in which, the different momentum retail brands work together. And almost like have bought into a common platform, and that they all going to abide by the rules in terms of interfacing into one. So clients of IFAs will have one interface with Momentum, and that we will hide the complexities of different product houses or whatever in that process. Question sometimes, okay, why can't we do more, together in the health business and corporate, let's say on the group side. And for some reason, it looks a bit more difficult. I mean, health is a very different business to employee benefits in many, many respects. So there I would say we've got maybe, if we really want to get to a sort of a common platform there, we've got a longer way to go. I don't know whether that...
Very useful, thank you.
Cool. Thank you, Hilly. A question here from one of our virtual attendees directed at Hilly, but I think we'll let Risto have a stab at it. Hilly, you said that you won't focus on Africa, but now that you've mentioned that you'll only return to markets where you believe there are reasonable chances of success, can you say whether there are markets that you exited where you see this reasonable chance of success? And will we allocate more capital to the rest of Africa operations?
Yeah, I think in the medium term, it's unlikely we'll go back to the markets we have exited. Now, I think it's important to realize when we exit the market, it's not an easy decision to make. You sort of weigh a lot of things. And normally it's a combination of the business not performing to expectation and the macro environment in that market not being conducive. Because if it's only the business, we can try to fix it. But if it's a combination of the macro environment and the business, then exit is the natural way to go. And I don't think things will change that quickly, that we will be going back into those markets. And then it follows on that we don't really expect significant capital investment into the rest of Africa. I think in terms of shareholder value maximization, fixing Namibia is probably the biggest one. And then second one is to make sure that we continue delivering on the Ghana growth.
Okay. Thank you, Risto. Any other questions from the room, maybe? Anyone? Now take us one more from our virtual attendees. From Greg Wood, the question is, what is driving the huge turnaround in India over the next 3 years? And there's a suggestion, question mark, whether it's volume and scale.
Yeah, so it is really just volume and scale, which is the same thing, obviously. Now, the India business this year will do about 2 billion rand of net earned premium. By 2024, we'll think it will be 7 billion. So you can just see the growth rates we are expecting in India. And that 5 billion of additional premium, basically half will go to clients in claims, and about 30% will be shared between intermediaries and our own expense growth, leaving about 1 billion rand of profit emerging out of that growth. So you must also remember, when we say we're going to earn extra 400 million, it's 800 million for the group, because we are 49% shareholder. So not to labor the point, I think it's also important that we're going to expect a big difference between volume growth and expense growth over the next 3 years.
Okay.
I mean, you'll remember better, but volume growth on average over the next 3 years, and it's been close to, it's been 100% some years, and it's maybe down to 80, 90 now. But I think a sort of a nice rule of thumb type approach, which is how I remember it, is our revenue will grow by about 50% or so per annum over the next 3 years, and expenses will grow by about 25% per annum over the next 3 years. And that impact really brings down the cost ratio. And if we sort of end up with, a claims ratio around about 50% and a cost ratio of about 30% plus about another 10% on distribution costs, then there is a 10% margin in 3 or so years' time.
So there's one question from Dudu Tembo that I'm going to leave for the panel to decide who wants to take it. Hilly mentioned continuous consolidation opportunities. Are there any sectors that are very apparent in this regard? And how are you seeing valuations? Are opportunities about scale or efficient optimization?
Shall we have the debate? Yeah.
No. We differ a bit. Yeah.
Look, I mean, valuations, Risto's favorite topic. You can just imagine what Risto is dragging into. Anyway, look there, done a value to unlock. Look, I mean, on a more serious note, I think the best thing we can do for this business over the next 2 years is implement some of the organic things that will really prepare us for the future and put us in a better position. I would hate to be involved in some, look, bolt-on's fine, like we've seen, and I mean, AFI is more than Alexander Forbes was more than a bolt-on, but it was in an isolated business and was doubling up, MSTI, and it really made a lot of strategic sense and so forth. But I would hate to see something that will cause internal focus for another 2 or 3 years. And what do you have? Look, I mean, there's a lot of value to be unlocked, but the question is almost like, I mean, we've been through it now. We've seen what it means to do a big merger, maybe not unlock all the efficiency, whatever, in the first 5 years. Then you've grafted another 5 years just to almost like sort out your legacies. I mean, we still have a migration coming in 2024. I mean, it's, I think the best let 2 other guys merge and we'll go and feed on the scraps that they leave on the table. I think that's a little bit of our internal, I mean, I think we're ideally suited to do it. We've got the expertise, we've experience, we've got systems that can consolidate. Maybe we'll be in a position to do another consolidation in 2 or 3 years' time. But what this business now needs is just to focus on these, call it more organic plans that we have now. It's really, I think, the best thing we must do ourselves that service and not get us distracted.
Yeah, I think you can hear from the answer. We have a lot of work on looking at possibility of sort of larger scale M&A activity, and we have decided against it. But there's a lot of interesting smaller deals like in guard risk and in the distribution space, where you can pick up quite good assets on 6 PEs, 7 PEs. We'll continue doing that sort of stuff. You probably won't even see it, but you'll notice that there's extra 10 million of earnings here and there. We'll continue doing quite a few of those.
Cool. I think we'll give the last question to Peter, since he ended the slot for us before we go on to a break. Can you please describe the effect of migrating the Metropolitan policies? And this question from Kagiso Asset Management.
Okay. As I mentioned earlier, we have migrated the funeral book, and now we're going to be doing the savings solution. And the one thing that we did when we were migrating the funeral book was we also used that as an opportunity to modernize quite a number of things so that we don't necessarily take things as they are. And now the same thing will be applicable when we go into the savings migration. We need to make sure that we do that. And key again, we want to get to a point where we have got one enrollment system in the future, because that is how we are also going to unlock value from the migration journey that we're currently busy with. And yes, some of the challenges that we had because of the old system, and then they may not necessarily disappear immediately, but we try and make sure that we use this as an opportunity to try and address as many challenges and issues that we may have.
Yeah, they will. I mean, Peter, what's the saving? I mean, there will be a saving because I think after the final migration, we'll be able to switch off the old mainframe.
60 million or so.
60 million or so, which will be like a final definite saving in 2 years' time. But it's all baked into the numbers.
I think the floodgates have opened online because there's a lot of questions coming in from our virtual attendees. I think that's going to... 2 more. Okay, we'll take 2 more. This sounds like a question for Risto. From Michael Christelis, what do your targeted earnings mean for ROGEV to 2024?
Yeah, so Michael, I'll give you a broad answer in that we've done work on it, but it's also very dependent on things like when do we start putting an EV on India? You know what I mean? So the day we put an EV on India, you'll probably see a pickup in that year in the EV and so on. Now, whether it will be 23 or 24, we don't really know, but assuming that the non-covered businesses, nothing weird happens, the ROEV will probably be 13.5, 14 by 2024.
Okay. Last question, because time's up. I see the red light flickering. What has happened to pricing in the risk market, funeral, group life, and risk due to COVID-19? Between the panel, your choice.
Yeah.
Yeah, group life and risk, I mean, that's really Dumo's arena. I mean, on the retail side, we haven't priced. I mean, we don't think we've got enough information.
Yeah, I mean, Dumo can maybe answer the question, but the only product where we very actively changing prices is corporate. So I think on Metropolitan, the margins are fat enough to take a view that it's a short-term thing. And on Momentum Life, we're taking a more scientific reason why we're not changing rates. We do think it's a temporary phenomenon. But on corporate, being annually repriced, we are looking at price increases. Dumo, I don't know what you want to share.
Maybe just wait for the microphone to get to Dumo.
I think Dumo will give you quite a wide range.
Yeah, look, I'm not going to talk specific percentages and things like that, but more just from a guidance perspective. And what we've really messaged to the market is that, yes, you know, pricing is forward-looking, but to a large extent, what has happened in the rear-view mirror does have an impact. And I think what we are seeing is that there will be, you know, on average, you know, slightly higher levels of mortality, at least for the next year or two, especially because we are seeing a delay in the rollout of the vaccines. So that does have a knock-on impact, potentially, you know, around pricing in the group insurance space. And we look at it, you know, client by client, case by case, but directionally we have signaled. And I think one or two of our competitors have done similarly so. Reinsurers are also, you know, communicating that they are seeing, you know, a slight lift in the tide. Even when the waves subsided after wave one, we still saw relatively higher levels of mortality across the country. So that's something, you know, it will be a reality, at least for the next year or two.
Okay. Thank you, Dumo, for taking us into the break. We'll have a break until 11:24 so that you can be back in your seats by 11:25. We can continue the program. Our virtual attendees, please don't go too far. Join us here at 11:25. Thank you. Are we ready? Good. Thank you for staying with us. Thank you also to our virtual attendees for joining us for the remainder of the day. Just a few reminders that if you need your cell phone charged, there are 2 charging stations outside where you had your coffee now, and there's also a power bank in your goodie bag, so that's there for you, power to the people. Then another reminder, please, that we must continue to observe COVID protocols. There's enough room for us here to spread out so that we can remain socially distanced, as we need to do in this time. Okay, on with the show. We're now bringing you a powerhouse team for our next presentation. May I introduce Herman Skuman. He's the CEO of our non-life insurance cluster. In the middle, Brand Pretorius, the CEO of Momentum Insurance, and then Lawrence Botha, the Financial Director for Guardrisk. Now, Herman is well known and well respected in the industry and can be credited for basically building Guardrisk from scratch. As the CEO of both the non-life unit and Guardrisk, Herman moves between these roles with ease. Brand has been instrumental in defining and driving the growth of the short-term insurance business and has consistently demonstrated efficient and decisive leadership. Brand recently successfully navigated the 2 billion rand Alexander Forbes insurance acquisition. And then the best for last, Lawrence is the man taking care of the money in the business unit. Lawrence, who has 30 years experience in financial services, has been the financial director for the Guardrisk Group of companies since 2008. Gentlemen, the stage is all yours.
Shalene, thank you very much for those introductions. You know, it's almost like those certificates you get when you leave matric and the school writes a nice thing about you and you read and you say, was it really you? So thanks for that. We really appreciate that. I just want to add one thing about Lawrence. You will see, now in the business, we will talk about some significant cost cut initiatives or cost management expenses as a clear initiative. And the simple reason is we have A. Lawrence in the business. So that's why we don't need, his nickname in the business, you remember that from the dinosaurs world, T-Rex. That was the one with a short arm. So we always say Lawrence got deep pockets but very short arms. He just cannot get to the cash, to allow us to spend money, but at least he allows us to invest money. Thanks for attending. We're looking forward to the session and really to share with you a very dynamic and exciting part of the business. Obviously tough to present after Peter and his success story and his turnaround story, but I can assure you, and I really hope you will find, as much excitement from our presentation as well on the non-life side. Now, I saw Healy and Risto's presentation just now, and the what I call the creative tension between the two about ranges and pinpoints and this, that, and the other. We have something similar in our business. But I thought about just not presenting and just, put one slide up that says no pressure. Okay, in terms of the growth rates of 50% to 900 million, and we like the 850 to 900, but I saw it developing to 900 million contribution, and 20% of the profits of the group. But as a leadership team, I think we sit here today and we buy into this. We have certainly bought into this. This is not Healy's numbers. This is not Risto's numbers. It's our numbers. It's the business numbers that we're putting up into the bigger picture, because we really believe in our story that we will share with you today. We also recently had the benefit of engaging quite extensively with shareholders and investors and so forth. So our presentation that we have put up, the agendas on the slide now, is really come out of the session that we've previously had, and you can see the issues and the questions that were raised. Hopefully we'll address the majority of them and obviously deal with the questions afterwards. So I will just talk a little bit about the key aspects of the non-life insurance business in the Momentum Metropolitan world, especially between Guardrisk and then the Momentum, let's call it personal lines, commercial business for now, which when I refer to that again will be the combination of the AFI business as well as the MSTI business. We get these questions a lot. Why the two? What do you do? Are there synergies, etc.? We'll deal with that a bit. Then the reinvent and growth story. As Celia said, we're towing the line with a theme, in the slide presentation, but first of all for Guardrisk, and then also Guardrisk being a business in many times in what's seen as a mature market, what do we think is our right to win, continue to win in this marketplace? Then we move over to Brand, who will talk to us about the Momentum short-term business, a little bit on the integration and also reinvent and growth. Lawrence will share with us some of the numbers and the financial projections that the teams have committed to, and then I will conclude with one or two slides. Okay. I thought as a start, this is perhaps a slide that we can put forward just to position the two non-life or short-term businesses. In our world, we kind of use those terms interchangeably. If you add it all together, the Guardrisk non-life business as well, that will include the cell captives as well as the non-cell captive business, and you add the MSTI, AFI businesses together. The top circle, the blue one, gross written premium of 27 billion. This is F20 numbers. Earnings 405 million. Got this one right, Risto. Market share 10%. That's based on the latest KPMG report on 2019. Industry numbers, and then 1,300 odd employees in the business. So, looking at it currently, looking at the 405 million and so forth, hopefully you will find the reasons or understand the reasons when we put the story forward about supporting the targets that we've seen. It's a business that is well established. It's a business that's well educated, well staffed, that we can actually grow to achieve those numbers. Guardrisk on the one side, there's some other numbers in there. I'm not going to deal with that in detail. You can have a look at it. 158,000 policies now. more or less that we have on the retail side, the Momentum retail side after the merger. So it's quite sizable. And we're starting to talk about scale and seeing the benefits of the scale coming through. Under Guardrisk 3, the three main business units. It's the cell captive business, life and non-life. If we just add the life business here from an earnings point of view. Then we have the general or the GGI business. We'll hear a little bit more about that today. And then the microinsurance, that is really the heart of the press one, where we received the license. The first cell captive microinsurance license for composite, writing short-term as well as life business into one license. If you know the microinsurance world, it is materially more capital efficient for our clients and our customers than what the normal licenses are. And on the Momentum side, I said Bronwyn will share with us some more detail on the MSTI and the old previous AFI business. So the key aspects about the two businesses, if you look at it, first of all, what is different between the two businesses? What's the same? And then just maybe something on synergies. So the first one is how do we differ? In terms of distribution and market segments, play in very different market segments. The Momentum retail business predominantly in the retail space, as well as the smaller commercial market, where Guardrisk plays obviously in the cell captive space. Also in our first-party cell captive business, predominantly through the broker market, but a very different profile of broker environment. Really the corporate broker market as well as the mid-tier market. Also for our general insurance business. Product ranges, I think personal lines and small commercial versus a lot of specialist lines, which is a key growth strategy of the Guardrisk business. Governance structures, very different, two separate licenses. Okay, so we have different boards, risk and committee, board, audit and risk committees, management teams, executive teams and so forth, reporting up into the group structures, but very separate reporting into the regulators. Line of business systems also different. As you can appreciate, small commercial and retail business versus predominantly the B2B type of business in Guardrisk. And then the strategic drivers. You'll see through the presentation, the difference between the two. So what's the same then? I think both businesses are quite dynamic and it's innovative in terms of the solutions that we put to the market. It's a tough market out there. I think so much more for Bront and his area to compete out there. So we have to differentiate materially and we really have to be different and make sure that the customers understand what is it that we provide that's different. Organic, inorganic growth strategies. I think for the time being, we've had our share in the inorganic growth in the MSTI business and so forth. But as you heard Risto was saying, the bolt-on transactions, it's quite a successful strategy in the Guardrisk environment. I'll talk about that a little bit later. So there's one or two still on the horizon, and I personally expect that we'll see more consolidation in that non-life insurance market, especially in the UMA space, where from a regulatory point of view and a capital point of view, it's just becoming too cumbersome, for small businesses, I think, to survive. Stretch growth objectives, I think the presentation by the other two gentlemen tells the story. Very limited synergies, if we move over to that. Obviously, there's some knowledge sharing where we can participate in the same industry forums and platforms and so forth. We do that and we support one another in that regard. Procurement is an area where I think we can still do a bit more, not only from a transformation point of view, but from a cost efficiency point of view. And then leadership, Bront being responsible for the MSTI and that side of the business, and Lawrence also having financial ultimate responsibilities for the cluster with me together with the Guardrisk business. Okay, so hopefully this puts it in perspective. It is actually two different businesses. We operate just in the same industry. Right, so let's dive right into the Guardrisk reinvent and growth story.
Guardrisk is South Africa's leading B2B life and non-life specialist insurance provider and pioneer of the cell captive model, which allows clients to share in the financial rewards of prudent risk and insurance management. In 2019, Guardrisk launched the next exciting building block in its growth story, Guardrisk General Insurance. Leveraging the group's existing client relationships, its respected reputation, and the financial strength of its parent group, Momentum Metropolitan, Guardrisk General Insurance extends the rigor of scientific underwriting generally found only in the large corporate market to the mid-market general insurance sector in a cost-effective manner with accelerated response times. This offering currently includes motor, engineering, marine, personal accident, corporate, commercial, medical gap cover, guarantees as well as broader liability. In April 2021, Guardrisk received SA's first micro-insurance cell-captive license, a composite license that allows life and non-life insurance products to be written out of the same license and cell. By significantly lowering the barrier to entry, micro-insurance cell captives will play an important role in transforming the insurance sector and providing innovative products in dedicated segments and markets. We built this business on a passion for innovation, and the Guardrisk story is far from finished. There is more to come as we continue to reinvent and grow the business. Guardrisk. Tailored risk solutions.
Sounds a bit like a new business pitch, but it is. We also use it for new business pitches. And I must admit, 2 of our clients have already asked us who did this video for us. So the key elements of the Guardrisk reinvent and growth story consist of 9 key elements. On the reinvent side, if we start there, the first one is digital transformation. You heard it's an absolute key theme. It's a golden thread right through the retail, the corporate, the B2B businesses in the group. From a Guardrisk point of view as well, we recently got an approval from our board to invest tens of millions into a modernization project where we actually look at our cell-captive management system and administration system, just to start giving our clients much more of a digital, online, real-time experience as opposed to sending out monthly statements and accounts and so forth. And that is progressing very well. Also for our clients, how can we assist our clients to also digitally transform their businesses as far as insurance is concerned, especially in the affinity space? Ruth, I'll chat about that a little bit more. Underwriting skills, key element of our reinvent strategy. As we're moving into the GGI business, more underwriting, more risk retention onto the balance sheet. We want to write for bottom line. We want to write for 9 to 11% underwriting margin. So the top line and market share is one of the areas that we will look at, but it's more important that, and we can achieve that because our approach is through specialist lines. If you underwrite specialist lines, you need the best in town. And that we do through our bolt-on transactions, and we've recently added the best team of liability underwriters in town, who's left one of the Cape Town-based short-term insurers, there's not many of them, and to join us to run our liability team. So underwriting skills, important as part of the reinvent strategy. Capital efficiencies, again, ROE coming onto the horizon, lots that we can do. Risto touched on additional capital modeling, perhaps going back to a regulator, and convince them to review the internal model, the standard model that we currently use. Again, capital and a big issue in our clients' environment as well, with cell capital, and to what extent do we assist them and provide them with capital at a more cost-efficient rate than what we currently do. And there's quite a few plans consisting of contractual changes and reinsurance also playing a big role in that regard. And then the value proposition behind cell captives. COVID has shown us that our clients need us much more than, if I may say, we need them, especially in the tough times. Insurance, to a large extent, is a secondary business component in the volume and affinity. They understand their core business very well in the retail space, but when it comes to insurance, where they do make a good margin out of it, they need someone to assist them with information, with analytics, etc., and that will be a key element of our additional value. On the growth side, increasing underwriting revenue. Lawrence will have some numbers that he will share with you. Because it's a broker business in GGI, it is something that we need to also make sure that we can enable our brokers through digital mechanisms and other relationship management initiatives that we have in the business. Bolt-on transactions, we've done 3 3.5. The one we've bought just small, and we have the opportunity to grow our share to 100%. That business is in Guardrisk. We've embedded all those businesses, specialist lines in Guardrisk, and I'm happy to say that up to now, all of them have given us a return IRR of way in excess of 30%. That businesses is on the Guardrisk balance sheets, in the Guardrisk, so, and we really have the opportunity to cherry pick. We will certainly be on the lookout for one or two more. InsurTech Root, that's our partnership with the InsurTech platform. We will roll the platform out to our retail and affinity clients. Currently have 6 clients, very large retailers on it, about R500 million of premium that flows through that, and already 1.5 million policyholders that get serviced on this specific platform. And we're very, very excited about the future of this initiative with the Root Group. Microinsurance, we think more and more short-term insurance are going to be sold on an embedded basis, especially your monoline insurance. I think it will be a while before motor comprehensive and household and the personal lines will get into the embedded. But cell phone technology, cell phone insurance, accidental insurance, we're seeing now these things being rolled out to passengers in Uber schemes, etc. Tap and go type of thing. Microinsurance license, ideally suited for that. Low capital requirements from a statutory point of view. And I think it will make sense for us to grow in this area. There's a lot of, I think, opportunities, especially in the SA market, if we've seen how some African countries are growing. Volume and affinity, and then ownership. Black ownership, very important for us. We can achieve that through the enabling nature and structure of the micro-insurance license. Black-owned businesses owning 100% of the cell and getting all the financial rewards, similar to owning an own insurance company. Right, so before we move over to Bront, why do we have a right to win? The differentiators in the Guardrisk environment, capital efficiencies. We can move from a 16% ROE ratio to 20%. The challenge is on. I think we really can do it. We have a few plans up our sleeve in that business. The bottom one, monetize data assets to provide analytics capabilities to our clients. Again, we've seen with the credit life as well as the retrenchment claims coming through all our CPI, credit, consumer protection insurance clients and so forth, the massive need that existed for them to understand the profile of the clients better from an insurance point of view, the pattern of claims, and etc. And we started to add additional value in that regard. On the growth side, only the one thing that I think I would like to highlight is growth diversification, especially on the revenue side. Lawrence will have a slide on that. I think when the Guardrisk business moved into the group, our underwriting profits were about 2 or 4% of total revenue. We're now aiming, I think this year it's at 22% of total revenue, of the business, and Lawrence will share with us some future targets that we have. Good, and I think what also bodes well for Guardrisk is its deep client relationships and broker relationships. I do think that it will bode very well for us in the growth of our GGI business. Okay. Right, I think that concludes just quickly on Reinvent and Grow, and Bront, over to you.
Thanks, Herman. So I think for us, it's important perhaps just to reflect on where we've come from to understand where we are going. And, both businesses, the MSDI business, but also the Momentum Insurance business, had completed its reset. But both businesses also were left with some challenges to address. On the MSDI side, Hilly used the truck and the load analogy earlier this morning. I think it's very applicable to the MSDI business. We had a solid big truck, but simply just not enough load on that business, and growth was to achieve the level of growth that we need to get scale organically was proving to be quite challenging. On the Forbes side, it was a absolutely solid business, a profitable business, a sizable business, a business that I think was a little bit under the radar in the industry. But if we look at the transaction and the process, the amount of interest was quite significant. But that business in its previous shareholder was a little bit of an underinvested business. So from a systems perspective and specifically a digitalization point of view, left behind a little bit. So when we were, successful in putting, the transaction together, and we were the successful bidder, it gave us a very unique opportunity to, in a way, reinvent both businesses to address some of those challenges, but more importantly, for us to set this business up for sustainable growth. So, I think if I can, quote my favorite superhero, Spider-Man, who said, with great power comes great responsibility. With great, investment comes great expectation. So, we have I think, quite a significant target to achieve. The main aim for us, and we really believe that, the key to our success is to combine the businesses into one integrated business. So what does that business look like? It's obviously, under the Momentum brand, but more importantly, with a very distinct value proposition with safety at its core. And I'll touch on that a little bit later. Second point is we are migrating the entire Momentum Insurance business onto the MSDI systems and platform. So we are optimizing from a system perspective. There will be one license. We are closing, other legal entities. So there's a lot of efficiency which lies just in that process. Third critical component is that we will now, for the first time, as a result of the combination, have a very complementary product set which allows us to play in markets which the individual businesses weren't, able to do in the past. So that's a big positive for us. And then the last point is, again, it provides us with a much more diversified sales and distribution capability, which in the competitive market which we find ourselves, is certainly, we think an asset. So this combined business is a sizable business now. It's comfortably in the top 10 from a premium point of view in the personal lines environment. It's a profitable business, and it is really very close to that point of achieving appropriate scale. I often get asked the question, so if you sort of think about a combined ratio, what does this combined business look like? So in very simple terms, it's a 90% combined ratio ambition that we have sort of in the medium term. I think potential-wise, we can do a little bit better in the longer term. So that's typically made up of about 10% of acquisition cost. In that, we count commission, advertising expenses, and distribution fees. We're already operating more or less at that level. So, that's sort of a tick for us already. Big driver for all of us in the underwriting business in short-term insurance is the claims ratio. So, in the 90% combined ratio, we aim for about a 60% claims ratio. Again, the business is already for the last year or so operating at that level, even if we sort of take the COVID impact out of the way. In the longer term, we think that we can operate in a band somewhere between 58 and 61, and my personal ambition is certainly that we can get slightly below that 60 mark. I think in terms of potential and investment in underwriting, that should be an achievable target. And then the key thing for us to address is that expense ratio. So currently we're slightly above that targeted range of somewhere between 22 and 18. For the purposes of the combined ratio, roughly aiming at 20. If we get the integration out of the way and start to unlock some of the efficiencies and the once-off integration costs, we'll drop down to within that range. But again, I think if we can get the growth engine really kicking, 18 is definitely on the cards in the longer term. But that's sort of what the combined ratio looks like from a product perspective, trying to move the business from about 15% of new business coming from commercial lines to in excess of 20, hopefully moving upwards towards 25. And from a channel point of view, already quite a diversified sort of channels between IFA, digital, and direct, our tied agency force, and then strategic partners. But in the next 2 or 3 years, given that we have invested north of 2 billion rand in buying a very, very capable tied distribution force, our objective is to really scale that up appropriately. We think it's an important strategic capability in our industry. So that's why you will see the growth rate in that channel exceeding some of the others. And that's certainly the focus for the immediate future. How will we get there? I think sort of thematically it's about sustainable profitability through scale and value beyond traditional insurance. Personal lines insurance to a large extent is a bit of a commodity, so you must differentiate yourself in what that offering is around the sort of the commoditized component. the sustainable profitability point is just, I think all of us know of horror stories where big mergers have gone wrong, where 1 + 1 remains 1. So we're at least aiming to achieve 2. Healy thinks we're unrealistic if we start speaking about 3, but 2 must be on the cards, in the business, absolutely. Otherwise, my Spider-Man words will not ring true over time. So from a reinvent perspective, really sort of 4 key things that we want to do, and I'll unpack these in a little bit more detail, in the next few minutes. But, we are stronger together. We must deliver this integrated business, and the sooner we can do so, the better. Obviously, a merger focuses, the business internally. We're heads in the scrum, and we are in an extremely competitive environment with, world-class competitors. So the sooner we can get to that point of integration, that can be the springboard for us to really grow the business. The second is we must get on the shopping list of clients and brokers. So the importance of a strong brand, the importance of a differentiated, distinctive value proposition is absolutely critical. And we're excited by the work that the group, and particularly the Momentum brand, is doing, of late to really build that brand. And we obviously, intend to expand on that. But we've spent a lot of time to define what we think is a distinctive position in a very cluttered and competitive market where some of our competitors have much deeper pockets than us. Then, in keeping with, I think the philosophy that you've heard of product and service leadership, we must build our business in the future to have a much stronger outside-in mindset and choose which segments to be competitive in. And again, the integration allows us the opportunity to do so. And then lastly, again, a theme that you would have heard through all of the presentations is one of digital transformation. In our case, it's probably a little bit more evolutionary than revolutionary, and it's really driven by the initial focus on integrating the 2 businesses as opposed to, trying to sort of leapfrog the competition. We first need to get all our clients and all our capabilities on par, and then we can move from there. From a growth point of view, the targets have been shared a little bit, and Lawrence will unpack it in a bit more detail. But we want to add roughly about R1 billion in premium over the next 3 years and see whether we can, on an annualized basis, take the F20 earnings and double that, by the end of F2024. And, again, those are stretch targets, but we do think, given, the efficiencies that we are driving, that it is achievable. So if I then look at, each one of these strategic objectives separately, from an integration point of view, I think the key message is, we're on track in terms of the timelines that we've set ourselves. First big milestone is coming up now in July, and that's really for us to launch the first version of this integrated business for new business. And then for us during the course of F2022 to migrate the existing Forbes policy book onto MSDI systems and platforms. So that's it's a big job, it's a complex job. There's obviously some client risk involved in that, once you start moving, policies. But to date, we're comfortable that we've managed that well. From a business case point of view, tracking well against, what we initially promised shareholders in terms of what we will achieve. So we must just maintain, excuse the pun, that momentum. We've been able to retain all of the key staff, specifically the sales staff, and given the strategic weight we attach to that distribution force, we are comfortable that all the key managers have been locked in. They're excited to be in the Momentum environment, and they enjoy being in an environment where short-term insurance is really, an area of strategic focus. Lapses have been better than what we expected. I think all of us expected some form of client fallout as a result of the transaction. Clients have reacted well to the change to the Momentum brand, and our lapses have actually been better than what the historical numbers have been, despite COVID. So I think it points to very resilient and a loyal client base, specifically in the MI environment. And then all the key strategic business partnerships have been retained, barring one. That was a small-ish corporate broker that we had, and we were able to retain half of those clients in any event. And post that sort of event, a lot of them have started to come back to the Momentum environment in any event. So happy that the key relationships are in place. So I think all in all, the integration, despite it being challenging doing this during a COVID period, on track. From a safety perspective, this is the key thing that we try and get right to really position the business separate from the competition. And safety is not a unique concept in our industry, but we do think that there is an opportunity to present a holistic safety value proposition to clients, and not, many of our competitors touch on a portion of it, but nobody's really put down a coherent view on it. So we hope that, that is what we will achieve over time. The first step in this process, just to expose all clients, so the Momentum Insurance clients, to the same, safety-related value proposition that the current MSDI clients have had. And we've been able to, to start that process. Our safety value proposition, in very simple terms, consists of personal safety, safety on the road, and then safety at home. And, we build different value propositions in those components. From a personal safety perspective, we've recently launched the second version of our mobile panic button safety alert, and we've launched it to the, the MI clients. And we've been able to double our number of registered users. It's now up to, after 2 months, up to about 10% of our book, which is a really big step. The penetration and uptake is even better than what it was in the MSDI business. Then we've got I think a properly functioning telematics offering. We've got about 70,000 clients registered using the telematics offering between ourselves and Multiply, through whom we facilitated. We've gathered about nearly 1 billion kilometers worth of driving data. So it's really becoming a valuable asset. And given where motor insurance will go in the future, I think we're learning valuable lessons, and it's setting us up, I think, well to meet future challenges and opportunities. Safety score helps our clients to define and understand their level of safety, and then we reward them through the safety bonus, where you can get up to 30% of your premiums back. And we've paid multiple millions of rands to our clients. So uptake is great. Exposing it to all our clients is the next step, and we can see the value. When we compare clients who are engaging in safety and those who not, those who do just display much more profitable behavior. So claims frequency is about 10% better, and persistency, depending on what component of safety they engage in, up to 50% better than what a non-engaged client is. But on average, somewhere between 30 and 40%. So it makes a material difference in a short-term business if you can just get that persistency going. From a market-led philosophy perspective, again, as I said earlier, it is about creating a business where we can, in the segments that we choose, have a product and a service leadership position. And in the past, I would be the first to acknowledge that the MSDI value proposition was a reasonably generic one, without necessarily a very clearly identified target market where we stood out. And this transaction, again, through integrating the businesses, allows us to do that. In, for example, the high net worth and affluent market, the Momentum Insurance business has the Envoy product, which was really for a long time the gold standard in that high net worth affluent market. So we've looked at it, we've looked at what some of our competitors have done, we've improved on some of it, and we do think that that is something which allows us to to speak to Momentum's traditional distribution channels a lot better over the years. From our colleagues, we've had requests often to do that, so excited about that. We've got good value propositions aimed at the retired market, to speak to those needs of clients, and we can name quite a few. So exciting to have a much more focused value proposition than just a sort of a basic generic one. From a digital transformation point of view, earlier I made the point that it's evolutionary rather than revolutionary. So sort of, again, from a sort of a theme perspective, first process is just to enable integration from a digital point of view. Get all clients to the same level. Then secondly, for us to really own safety through digital, and a lot of our safety components are digitally enabled, so that would be the second area of focus. Then to drive efficiency, to get us to achieve scale. And there's a lot of automation that we can still bring into the process. And then lastly, to make sure that we drive growth. And in doing so, we're comfortable that we've got already a competitive value proposition from a digital perspective. So we do thousands of online quotes, we generate many thousands of leads digitally. We've got a good telematics offering, we've got good safety value proposition, chatbot, straight through processing in some of our claim types, which some of our competitors don't have. So efficiency, I think, will be the result. How will we grow the business? really 4 areas of focus. The first is, as I said earlier, we've invested a lot in building and buying a business which has a proper tied agency force. So our first objective is to really just restore this tied agency force to its former glory and then hopefully improve on that. So in its heyday, it was about a 200-odd strong tied agency force. When we bought the business, it dropped down to 90. We're now at about 135. And then the next sort of 3 years or so, we want to add another 100 heads to that. So it's a headcount thing and just improving footprint. Second key focus is to increase productivity. Currently, that tied agency force operates somewhere between 8.5 and 9 policies per advisor, per month. We think that we can take that to about 12, and if we're lucky, perhaps even a little bit above that. And that's purely a function of more automation and more digital exposure and enabling of the advisor. And then again, it's in keeping with what I think you'll hear from both Jeanette and Johan later in terms of how we think about, advisor enablement in general. The last point is just making sure that we drive higher average premiums, and it's focusing that channel on the high net worth market, where there is an appetite for higher premium. Then from a direct and digital perspective, it's having a better story and spending more money telling that story. That's really in essence what it is, and the spending more money bit is about a 75% increase in our direct marketing spend, if I have to compare MSDI to the combined business in future. So there's obviously a bit more premium to spread it over, but we do think we've got a good story to tell, and we're excited to tell it more often to more people. From a commercial point of view, 3 things we want to address. So it's really making sure that we improve our ease of doing business, focusing our distribution. We've already combined the distribution teams, and over time, probably F2023, enhancing the products. And then lastly, in the IFA and partnership environment, it's again a footprint thing, combining distribution, and specifically for our strategic partners, because we are utilizing the MSDI systems, just creating a much more automated and digitally enabled experience. So Herman, I think that's it from my side in terms of growth. So Lawrence, maybe over to you from a finance point of view.
Thank you, Brian. If I take the time, it's clear that you and Herman are putting me under pressure, but not something that I'm not used to when it gets to the numbers. I think if we look at the future, no future is complete without looking at the financial results and the targets that we want to achieve. So the Guardrisk story, the focus on underwriting, building on a fairly solid and stable base of cell captive management fees, allow us to grow the business to one where we will have normalized headline earnings just in excess of 500 million by 2024. It does give us double-digit growth over the next 3 years. And I think since we started with the message that we're going to take underwriting risk, we've been asked the question, where are you going with the underwriting? And I think the message is still the same as what we've had 2 years ago when we started with this. It is we're going to take underwriting risk, we're going to selectively pick where we take the underwriting risk and where we share risk with our clients. And we've put a target down that we want to achieve around 30% of our revenue to be coming from the underwriting profit. It's not an excessive target. It is a target that's possible for the business, and it's really one that is supported by the objectives and the strategies that we have. If we look at the Guardrisk General Insurance story over the last couple of years, it started off with a business where we had the expertise in the relevant areas, but we were heavily reinsured and we didn't take underwriting risk. So you can see in 2016, there was some decent gross written premiums, but you can see the net written premiums was similar to that. And it just shows you that, with the heavy reinsurance, it allowed us an opportunity to take some more risk. Through the first couple of years, we realigned our reinsurance strategies, and it took us to a point in 2019 where we launched our GGI business. And from there, we had a number of the bolt-on transactions, as mentioned by Herman, and it's really taking us to a position where we will be close to 4 billion rand in premium by 2024. The profits that we will be generating from underwriting, as I said, the 30% of revenue, that will comprise around 470 million rand by 2024. Again, as I said, we will take underwriting risk only in those areas where we feel we are confident and that we have the expertise. And you can see from the proportion of profits and business that we're writing that the areas are not changing significantly over the next 4 years. It is still the areas where we are achieving and where we have the expertise and where we have acquired the expertise. The one that Herman talked about, liability, you can see the liability team coming in, a very modest target to be 2% of the underwriting book in the next couple of years. If we look at our retail business, the more traditional insurance business, when we get our sales strategies and objectives to really fire on all cylinders, we will then get to a position where we can write around gross written premium of around 3.7 billion in 2024. It is allowing us to grow slightly more than the market, but very much, if you listen to Brand, the strategy is right and it is something that can be achieved. If you couple that with the synergy objectives and the efficiencies that we want to achieve in the system, it will take us to a headline earnings of closer to 350 million. And then when we look at the consolidated picture, this is really where you see the value of the non-life cluster coming through. And then I don't know whether it's fortunately for Risto or fortunately for us, but the bottom-up targets correspond with his consolidated target that is put on the business. And I think as Hilly said, there's always positives and negatives when you talk about a three-year target, but it is putting a peg in the ground and it is showing intent. And we believe that the strategies that Herman and Brand presented to you will take us to the longer-term targets that we want to achieve. Herman will share with us some of the challenges and the positives that we can experience and expect over the next 3 years.
Thank you, Lawrence. I can move on to the next slide. So obviously, where you have a tight, stretched growth strategy, there are always some risks involved in it. I think we've heard about that from Hilly and Risto. We don't know what we don't know from a COVID impact point of view, from an economy and a recovery of the economy point of view as well. But again, between the Guardrisk and the MSTI business, I think there's a fair level of diversification, and they are not all correlated to the same extent with economic growth or bad times in the economy. And I think that gives us a little bit resilience and maybe even, a little bit of a lag so that we can catch up in other areas. Lawrence has mentioned that under the low road scenarios. I'm not going to repeat that. The one at the bottom left hand, maybe I could just touch on that, hardening reinsurance markets. We certainly expect that to happen. The noises that came out of the non-life reinsurance market locally as well as internationally up to around about December, January were quite negative, especially where they had to stand in for businesses who had business interruption claims, as you all know that we had it in the Guardrisk environment. So we've really expected some tough reinsurance negotiations as far as rates are concerned, capacity is concerned, and also deductibles, where they will require us maybe to keep higher deductibles, per risk or then in the aggregate. We are planning for a 1 July renewal, so we're in the middle of those discussions, and I'm pleased to report that these terms are not as punitive. The initial terms that we've seen being put on the table is not as punitive as what we've initially expected, and I think we're going to see higher levels of retention being required by the reinsurers, but we're hopeful that we will be able to achieve all those renewals. I think the markets are there. We're not going to have any shortfall in capacity, even in the specialist lines and so forth. And we're quite confident that it will not have a material negative impact on the income statement. Then I think last slide from my side and from the team to conclude. Yeah, the non-life insurance, as you can see, is a growth area in the business, and hopefully we will not disappoint. We are quite confident and that we will be able to achieve these targets in the if I may say, the range that has been supported by the rest of the business through organic growth, key component in the gold rush business. We focused on the bolt-on transactions, but organic growth is probably up to 60% of our annual growth in the gold rush business through our cell capture structures, and then the GDI businesses Lawrence has indicated to us. Inorganic, we probably called it the day for a while now on the MSTI side, but 1 or 2 bolt-on transactions to really capitalize on the further consolidation that we see in the market, especially on specialist lines and some of the more higher-end commercial corporate level. I think the business is well positioned to achieve these growth targets, and we will continue to improve on the diversification and the total of the short-term insurance cluster. That is all from my side, and thank you for attending. Thanks, guys. Appreciate it.
Thank you very much, Herman, Brandt, and Lawrence. It now gives me great pleasure to introduce Dumo Mbete, the CEO of Momentum Corporate. Dumo has over 16 years' experience in the financial services industry. Starting in 2017, he was first the COO and then the CEO of Momentum Metropolitan Africa, and he is credited for initiating the turnaround within the Africa business unit. So he is a real rock star in business, and in life he actually does play a formidable rock guitar. But before I allow Dumo to come to the stage, let's have a look at Momentum Corporate.
Hello and welcome. I'm coming to you today from the Mark, the headquarters of Momentum Metropolitan Holdings, where I'm about to sit down and engage in conversation with the CEO of Momentum Corporate, Dumo Mbete. Now, we'll be reflecting on the group's overall strategy that's been implemented over the last 3 years, focused on reset and grow, how that's been impacted by the pandemic, and most importantly, what some of the key learnings are that the group will implement in its new strategy of reinvent and grow. Join me, Gugulethu Mfuphi, as I'm about to sit down in conversation with Dumo Mbete.
Momentum Corporate, the employee benefits business within Momentum Metropolitan, delivers solutions for employers and retirement funds. Our solutions, spanning 5 business areas, include group insurance, the Funds at Work umbrella retirement funds, structured investments and annuities, advice and administration services, and member solutions. Let's explore each business area in more detail. Our group insurance business received almost 5 billion rand in annualized premium income for the 2020 financial year, 6% higher than the previous year. We paid 1.2 billion of income disability benefits, 350 million in lump sum disability benefits, and 2.6 billion in death benefits. We are the market leader in the group insurance market with 23% market share. Our Funds at Work umbrella funds has 59 billion in assets under management. Research shows that the key Funds at Work market differentials include high levels of flexibility and the extent of digital engagement. Between July and December 2020, half the Funds at Work members engaged digitally, giving the experience an average rating of 4.4 out of 5. We have grown into one of the big 5 players in this market with 15% market share. 2020 highlighted how our smooth bonus portfolios and annuities business protects members' benefits from market volatility. A key player in this market with assets under management of around 33 billion rand, we have the scale to grow significantly. To unlock synergy and sustainable client value, our advice and standalone retirement fund administration capabilities recently merged leadership structures. Adding technical consulting skills to our administration business creates a stronger value proposition for current and future clients. Our Member Solutions unit helps members to make better informed financial decisions on their journey to success. Between July and December 2020, we had facilitated personal product purchases and investments to the value of 82 million rand across 58 work sites. 143 million rand in retirement savings was preserved with Momentum Corporate. Multiply for Corporates is a rewards program for employers. Since the launch of the program, over 1,000 employers have accumulated 6.9 million rand in rewards, which can be reinvested in various employee wellness and business continuity initiatives. Momentum Corporate is headed by CEO Dumo Mbete in partnership with a strong leadership team and over 1,000 dedicated employees. Momentum Corporate is a key and consistent contributor to Momentum Metropolitan earnings. Despite the COVID-19 bump, we remain strong, financially resilient and well capitalized. We believe the right advice and partnerships can make any business unstoppable. Momentum Corporate, here for clients on their journey to success. Momentum Corporate is a part of Momentum Metropolitan Life Limited, an authorized financial services and registered credit provider.
Well, as promised, we're now in conversation with the CEO of Momentum Corporate, Dumo Mbete, to give us more clarity in terms of the journey that we've embarked on in the last 3 years and more details as to where we headed as we head towards 2024. Now, we do want you to acknowledge that all COVID protocols have been observed in this conversation today. Necessary distancing and our masks were removed just before we started this morning's conversation. And speaking of conversations, Dumo, perhaps now is the time for us to get into those numbers and really seek some clarity in terms of the direction and the response of Momentum Corporate, specifically given the tumultuous times that we live in and the pandemic that we've currently experienced. As we saw the video earlier on, we certainly managed to get some clarity in terms of the role and the importance that Momentum Corporate plays under the Momentum Metropolitan Holdings umbrella. But let's talk COVID. It's the reality of the times that we live in, and it's really had an impact on everybody's life, but it's also had an impact on Momentum Corporate from a financial point of view, as well as the response of the business to many of its stakeholders. Let's talk the numbers first.
Yeah, thank you, Gugu. I mean, 2020 was really a challenging year in many ways. And I mean, considering the contribution that we make to the group, it was quite a significant impact. So we did see a drop in our earnings in that financial year, and largely impacted by the fact that we needed to strengthen our guarantee reserves as a result of market movements. And then also, you know, the COVID-19 related reserves that we set up in anticipation for higher levels of mortality in our book. And I think at that point in time, it was really our best view of the world and what we thought was likely to transpire. But of course, as we have seen in our half-year results, that impact has been a lot worse than what anyone would have predicted. So the extent of the second wave then meant that we needed to set up additional reserves at the half-year, which then had the impact of us being in a loss position actually for the first time ever in all likelihood for the half-year to December 2020. Now, those are the numbers, but really what's far more important is the role that as Momentum Corporate we play in South African society. You know, as one of the larger employee benefit providers, we really see what we have been able to do during this time in terms of being able to keep the promise that we make to our clients, that when that tragic day does come, we will be there for your families. You know, we will be there for the beneficiaries of these policies. And that's what we've been able to do. We've seen in excess of 1 billion in excess claims until the month of February 2021. But that 1 billion is an extra 1 billion in the hands of individuals in this country that will ensure that lives are able to be sustained beyond the loss of a breadwinner. So there's a child today who can still go to school, go to university because of these benefits that we have paid out. There's a house that will not be repossessed because of these benefits that we have paid out. And that's really what matters a lot more to me and to our broader organization.
That is a very critical role of employee benefits and how it really does add to the benefits and construct of society. And not only has Momentum Corporate kept to this mandate, but you've also tried to show up in a different way as well for your own people internally to ensure that they also have the necessary support. Give us more insight into that.
Yes, well, that was quite interesting because when the initial announcement was made, we really had to get our act together quite quickly in terms of ensuring that our colleagues are able to work from home, but do so effectively and in a way where our end clients do not see, any drop in service, especially because we are an essential service. When that benefit needs to be paid, it needs to be paid, and we need to be there at that crucial moment. But it has been quite testing, from a morale perspective, being able to continuously engage, communicate with our employees, and also just to try and, give them the tools to have the necessary resilience, especially during the second wave where we saw significant loss across the country. So being able to support our employees through that was quite important. And for our clients, we put in place quite a number of initiatives to really support our clients through this time. The biggest of those were the relief measures, where we provided relief in terms of retirement contribution payments. And most clients took this up. I think about 25% of our book at the highest point had taken up the relief option. And we did, though, emphasize the importance of the need for employers to continue making payments in relation to the group insurance cover, which is really what kicks into effect now when we start to see the loss we have seen in terms of lives lost during this period. And I must say, employers have heeded that call. At the highest point, again, about 5% of employers were not contributing group insurance cover, which really highlights the fact that, employers did understand and really made sure that their employees were taken care of during this time as well. We've also been able to open and widen the scope for our Multiply for Corporates proposition, where through that program, we've been able to get clients to use the rewards that they earn for COVID-19 related business continuity measures. And from a wellness perspective, I think that is really, something that has been quite significant.
Dumo, we focused a lot about business conditions and operations under the current pandemic of COVID-19, but perhaps let's backtrack to actually understand where the earning potential of the business has previously been from, and understanding the market positioning and what has actually changed under these particular segments. Fundamentally focusing primarily on umbrella funds, specifically funds at work, and of course understanding the group insurance business of Momentum Corporate. Take us back to give us some insight as to how these business segments have performed previously before the pandemic.
Yeah, so Gugu, I'll start with funds at work. And funds at work itself was a first of its kind when we launched it in the year 2000. First of its kind in South Africa. And in the last 7 years, we've actually seen some good growth in that particular business. It is our largest profit contributor for Momentum Corporate. And in the last 7 years, we have seen a CAGR of about 12% year-on-year growth. If one translates that into assets under management numbers, from 30 billion to 60 billion. So literally doubling the size of this particular business in the last 7 years. And that has been quite significant. And through that, we've also been able to retain top 3-4 market share, from a competitive perspective.
That's quite substantial and a feather to put in your cap.
Yes, it is. But look, we can certainly do better. We do believe there's far more potential in this particular business, hence why we have identified it as quite a stronghold that we want to build on, even going into the next 3 years. So even from a margin perspective, we've seen pressure on margins due to increased competition. And generally, I think cost is a very big factor for clients in this space, and we have been able to respond to that in an effective way, but whilst also ensuring that we are able to manage expenses and also, just partner with clients more effectively
from an understanding of value proposition perspective to ensure that we are able to improve profitability over a period of time.
If we go back to the opening video, there was reference made to digital content and a digital engagement strategy. Tell us a little bit more about that.
Yes, Google, over a period of time, we have had a big focus on, just self-service from a client perspective, member, as well as an advisor perspective. Now, in the earlier part of the journey for Funds at Work, the focus was really around, building solutions where members would be able to self-service. So being able to view their benefit statements, update beneficiary details, which is quite important, so that the benefits do get to who they are intended for. And then we also looked at elements like, switches, transactional stuff, switches, withdrawals, and making that as easy and seamless as possible for members. We also invested in capabilities that enabled advisors to better engage with members and with employers around the solutions. And I think to a large extent, that also speaks to the level of support we have seen from advisors, in terms of our solution over the years. The journey has then evolved. Around 2005, we then launched what we call the employer portal. And this was now really looking at enabling employers to better service the solution on their own. The ability to upload payments, automating the reconciliations, such that member funds are invested a lot earlier than what we would have seen historically, meaning more time in the market for members' contributions. Then more recently, we have also then now started looking at member journeys a lot more specifically to say, how do we ensure that our solutions now start speaking to various stages in the life cycle of a member within a fund? That's where we have now, we've rolled out the likes of your Smart Exits solution, which is an award-winning solution. Our Smart Underwriting, we are now looking at Smart Onboarding as well. So really looking at all of these touch points through the life cycle of a member. What we are also looking to invest a lot more in is real-time information. And one of the, I think probably the first of its kind, real-time benefit statement, digitally accessible, which we rolled out to clients towards the end of 2020. Now, this has had, raving reviews. I think of the clients who have used the solution, which is actually 50% of our Funds at Work member base, all of those have given this particular solution a 4.4 out of 5 rating from a client satisfaction perspective. So this is what we're looking to do a lot more of. Broader on the technology front is also just around automating our high volume transactions. So there's a number of initiatives we have in the business, just looking at how we can ensure that we are a lot more efficient, and I'll speak to some of those a bit later.
Speaking of this partnership, it does seem as though Momentum Corporate is going the extra mile, not only to interact with its intermediaries, but also ensure that end clients also see that full benefit. And it almost seems as though Momentum then has this clear benefit of accessing data, changing the behaviors then of South African citizens in terms of how they approach that retirement journey. I understand Momentum Investments has also shared some insight into some of the losses, the behavior, but also some insight that can be shared in terms of how it is that financial advisors are able to support South Africans even further on the back of the data and the digital technologies you implement.
Yes. Look, I must say, the way I normally, at least the analogy I normally use when it comes to financial advice is that even the best players in the world, you can take a Serena Williams, you can take a Roger Federer, a Tiger Woods, etc. They all have coaches. So even I, as someone who has been in financial services, have a financial advisor. We all need a coach to walk us through this journey, especially also to make sure we don't make the wrong decisions. Now, last year, what we saw was, people were watching their balances on a daily basis. Access to information is a good thing, but sometimes it does also then trigger some of our more negative behaviors, especially when it comes to fear. When the markets dropped 30% last year, people started switching their investments. And I think the research from Momentum Investments does show about 100 million in value that was lost by clients who made that call at the time. So giving clients access to the data, the information, has to come with access to financial advice as well. And that's what we do, via the retirement benefit counseling offering, which is provided within the umbrella fund, and also how we then partner with financial advisors together with employers in guiding employees, through this journey.
Well, let's shift gears to another business segment of Momentum Corporate, which has been a key driver for growth, as well as the largest market share in the group is group insurance, rather.
Yes.
Maybe give us some details as to how that's also changed, especially on the back of its positioning, market perceptions, and of course the environment that we've experienced in the last year.
What a business. According to the Swiss Re survey 2019, we are the leading provider of group insurance in South Africa. 23% market share in terms of gross written premiums. Now that says a lot, and it does then come with a certain level of responsibility, not only for policyholders, but also to shareholders, as we, select risk, price risk, and then of course delivering on the promise to our clients. And in that business, I must say over the years, we've seen very good growth, stable in terms of market share, but continuous growth. But more importantly for us, beyond market share is the ability for us to ensure that we are providing these solutions on a sustainably profitable basis. We've seen a lot of volatility in margin in this particular business in the past. I think the lowest point was in 2016, and we've really gone through a process, through our engagements with employers and with advisors to say, look, how do we ensure that we price effectively for the risk itself, and at the same time we do this in a way that doesn't spring surprises to our end clients. And we went through a cycle of strengthening, our pricing and just making sure that we're able to price effectively for the risk that we are taking on board. And I must say, even through that journey, we have seen excellent client retention levels. Because one, I think the first fear would have been that clients will walk away. But I think clients do see the value. And we have been on a journey of success together in partnership. And that really then speaks to our ability to retain clients through this cycle. And as you see in the graphs that are being put up right now, the margins have actually strengthened since 2016. So, and this has not been, by accident. I mean, really, disciplined execution of strategy by our people in the business.
What sets your group insurance business apart?
Well, Gugu, a big highlight for me within our group insurance business has been our disability insurance space. Now, here, there have been a number of things that we have done in the last few years, and really with a very big focus around strategic execution. Now, here, if I look at a number of areas, our disability management, where I really believe we have one of the best teams running that particular area. And we've really had a big focus on, how we assess disability claims, how we then rehabilitate disability claimants, and then also looking at how we reskill disability claimants such that they are able to return to work or potentially go into other forms of occupation. Now, this becomes very important because I don't really like to look at this purely as we are here as an insurer and we're here to pay an amount. It's really about a wellness journey that we go on, with our disability claimants in partnership with the employers. So that has really been a big positive. And in terms of the numbers themselves, it has really shown itself, in what we have seen. Right. In the 2020 financial year, we started to see an improvement in profitability levels for our disability insurance space. Historically, we had an underwriting loss of 200 million.
Sure.
So as recent probably as 2016, we were sitting with 200 million underwriting loss in that business. I'm happy to say that as at the half year this year, we have a small profit in that business. And you can imagine what that means from a shareholder perspective as well, that we have been able to take a business that was generally a loss-making business and turned it into something that is break even, maybe slightly profitable, but more importantly, meeting the needs of our clients on a far more sustainable basis.
someone else who might want promises are some of our shareholders and investors who might be engaging in conversation and reviewing some of the elements and the growth that Momentum Corporate does possess. But the big question in terms of the returns that they want to see might be based on numbers and profitability. But we know that that is also as an influence of the environment that we operate in, as witnessed in the last few years. The previous strategy over the last 3 years did focus on, again, reinvention as well as growth, if I'm not mistaken. But I do understand that there's some learnings that we take from our previous strategy in terms of how we implement that going forward. So give us some insight in terms of the projections we have for future profits, the projections we have to be a market leader within the South African environment, and how it is that Momentum Corporate will stick to that commitment.
Yeah. So, I mean, we are a business that holds a significant position within employee benefits in South Africa. We do see ourselves as a corporate citizen and with again, a very important role to play in terms of, just even the impact on our social security, landscape in the country. There are two realities that we foresee, in the current environment and going forward. The first one is just around increased mortality. So even when the first wave subsided, we still saw mortality levels at about 20% higher than what we are used to normally seeing. So at least for now, as a result of COVID-19, and probably into the future, as a result of secondary impacts of COVID-19, where people have not been going to the hospital, they've not been getting their checkups. At some point we saw even things like, scans for cancer and the like, those numbers had dropped by 80%.
Sure.
Year on year. People were not seeking medical attention. So this is bound to have a knock-on impact into the future. And then, of course, we have long COVID as well. So, I mean, it's not yet fully understood what the full extent of the impact of COVID-19 will be on mortality. The second one is the impact on SA Inc. I always say to my colleagues that, we are pretty much in the front row seats in terms of anything that happens to SA Inc. And we saw it last year. When level 5 hit, I did mention earlier the 25% of employers who then took the relief contribution option, right? Now, what does this mean practically? I mean, there are sectors that have been hit very hard. Hospitality, travel, tourism. We've seen it in the construction space as well, and probably even broader sectors. The actions those sectors have had to take in response, unfortunately, have a direct impact on our business as well. So reducing headcounts, so retrenchments, we have seen, about 7% impact on our book on a year-to-date basis. And we've seen the unemployment levels in South Africa, in the stats that are published, liquidations of companies also on the rise, salary cuts, salary freezes, and those have a direct impact, on our business. So one of the ways we are responding to this is through effective cost management. I think over the last 3 years, we've really been able to exercise disciplined cost management, ensuring that we are able to contain growth in expenses, to the levels of income that we are seeing or growth in that income. So that particular discipline is something that will put us in good stead for the future. But despite all of these things, we have also been able to register growth through the cycle. And the investment that we have made in technology, the investment that we have made in relationships, partnerships, and strengthening those do certainly position us quite well to be able to achieve what many will call a recovery, which I think COVID-19 has pushed out probably by another 2 years. So yes, a range of 400 to 500 million, but definitely on a far more sustainable basis. If you look at the underlying that I've taken you through in terms of what we have done specifically around funds at work and more so within our group insurance business, creating a bit more stability there around the earnings profile.
So meeting your clients at the point of need, reacting and responding to the current environment, and most importantly, playing to the competitive advantage that you continue to have in the market.
Yes, indeed. But the work never ends. I think we just have to be very, what's the word? I think it's being practical. I think it's also just being, humble enough to acknowledge that the past successes, are indeed in the past. And we need to continue to reinvent ourselves as we grow into the future.
The perfect name for the perfect strategy, given the times that we happen to be in. Dumo, such a pleasure engaging with you, and we're looking forward to hearing more insights regarding the growth strategy at Momentum Corporate, and appreciate the tone and the themes that you've set in terms of understanding the environment for today.
Thank you, Gugu. It's exciting times ahead.
Thank you so much, and we wish you all the best going forward.
Thank you very much.
Okay, so we take the conversation back into the room. And I tried to, from an editing and continuity perspective, I tried to maintain the same look. And I kept looking at the time on my watch just to make sure, it all looks seamless. It's all part of the show. Now, let's start looking at the future over the next few slides. Yeah, it's not moving yet. Okay, great. So there are essentially three key themes that we are looking to respond to as we go towards 2024. And in looking at these three themes, I also want to, just share some of our ambitions, and in far as these are concerned, but also looking at, the strategic choices we have made on the back of these key themes that we see. The first one of those is really around the need to have end-to-end digitalization of our solutions. So this is where we bring in the digital element together with the use of data and data analytics to really improve on our processes, drive more efficiencies, but at the same time, hopefully lead to some newer revenue streams within our ecosystem. So here it's very much a client and an advisor story as well. And here, the choice we have made is to say that we want to enhance our client and our advisor value proposition. A few things we want to do in this space, and this is just really sharing some high-level examples. I can't give it all away. But just to share some high-level examples, the first one is around smart onboarding. Now, typically, the onboarding process in our industry is a very manual one, and we really struggle to get members engaging with their employee benefits from day one on a digital/digitized basis. And this is what we're looking to do through smart onboarding. And together with that, we also have the educational tools and the tools that essentially enable members to better navigate their retirement journeys with us. The second one is smart underwriting. Interestingly enough, I have used this particular solution after joining Momentum Corporate. We have to eat our own cooking, and really a great process where we essentially have digitized the process end to end. I didn't touch a single piece of paper as part of this underwriting process, but also using, an omni-channel approach. So we digitize certain elements of it, but we bring the face-to-face world together with the digital world, but enhancing it through digital solutions. So yes, a mobile nurse came and drew blood and did all of the tests, but all of this in my own time, convenience, and this is what we are rolling out to our broader client base to make underwriting beyond the free cover limit seamless. The next area is just around how we use self-service. Here, looking at our website and also our apps, more to enhance the ability for advisors to engage with our solutions. And here, it's giving advisors access to a wealth of data at their disposal, and data that they can manipulate, analyze, in order to really have those enhanced conversations with their clients. Quotes, self-service, here we're trying to go a bit more straight through from a processing perspective, making our solutions a lot more digitally accessible, digitally friendly. And in this industry, quotes are a big thing. We monitor quote volumes on a daily, weekly, monthly basis, looking at the conversions. So our ability to deliver seamlessly in this space starts to become quite a strong differentiator in the intermediated environment. Smart claims, again, here we're looking at more of our high volume transactions at those crucial moments for our clients. And here again, we want to make it as seamless as possible. In the longer run, we won't even be talking about smart exits. We'll talk about smart preservation, another behavioral type element that we're looking at there. But ultimately, we want to be able to make these processes as seamless as possible. In terms of outcomes, at least one of the impacts we're looking for is lowering the cost at which we provide the solutions that we deliver. We also want to enhance the overall member and advisor experience. And then in terms of our ambition, going to 2024, to grow digital engagements, historically at 50,000, you saw the 160,000 for our real-time benefit statement, but we want to expand this on a far more sustainable basis, and that takes us to the target of 250,000. And this is really around the umbrella fund by 2024 in terms of digital engagements. So whether it's your benefit statements, exits, use of our app, but far more regular, beyond what we used to see historically, where members only really engage with their benefits once a year when they get the statement in the mail. Oh, and of course, a net promoter score of 60. Currently, our net promoter score sits at around 50. So we're looking to build that up over the next few years. Second theme is around the umbrella fund. And here specifically, increased competition, pressure on clients' pockets, and the need to be able to deliver these solutions at a far more cost-effective level. So I'm sure you saw in the pack and on the slides, really pressure on margins in this space. So how do we remain competitive, but still delivering on shareholder value? So here we have made a choice to say, okay, we want to develop an accessible, simple, and flexible solution, but in a way that helps us to protect margin and also to deliver on sustainable growth. So a few things we're looking at here. So as you will all know, regulations are driving towards further consolidation with the move from standalone funds. Is the sound still fine? From standalone to umbrella, 130 billion in assets being the opportunity there, and we really want to get our fair share of that. And this is on the back of, what I took you through in the previous slide and some of the elements that we want to look at here. Simplifying our umbrella fund solution. As far as possible, what we can automate, we want to automate. We want to make sure that we are able to support this solution with digitized end-to-end processes. And really then, especially from a high volume transactions perspective, driving improved cost-to-income ratios. And then distribution. So, if I talk strongholds, intermediated distribution is a stronghold for Momentum Corporate within the industry, and we want to continue to build on that, hence the focus on the advisor when it comes to our digitalization efforts, but also starting to build out our direct-to-client capability as well, as was mentioned earlier by Healy. And we really want to see how we can use these two elements to, yes, capture the opportunity we see in the standalone to umbrella market, but also capture new opportunities that present themselves from a growth perspective. We don't believe South Africa is going to remain in, this kind of muted growth environment for the longest time. So, if the tide does lift, we want to see our ship rising slightly higher than the other ships in the ocean. Hence, we are saying we are targeting 80 billion in assets under management, which is growth from the 59 billion as at the end of 2020, which will translate to a market share of approximately 18% by 2024. So that's what we're looking at for the umbrella fund. Then in terms of our ability to use data and using data analytics, being a scale player does come with its advantages because we actually have, data and analytics that speak to quite a wide spectrum of the South African population. So if you're talking, disability claims, if you're talking mortality, here we are able to speak to a member base of well over 1 million individual members, which then enables us, and also for corporates across a number of sectors. So it enables us to share far more insightful information with intermediaries, but also with the corporates that we serve. So for example, we'll have a conversation with a client, we're able to give them a sense of what's happening within their industry in terms of employee value propositions, what are employees going through, what are the common causes of mortality, of morbidity, etc. So we're able to share those insights. Then we are able to zoom in and say, how do you compare to your competitors within that particular sector? And then we're able to zoom in further to say, within various departments in your organization, how does this picture look? And then this feeds into the whole, employee value proposition that each of our employers are driving. So we see our solutions as sitting, within that employee value proposition and wellness proposition employers are driving. So using analytics to unlock revenue, but also to unlock efficiencies. So some of the things that we would like to be able to do by using these insights, we want to improve turnaround times on disability claims. The more insights, the more information we have around members and the types of cases that we see, the quicker we're able to address these, but also to optimize our case management. And I think we've been very good at getting individuals to return to work, whether it's in the roles they previously played, but also crafting new opportunities for employment for disability claimants. Our ability to actively manage our group insurance book. And we're trying to get a bit more scientific here. And I think those of you who know, there's a dearth of data when it comes to the group insurance space. You might get an ID number, and that's as good as it gets. And you might know someone is male, they're female, but do we know if they smoke or not? Do we have any further insights? And there are a few tools we want to use there to enhance the level of information we have around members. We also want to use reinsurance in a smart way to look at how we provide at least a semblance of stability when it comes to the earnings profile of our group insurance business over a period of time. And then, of course, using trend analysis, as I've highlighted earlier, just in terms of some of the examples of what we can do in terms of enhancing these conversations we have with clients. People like to talk about group insurance as a commodity. We are looking at this in a far more nuanced way, where we really want to get deeper from an engagement perspective. And then, of course, some new opportunities we want to explore, the use of wearables to gather real-time health information. We've got Kimi, which does that through a wearable. We're able to get far more insights on the wellness of members. Something we're piloting currently in the underwriting space, but also in the disability management space. And we see further opportunities in terms of how we can leverage some of these insights, again, with an ultimate objective of improving the value we deliver to clients, but yes, more importantly, to shareholders as well. So what does this translate to as we look into the future? A net of tax group insurance risk margin of 5%. Now, just to give you an idea, I mentioned 2016 in the video. 2016, we dropped to negative 1.8% in terms of this particular margin. We saw a recovery up to 2019 to 2.8%, and this is through the management actions we've taken. And we really want to then, at least the ambition is to take this to 5% by 2024. So in summary, we are a business with scale and a significant contributor to the group, and I dare say, to the South African employee benefits landscape. Through our engagement-rich solutions, we want to be able to, deliver better outcomes for all of our stakeholders, and in this room, predominantly our shareholders. The digital journey here, really looking at how we enhance the experience, members, clients, and our advisors, and really driving efficiencies as we do that. And then, of course, using data and data analytics in far more scientifically, to take our industry to another level. And of course, it comes back to the bottom line. So if you include investment returns, we are targeting earnings of between 500 to 550 million by 2024, very much aligned to the reinvent and grow ambitions of the group. Thank you very much.
Thank you, Dumo. If you could stay on stage for us. It's time for our question answer session. So as you've heard there, business executive, rock star, and TV presenter. So we'll see what's next. Can I also have Herman and Brandt on the stage for our Q&A session? So same drill as last time. If there's questions from the room, we'll take that first. our tech team on standby. Okay, there's one question there in front. If we can get the microphone to the gentleman there. In the meantime, a question from our online attendees asking, are more of the Guardrisk cell captives using less reinsurance given the hardening of rates and risks slowly waning? And that's a question from Greg Wood. Herman, I think that one is for you.
Thank you, Greg. I think it's a bit early for us to confidently say that that would or is the case. Theory tells us, history tells us that that should be the case. We've seen some reports coming out of the international markets, especially some of the Cayman Islands, and I think Bermuda is the last one we saw, where we do see that large corporates are starting to take more risk in their own facilities. Are they self-captive of their own wholly owned captives because of the increased rates and capacity contraction that we see coming from the international markets? We still have to see it locally. As I said, in SA, 1 July is really a very big reinsurance renewal cycle, and I think then we will have a better idea. But hopefully it will happen, then it will be good for Guardrisk.
Cool. Thank you, Herman. The question in the room.
It's Warwick Bam from Avior Capital Markets, and thanks for the presentation. I'll start with a question on Guardrisk for you, Herman. Outside of underwriting risk retention, my sense is that the cell captive industry has been in structural growth for many years now. And maybe just give me a sense in terms of your targets of 11% per annum growth to 2024. How much of that is normal structural growth, the trend that you've seen, and how much is kind of inorganic, acquisitive and market share gains?
Yeah. I think, as I said in the presentation, at any given point in time, on average, our organic growth, just through our existing client base, and writing more business through existing distribution channels, is close to 60% per annum. So I don't think we're going to see material changes in that. We're certainly banking a bit more on our GGI business from an underwriting profit point of view, as Lawrence indicated, to increase total revenue from around about 22 to 30% by 2024. So certainly there we see as a single element of revenue growth as the biggest contributor to our growth. Our inorganic growth targets, I think, as Risto also alluded to, it's smallish. So we're looking at one with 500, 600 million annual premium, I think, at this point in time, but again, with a good margin. So we may be doing one every 2 years, in the region of a 500 million or a 600 million rand annualized premium. So, but hopefully that will give us at least a 2 or 3% kicker in the earnings line. But it is weighted towards organic.
Okay.
Thanks.
Follow-up question?
I think Risto is correct. We haven't modeled any of the bolt-on transactions into the future numbers that we have. So the one that Herman is talking about is a fairly smallish one that's coming in. Yeah. We're talking, maybe 400 million in premium, but we haven't put in any big bolt-on transactions in our forecasted numbers. So the numbers that you see there is really growth within the business, growing. I think our own product range that we have on underwriting, and then maybe just on the cell captives, on our cell captive business, I think Herman is right, about 60% is based on organic growth, our clients developing their own products, and we've seen a lot of that where clients are starting to talk to each other and start using the benefits of the different products between the different cell owners. So a lot of our growth on the cell captive side is coming from in-house, more products by clients itself.
Thank you. Warwick, do you have a follow-up question?
A question for Dumo, just on the corporate segment. The CAGR growth rate to 2024 was 0 to 5% in terms of the targets. I think in your slide pack, you seem to have much stronger growth in the funds at work AUM target from, and you can just repeat the numbers. I think it was about 59 billion now to around 80, was it? And then you're also, you're saying you're the leader in the group life sales. Does that still give, if you extrapolate that out, the recent trend, does that still give you 0 to 5% earnings growth? Thanks.
Yes, so I think here the key differentiator is the starting point. So if you look at the starting point for the numbers that were shown earlier, it takes out the COVID-19, the reserving impacts and also the excess mortality impacts. So it almost looks at a normalized view of what our earnings would be. So last year, I think we were at about 150 million. By the half year, we were at about 200 million loss for 2021. So that's essentially where we are projecting from to say, okay, what does a normalized view look like? And so hence the point that it's more of probably a recovery position that we are seeing up to 2024 from a growth perspective. And then again, it becomes a question of how quickly do we recover to what people would call normal? Hence the points just about the fact that, we've seen the member base itself drop by about 7%. So that has an immediate impact on our admin fees, the fees that we earn on assets, so that there are a few knock-on impacts there. And then also, how quickly do we get back to normal from an underwriting performance perspective? So the earlier question, how are we going to look at risk rates? What does client retention look like through the cycle? So we definitely see the 550 being quite a significant step forward from where we will likely be coming from at the end of this particular financial year.
Okay. You still have the mic, Warwick. Do you want to go for a third round? No. Okay. Can we please maybe get the mic to Risto and maybe Hilly if there's time, if I'm judging by the questions. But in the meantime, a question for Brand. Brand, in Hilly's presentation this morning, there was reference to the importance of culture as a strong enabler for the success of what we've seen with Reset and Grow. Now, with the Alexander Forbes acquisition, how are you going to access culture to be an enabler for you?
It's a good question. Thanks, Charlene. So I think it was one of the key reasons why we were so excited about the business was because there was such a good, strong culture alignment. I think in the group we had the benefit of Herman and Lawrence and the Guardrisk team coming out of the Alexander Forbes group, and they had a fair sense of the business and the quality of the people. And in the roughly year that we've now been working together, I have just been amazed by the quality of the people, their commitment to making things work. So culture, I think, is a key enabler. It's obviously challenging to integrate two businesses, and particularly from a leadership and a culture point of view during times of COVID. But I'm fortunate to have great leaders in the business, and we assess it on a continuous basis. Our staff engagement levels are still high. We haven't lost key people, so I think we're, under the circumstances, we're doing well. And it is I think for that business, but also for us, when you are fighting for survival for such a long time, and you are in a position where somebody trusts you, there's investment, it opens up the mind, and I think it just creates a much more positive attitude, and we've seen that. Everybody is just jumping, to meet the various challenges that we have had over the last year. So I lose sleep over many things, but culture is fortunately not one of them at the moment. I think we're very lucky.
Thank you. Fantastic, Brand. A question from Itumeleng Molefe for Risto. Thank you for the presentations. Risto, you mentioned that there is a criteria that will be followed for special dividends and repurchases. What is the ROEV criteria?
Yeah, so I think what I was trying to say there is that I can't give you a single number that will always hold. The decision between buybacks and special dividends will be a function of where we are on any given time. So, as an example, if we thought ROEV would be 20% for the next 5 years or 10 years, we'll buy back shares at like 1.2, 1.3 times EV. However, if we thought ROEV would be 5%, we'll probably never buy back shares. We'll rather pay out the cash to shareholders. So what I was trying to make a point is that the decision between buybacks and special dividends, it's a function of both the price of our own shares and the expected return on what we're buying, which is the underlying business. As we stand here now, maybe that break-even point is somewhere 85 to 90% of EV, but it will be reviewed regularly as our view of RO EV goes up or down as a business.
Thank you. Last question for Hilly. It's a question from Michael Christalis. He is asking how important is Multiply to the strategy of the group, and why is it necessary to reinvent this offering, as you mentioned?
Okay, thank you, Charlene. Look, Multiply is very important, but I think, some of the challenges that we're facing, or realities or whatever, the one important thing is that it's almost as if we hit a bit of a wall in terms of growth in Multiply. And it's around about 100,000 or so clients, and these are power users of Multiply. But the ability to really grow that base, been eluding us. And I think it's a function of people that really sign up for Multiply, new clients and so forth, are really the people that almost can work out with the help of their advisors that they're going to benefit from Multiply. So it's a small segment of even our affluent segment that can afford more than 300 Rand a month and be convinced that, that 300 Rand is going to actually come back in terms of discounts and so forth. That'll be more than the 300 Rand. So that's, let's say, one of the things that we had to solve for. We wanted a sort of a rewards and loyalty program that can attract many more clients than 100,000. And this, this current sort of design and so forth didn't give us that. So that was on the one hand. The second was that there is there's some sort of limit to the behavioral impact. And I know, that might not be the view of all the, let's say, some of the competitors or whatever, but it's almost as if, a lot of the behavioral aspects and let's say the risk, important aspects from a risk point of view, you can probably identify at the underwriting stage, including, propensity to be fit and healthy and all of that. There's almost like the behavioral aspect has got its limitations. So that was a sort of a second factor that made it quite, it's quite a sort of expensive program to run, to impact behavioral change if the impact is relatively limited. And then also, I think one of the other things is we went onto a bit of a process, a phase where we build a fair bit of loyalty into the Multiply program. So if you buy, a short-term contract, then, and maybe you buy 100 Rand a month Investo, you can get a 700 Rand discount on Marriott and things like that. So there are some design, some of I think the loyalty features and the cross-product line discounts, I think we're getting a little bit disproportional, and we needed to manage that. But it is important, and I think these are, there's the cream of the crop of our clients that are these 100,000. So we need to, sort of come up with something that will work for those 100,000 clients, but also maybe something that we will be able to use more universally, so that we, end up with 1 million or 2 million or 3 million Multiply clients. So that, I'm sketching, Michael, more the challenge we're facing and what we need to solve for. I'm deliberately not telling you how we're going to solve for it.
Thank you, Eli. Last question before we break for lunch to the panel from a virtual audience member. Are the smoothed bonus funds fully funded post the market recovery?
Dumo.
So the simple answer is yes. Yeah, so post the recovery, the funds are fully funded. In fact, some are now over our upper limit from a funding level perspective. So we have had to soft close, looking at launching, some new series within those solutions. But they are fully funded. If I look at at the time of the market downturn, funding levels dropped well below the 95% level. But I think we were one of the few insurers that did not have any, impact at a policyholder level, just in terms of the market level adjustments and that sort of thing. So we were able to contain the impact at a client level, but we are fully funded at this point.
Thank you, Herman, Dumo, and Brandt. Thank you also, Risto and Hilly. We'll now break for lunch. If everybody could be back, please, at 13:55, and then we will kick off the last session of the day with a presentation by our health business. Thank you. Good afternoon, everybody. Welcome back. We have the perfect presentation to fight off the post-lunch slump. With health being foremost on the minds of so many South Africans, this is an eagerly awaited business unit presentation. The CEO of Momentum Metropolitan Health, Hannes Viljoen, and the Chief Marketing Officer, Damien McHugh, will unpack some of the issues transforming the health business. Hannes is, you might not know, a qualified dentist, but relies more on his public health administration qualifications to navigate the intricacies and nuances in the business of healthcare insurance. Hannes was part of the team who founded Pulse in 2003, which went on to become Momentum Health. The health unit now looks after the healthcare needs of over 2.5 million South Africans. But today, Hannes has kindly put Damien on the spot. No stranger to presenting under pressure. Damien is really the best spokesperson for our health business. He always shows up with so much empathy. And he's very passionate about helping people realize that their health is their ultimate wealth. Damien, welcome to the stage.
And good afternoon. I realize you've just eaten probably some of the most unhealthiest food. No, I'm kidding. I hope you enjoyed your lunch, and I hope it was something which is going to sustain you through a really interesting presentation and two very boring ones. No, I'm just kidding. Sorry, Jeanette. That's the last time I will ever be able to present. Yes, I know. The health is undoubtedly the most important asset you have. And I can say that categorically because I've yet to find a person, when I ask them this question, that they raise their hand. If anybody in your family was ill, and I mean truly ill, that you have to, except your mother-in-law, then that example doesn't work, but truly, truly ill, to the point that you have to sell everything you have, and I mean everything, the reserves that you have in your bank account, the money that you've saved and invested, your retirement money that you've got with your company, everything, your house, your car, everything, to get them healthy again. How many of you wouldn't sell it to get them healthy again? That's why the mother-in-law example doesn't work. If it was your daughter or your wife or your husband, you would sell it all. So you put all of your investment and value at risk if you don't have good health. How many of you would sell your kidney for more money? Now, some of you, the way I feel, I just had a kidney stone. I would quite happily sell my kidney for more money. But the principle of that is so true. Your health is the most important asset you have. And as a result of that, you should protect it then. And that's really what we as a business are striving to do. And as you can see, the heading of our presentation is about our purpose. And our journey about transformation isn't just about our ownership transformation. Our journey about our transformation of our health business is also about us as a business transforming the way we think about health and the way we think about the ultimate user of health, ultimately every one of you in the room, but also every single South African that's in our country. So we'll take you through a little bit about that transformation and the journey through which we think healthcare will move going forward. We'll talk a little bit about, if you like, our innovation or our product and service leadership. We believe that the opportunity is now to start challenging the way in which healthcare has been provided for and insured over the last sort of 2 decades. In fact, there hasn't been innovation in the healthcare industry since 1992. You will say, no, Damien, there has. The healthcare solution you are currently utilizing was designed in 1992. So there hasn't been. Yes, we've added things around them, but the actual medical scheme product and health insurance that you have is actually quite old. And so we think there's an opportunity to change that level of thinking, and we believe we can do it well. Then obviously, the theme that we've all heard about today is how can we do that faster, better, through digital capabilities, and healthcare has got to be one of the sciences that allows us to do that better than any other. And again, COVID has accelerated some of that development. How we as a business are growing market share. I think many of the investors in the room probably think of us smaller than what we are. We're actually a large healthcare player in South Africa, and with our initiative in India, which is a healthcare initiative, becoming a larger player worldwide. And we'll talk a little bit about that. But what started the transformation of our thinking about health? And very, very simply, it was one thing. It was our purpose. And our purpose is actually really simple. It's more health for more South Africans for less. Now you'll notice it doesn't say more health insurance or more health care. It says more health. Because health isn't about what you insure, it's about who you are and how healthy you are. That's what we're looking for. Because if I can improve the level of your health, the cost of your health insurance can become less. Now, what we often think is the truth is that the absence of sick, or the opposite of sick, is healthy. No, the opposite of sick is just not sick. Let me explain it perhaps a little differently. If the men in the room, you kept coming home late every night after work and you kept missing supper with the family, your wife is unhappy. When you come home from work the next day and you're on time, is your wife simply not unhappy, or is she happy? She's simply not unhappy. What makes her happy is when you bring her flowers when you come home at the right time. And that's the difference. It's not just about being not sick, it's about health. The other thing you'll notice is it doesn't just say for our clients, it says for all South Africans. And what enables that, you'll see a little bit later in the strategy, is how we've therefore been able to build into new markets, because we're not just thinking about the traditional market in which medical schemes or health insurance companies in South Africa play. And critically, can we do it for less? You see, the healthcare market, and I would imagine that most of us are privileged enough in this room, and those of us who are live as well, watching and streaming, are on a medical scheme product of some sort, some kind of health insurance. And that's a privilege in South Africa, by the way, because there's only about 9 million of us out of the 60 million in the country who have that privilege. The benefits you had 20 years ago to the benefits you have now, by the way, are less. You don't have the same level of cover as what you had 20 years ago. And by the way, just so you know, we charge you more for that privilege. So in a marketplace where your benefits get less and less and less, and your premium is getting more and more and more, we expect somehow this market to grow miraculously. And that's silly. So this purpose drives us into a totally different place. More health, that's not just about insurance, it's about you as an individual person, for less and for our whole country, not just a subset of it. So let's talk a little bit about the size of our business. 2.5 million people are covered by solutions that Momentum Metropolitan Health offer to its clients. We pay over 800 million rands worth of claims a week. We deal with 11 million claim lines in order to pay for that 800 million rands worth of claims. And it's complex, because we're not just paying the consumer or our client, we're paying providers and hospitals and pharmacies, and we do it automatically. In fact, the vast majority of those claims, 90% of them, happen without human intervention. The claim is submitted by the provider, assessed by a system, and paid, and checked for fraud at the same time. So an unbelievably complex business. And our health business has transformed itself over a period of time from a multiple range of entities. And you'll see, if you like, our family tree. Now, some of us have the fortunate position where you can change your family tree. Some of us, you can't change your family tree. We have the ability to change our family tree. And the journey that we are embarking on now and into the next few years will actually change this tree even more. As it stands, we have an administration business, largely. As you can see, Momentum Health Solutions. We also use Metropolitan Health, which is the business that administers a large portion of our public sector segment. We also have Momentum TYB, which is a different administration business that we purchased some years ago that operates almost solely in providing solutions in a mining segment. And then lastly, Momentum Oxa, our wellness business, which is also a collection of wellness companies that we've purchased over time. What we want to do differently compared to the other health businesses, Metropolitan Health, as you see it, was the first BEE healthcare provider in South Africa. It is owned by the investment arm as well of Popcrew and Tebe to 49%. Tebe is also a shareholder in our mining business at 48%. And we want to accelerate that. So firstly, what we want to do, and I think it was a question asked a little bit earlier, and Hilly answered it, said, are there still opportunities for us to create some consolidation within our health company? And the answer to that is absolutely yes. It's still quite complex in its structure, although we've simplified it a lot over the last few years. We have the ability to simplify it more. Less systems, better integration, and better shareholding. What better way than to have the very consumer that you're looking to provide more health to be the owner of your business? And so we want to align our health ownership, transform our health ownership into be stronger aligned to the worker, the labor within the South African context. And you'll see some changes to the structure. We wish we could have announced all of them now, but probably in the next few weeks, you'll see a little bit more around that. So our ability to transform as a business, but also transform our ownership, I think is really critical to the future of health in South Africa, because that's where vast majority of people are uncovered. If you look at the opportunity to demonstrate product leadership, there is an immense opportunity. As I said to you, the very solutions that you are on are actually quite old. They're in fact designed for your parents. It's quite strange that, eh? How many of you would use a solution that's designed for your parents? Not many of us. In any other technology, whether it's phones or TVs or whatever, I bet you very, very few of you have a TV that's this wide anymore. They're all this thin. But the ones that were this wide were designed for your parents. So why aren't you still using them? Because technology evolves, and the healthcare industry hasn't. And the reason why we have the ability to reinvent it, for a few key things, is there's a massive burden of disease in this healthcare market. And if anything shares it with you, it's COVID. What is the best thing you can do to prevent yourself from getting infected with COVID? It's not a mask and it's not social distancing. It's your health. The stronger you are, the better you will fight the virus. So the burden of disease is getting worse, not just in South Africa, but worldwide. People are living longer. If you've got children who are over the age of 14, it's predicted that those very children will live to be over 120. What is their health going to be between the ages of 100 and 120? So how do we resolve those challenges? We've got a lot more old people. People are going to live longer. In the last 6 months of your life, if you die of old age, you'll use more healthcare in those 6 months than your whole life before. Just think about that. So the opportunity for us to make sure that the health solutions products are established correctly are important. But in an industry where you can't price for risk, you better have enough cross-subsidy. And so you've got this younger generation who say it's all about me, but yet you've got solutions that are designed for their parents. You've got a problem. And so our industry needs to understand what national health will do, what the health market inquiry will do. And so having that understanding starts driving your particular focus around how do we interact with a new consumer. You've heard presentations a little bit earlier today about talking about the millennial and what the millennial does. I'm going to show just one slide, if you like, around innovation. This is the music industry. It's got really nothing to do with healthcare, but I thought it's a nice story. This is the evolution of the music industry since the early 1980s. Now, 1980 is not when I started in the healthcare industry, so I don't know what an 8-track is. But I'm sure there are many of you in this room who understand what a cassette is. Now, some of you are looking at me going, huh? What the hell's a cassette? Well, let me tell you about the amazing technology of a cassette tape. You had music on two sides. And if you wanted to listen to the other side, you had to turn the tape around and put it back in the tape player upside down. You couldn't find the song you wanted. You had to fast forward it, and then you were too far into the song, so you had to rewind it again. And because of that fast forwarding and rewinding, you stretched your tape, often to the point of it snapping. And for those of you that thought HB pencils were designed to draw, you wrong. They were designed to put in that thing so you could wind the tape up correctly again, get it to a point that you could stick them together, and then your favorite part of the songs where you had snapped it was the chorus, and you'd get this, and I wish I could sing, you'd get this lovely, and then it would carry on again. And you thought that was amazing technology. And in 1990s, you can see here, almost at the advent, 1992, was the first medical scheme savings account in South Africa, offered by a company called Amalgamated Medical Scheme Administrators, AMA. They designed the first savings account, kind of like the first CD. People thought it will never catch on. And that CD became brilliant because you didn't have to turn it over, you didn't have to put a pencil inside it. You could find the song you wanted when you wanted it. It was an amazing piece of technology. For those of you who are Gauteng-based, I would imagine the same thing happened up here or down here in Cape Town. You used to be able to drive on the road and buy CD stacks. On the side of the road, you could buy them and take them home. How many of you still have a CD rack next to your TV? The only thing you're going to use that for, I promise you, is firewood, because the industry evolves. The very solutions, the CDs, are the solutions that we're still offering you as clients in healthcare, as an industry. And it gives us an opportunity to update them. So if you look at the client that is now looking to utilize these solutions, we started to do some interesting work with millennials over a period of time. Millennials and Gen Zs, as the Americans call them. We like to use Z, Gen Z, I guess depending on your preference. A millennial will look at their phone 150 times in a single day. You may not believe me. I didn't believe it either, and then I did it myself, and I started to count how many times I looked at my phone. And I wasn't even a millennial. I was quite proud, and I still almost got to 150. I felt like I was young again, you know. But what do? They wake up on purpose in the middle of the night to check whether someone liked their status. Now, most of us wake up on purpose in the middle of the night and look at our phone to see the time for a totally different reason, not to check what's happening. The issue here, though, is we have this view that a millennial will always job hop. It's not true. Millennials are loyal. If you can ensure in their career, particularly, that you give them career opportunity and increase their income. And it's the same with their solutions. If you make their solution about them, they will stay with you. So there's loyalty in that. But here's the dichotomy of a millennial. Look at what they spend their money on. I'm not sure what those other 2% do. You're not buying smartphones. So just ignore them for a second. But almost 2/3 of them will buy energy drinks. And half of them will buy healthy food. Doesn't quite fit, does it? And so you can't look at the millennial as a whole group, because there are definite separations in a millennial group. And when you ask them specifically about what they want in healthcare, this is what they told us. They told us that, why do I have to pay for stuff that I don't need? Why is there no tech here? Why is it so expensive? So as you see that build up, you realize that that's not a millennial request. That's a request that every single one of you have. Why is it expensive? Why is there no tech? All of that is about all of us. And so if you can meet the need of a changing generation that's going to be entering into your market, you also meet the need of the current market. What was quite interesting is when we tried to explain to them that this is actually tough to do in our legislative environment, they were very understanding. They said, okay, we understand. No, they told us, we don't care about your legislation problems. Give us something that's innovative. And so that started to drive our belief structure around what we can do. Yes, we have legislation challenges in a healthcare market, but what can we do that's different? How do we bring more health to that consumer set? So here are some of our reinvent around product leadership in order to be able to deliver some of these things. The first thing we wanted to do is design a savings account that's flexible. Now, what you would have seen on the previous slide, if you didn't notice, I'll highlight it now, is I can even use healthcare for my community. Did you see that? Now imagine you could use your savings account in your medical scheme to help someone who isn't a beneficiary on your medical aid. How about your neighbor or your grandparent or your mother or your father? You can't do that in the current law, right? So what if you did a savings account outside the medical scheme? And you allow people to save what they want, not what the medical scheme tells you what you have to save. Allows you to build up money in that account, and at the end of the year you can actually reduce your premium because you've built up money. How cool it would be if you could take that money that you've built up in that savings account and transfer it into another financial vehicle where you get better interest. Wouldn't that be quite cool? And so we've done all of that. In fact, if you have balances over 5,000 Rand in your Health Saver account with us, you can transfer it into your retirement fund. And so we start linking people's thoughts about financial and health well-being, because your health is your greatest asset that you have. We've got 62, almost 63,000 people now who are utilizing Health Saver accounts. Their average balance is over 7,300 Rand. And it's not that we don't pay claims. We pay almost 25 million Rands worth of claims monthly out of those savings accounts on behalf of members. But the real value is we also pay for vets. So if you don't like kids but you like pets, and your pets are your children, you can still get them covered without having to take out all of those other solutions. That's not the real value. Whose money is a savings account? Yours or the medical schemes? It's yours, right? That was a good answer, whoever that was. I'll pay you later. It's your money. Now imagine this. You go to the doctor, there he is. You take out your wallet, you pay with your own credit card because he wants money up front. You pay with your own credit card, then you take their money and you go claim back your own money to refund the money that you've paid yourself to the doctor. Why not just pay the money from your savings account directly to the doctor? So the ability to start understanding the way in which people operate. The other thing is we started to incentivize people for doing the right thing. Not if they are already healthy, but people who are on a journey to become healthier is as important as the people who are already healthy. So we developed a program called Health Returns, and we actually pay people money back in their savings account. So that money flows from the one into their Health Saver account. We've got 13,500 roughly people who are now earning money back for free based on their health. Just stop and think about that for a second. This person does the right stuff, maybe if it's taking their medication because they're diabetic. They then start to get active. They earn money. That money goes into their savings account, which means they don't have to pay as much money into their savings account because they're earning money for free. Their health becomes an asset that they can leverage. That money that they earn over time can actually be moved into their retirement fund. Now your health, while you're younger, is actually helping you retire better when you're older. And we believe that's quite innovative. A doctor in your pocket. South Africa has a challenge with people not having access to quality healthcare 24/7. Not all of us have cars, and some communities, late at night, it's difficult to move around. In fact, it's dangerous in South Africa. So why not, instead of taking the member to healthcare, bring healthcare to the member? So we have a business, many of you would have heard about it, Hello Doctor, which we offered for free to South Africans during COVID. Gives access to a whole lot of people, anytime, anywhere, 24/7. We've got more than 1.2 million users doing it now. And I'm going to show you that they can actually have a consult with a provider and actually get their medicine delivered to their door. So no interaction with the doctor. Look, some things are just not possible, right? You can't go, in front of a TV, in a laptop screen. You know, there's times when you have to go and sit in front of a provider. But this does give you the opportunity to do so. And then the other market, which we think is incredibly exciting, is covering the uninsured population of South Africa. And we've entered into that market. We have over 100,000 members now getting cover in primary healthcare through insurance-based solutions that are covering people who previously did not have access at almost an average premium of 260 Rand a month. And particularly that's been offered in our corporate market with Dumo's business as well, in our corporate segment. If you look at some of those digital capabilities, and I've just taken some screenshots here to show you that COVID has accelerated a lot of these digital capabilities. You can see there's places to click on where you can go and talk to a doctor. And even in some cases, people don't have the ability to phone a doctor. They don't have data. So you can use a USSD number. So it's for free to the member. They can actually call, and we call them back. They get access to a provider. So all of that's now available on digital platforms. Really, as you can see, you can get medication now. I sit with a doctor. I can get medication. The medication gets delivered to my door. And we've seen a change in the way healthcare is being utilized now. You kind of strangely, we should have always been like that. We shouldn't really collect at a place where people are sick. I think a lot more of us are conscious about that. I don't know how many of you have gone into doctors' rooms lately and the magazine stack is perfect. Have you noticed? They're not all over the table. It's perfect. You know why? No one wants to touch that magazine because they don't know where you've been. It's the truth. And so we see a change in the way in which healthcare will be delivered going forward. It's done not just for web, but also for devices. I think really coolly now, people are able to access and understand their health better. Duma spoke about a little bit earlier in the previous presentation about wearables and the way in which the wearable information is now able to plot out a healthcare record for an individual. We can show them their blood pressure, some really cool technology that's coming forward through health, particularly in this. We've got web bots and web chats and the capability to do all of your pre-authorization without even speaking to a person. We're making significant investments in artificial intelligence. So now you can do pre-COVID testings and all sorts of things. Imagine a world, this is not far away, it's not happening now, but imagine a world where I phone you and say, listen, here's your hospital pre-authorization number. And you say to me, sorry, what? I'm not going to hospital. I say, but you will be if you carry on doing what you're doing now. That's not far away. It's really not far away. And we believe we have some really cool technology that's going to enable us to do that, not just in a COVID world, but for all hospitalization going forward. So what does it mean for our business? We are, as I said, a diverse business. We're not just an open medical scheme. We're an administration business, a wellness business, all sorts of things. I just want to show you, Hilly showed in his presentation sort of the market share graph that we wanted to indicate for you. In our public sector business, from 2017 to 2021, year to date, pretty much April numbers that I'm sharing with you here, you can see that we've had about 6.8% growth. Now, in a market, for those of you who don't necessarily understand or play or analyze the healthcare market regularly, 6.8% growth in a marketplace which is growing at 1 or 2% is actually quite phenomenal. So the growth in this segment has been really good, public sector. And we've looked at the public sector medical schemes, things like GEMS, PulMed, Transmed, Medipos. Those would be the schemes that would fall into this segment. And we have 72% market share there. If you look at the open scheme market, and this is quite interesting because what you see here in the graph, if you like, from the teal to the blue, you see some growth. But from the blue to the red, you see sort of a drop-off. You say, well, Damien, why is your open scheme not growing? And you can see that's the effect of COVID. So people haven't cancelled all of their policies. We as a business have quite a lot of foreign students that come into South Africa, that join. In fact, the leading provider of foreign students, if you call healthcare solutions. And a lot of those students obviously couldn't get into South Africa during the periods of lockdown. And yet our numbers are almost the same. So when the foreign students come back, and they already have started, we actually expect that our scheme will grow quicker. We've actually gained market share in a market that's contracted. We have a lot of opportunity in the open scheme space where we only have 7% of the market share. We really believe through the solutions that we have, we're gaining market share in this particular segment. Just hasn't been able to be seen because of the COVID effect. If you look at restricted schemes, and for those of you who are not familiar, this is companies who have their own medical scheme for their own employees. You'll see, I think as Hilly Aristo mentioned, we've had some really good growth in our restricted scheme segment over this period. As we take some of the solutions that we've evolved in our open scheme market and start applying them into the restricted scheme space, we've seen some significant growth because of the value that those solutions have for us and a market share of 18%. And if you look at that overall, you can see that we've had really good growth relative to the marketplace with a market share of 28%. And the plans that we have are to grow in each of those segments quite significantly, that we start gaining probably more than a third of that market share over the next few years. And that ignores the stuff that we've done in the new markets. And what I want to show you is a little bit of the growth in our health for me, or the low-cost insurance solution set that I alluded to a little bit earlier. We have over 140,000 beneficiaries now on that product, with a growth rate of almost 82% over the last 2 years. It's a marketplace which is growing rapidly. The rest of the medical scheme markets are quite mature. So we have this diverse, and this doesn't then impact the market share numbers that I shared with you a little bit earlier. This is almost shown separately. Our ability to grow into other markets. And we think not just through Hello Doctor, but through some other initiatives, we can actually start getting into some of the supply of healthcare through our wellness clinics and other components of our health business, which diversifies our income stream a little bit more over the next period. So it's a business that we believe is significantly well placed, not just for today and not just for today's consumer, but for a consumer that is going to be entering in the job market more and more and more, which is this millennial and Gen Z, because they have a totally different requirement around healthcare delivery than what their parents did. Yet, if we do it properly for them, we do it properly for everyone. And without them, you have a solution set that will fail. Because in a marketplace where you can't price for risk, you need the cross-subsidy of the younger, healthier life while they are younger and healthy. Or let me put it this way. Millennials aren't always healthy. A younger, non-sick life. But can we help them be healthier? You see, in South Africa, we have a challenge. We have a challenge around the way in which healthcare solutions are provided. And we believe we have a business which is transformed, not just in its ownership, but in the way we think about healthcare. More health for more South Africans for less. We've got an innovative set of solutions that not only integrate with our own offering in health, but start linking the way in which health offerings work with our other insurance solutions, like in our corporate segment. And as a result of that, we can grow not only in our existing markets, but we can enter into markets that we haven't been in before. Now, there's a piece of legislation that starts talking about integrating these health insurance solutions into medical schemes. There isn't one of the other 5 big medical schemes that actually have a comprehensive health insurance solution like we have. So we'd actually get instantaneous market share if that was just incorporated one into the other. But the digital capabilities and the artificial intelligence that we can bring through all of these health data points are absolutely fascinating. And our ability to leverage those going forward is what brings me, I think, the most excitement. So we are far more than just an administration business. We're a health solutions business that thinks about health differently. You see, in South Africa, as I've already shared with you, you are getting less health for more. That's what's currently happening in South Africa. Our strategy, which is totally different, is to ensure that we can give more health, and not healthcare, more health to every single one of you, but doing it in a way that it does it for less. Thank you very much.
Thank you very much, Damien, for that insightful presentation. Now on to our next speaker. We could say that she needs no introduction, but that would be remiss of us not share some of the awesomeness she represents within the group. Like Hilly, Jeanette Marais is a returnee. She left the company in 1999 and returned in 2018 as its deputy CEO of the group and also as CEO of Momentum Investments. And in addition, Jeanette also oversees the group marketing portfolio as well as the independent financial advisor channels. So she has quite a bit on her plate. But like Ginger Rogers, that famous film star from the 40s, the over 40s will remember, said about her dancing career, and she referred to her co-star Fred Astaire. She said, I can do exactly what he can do, but I can do it in high heels and backwards. And that's Jeanette. Jeanette, welcome to the stage.
Thank you for that, Charlene. And Damien, where are you now? I must say, you're going to be a tough act to follow. Great energy, well done on that one. But for those of you that's still here, in fact, you're all still here, because I was checking up all day. Thank you very much for doing that. Johan and I will certainly try and make our two presentations the highlight of your day, although they are last. So Johan, if I don't do it, it's going to be up to you to do it. So my privilege today is to talk to you about the Momentum retail business. And as Hillief said this morning, you will hear Johan and myself talking about each other's businesses quite a lot. We decided to basically divide it up, and I'm going to talk about advice-led distribution. And over lunch, Hilly kind of looked at me and said, well, after this, hopefully I will understand what advice-led distribution actually is, because it's this new word that you guys are using all the time. So hopefully all of us will be able to understand that when we are done here. Now, where were we 3 years ago? You know, when we stood in front of you the very first time and we launched our Reset and Grow strategy, I will venture to say that Momentum Retail actually had probably a lot more resetting to do than even the growth prospects that we could foresee for ourselves at that point in time. And the greatest challenge we had as a management team was the fact that we needed to fix our business while growing. We didn't have the luxury to sit back and say, we're just resetting and we're going to do that for a long period of time. And we needed to fix that business while growing market share and while actually trying to regain some of the support from advisors out there in the industry. Now, although advisors at that point in time were telling us that we had a great product and a comprehensive offering, there weren't many other positive things that they had to say about our business. We knew that we lost a lot of market share at that point. Advisors told us that we are just so complex, that our products were too complex, our service models were way too complex. We knew from ourselves when we identified it that our service levels certainly were not where they're supposed to be, and there were lots of inefficiencies in our business that we needed to reset and to fix. So a lot of fixing that we needed to do. But we also knew that winning back market share, and in fact, Hilly said it, I distinctly remember the first time that we stood in front of you and this community with our first results presentation. Hilly actually said that winning back independent financial support will be a way to show that we have fixed our business. But at that point in time, he also said, do remember that it's probably the toughest ask. If you have independent advisors, they have a lot of choice. They're actually not beholden to anybody. And at the same time, many of those advisors at that point in time have left us. That's why we lost so much market share. So we knew that it was going to be a tough ask. So Hilly put it out there and he said, this is how the retail business will measure whether they are turning the corner and they're starting to fix the business. So we took Hilly's challenge to task, and I'm very privileged to stand here today and share with you the progress that we have actually made in our retail business over the last 3 years. Marriott, our protection business, have actually just literally, and this is kind of hot off the press from an NMG survey that I will return back to later, have actually just shown that they have reclaimed the #1 position as market leader in the IFA space. So this is for our risk and protection business in the IFA, and it includes bank advisors who are allowed to actually sell, all of the life offerings in the market, back to a 17.4% market share. So well done to Johan and his business, to Etienne and the distribution partners for actually achieving that. I think no mean feat, especially if we consider where we are right now. The wealth platform still have a long way to go to reclaim the #1 position. And for those of you who don't know, not as much longer than 8 or so years ago, the Momentum Wealth platform was the #1 market share platform in South Africa. And what I can only say is that regaining around about 3% market share in the last 2 years actually, I think, puts us firmly on our way to reclaim at least a top 3 spot in the wealth market again in South Africa. So long way to go for us, but I think we're on the right track. Now, the one other number that, we always use to kind of show our progress and show how our businesses are doing is our APE numbers. And in this case, the incredible APE numbers that we are showing at the moment, I think, is nothing short of something that we could be very proud of. And, just because I'm standing here and I've got the mic, I will focus on the red part, which is Momentum Investments. And you can see that since the first quarter of 2018, we have almost doubled our APE for our investments business. So something that we are truly very proud of. And, I'll unpack that just a little bit more. And this is just showing you the new business support numbers. So it's hard for us nowadays to actually measure our relative market share because those statistics aren't available anymore. But I think if you continuously show great growth in your business, that start to show you that actually you are gaining that market share back. This unpacks it for the two channels. And this specifically on the left, Momentum Wealth and Wealth International are two platforms. And then on the right, which is also your right, life and guaranteed annuities. And you can see that we didn't only grow in our agency force, which is MFP at the bottom, the blue one, but we've had quite incredible growth for both the platform and even more so for life and guaranteed annuities in the IFA space as well. So again, while we were fixing our business, while we had lots of headwinds in terms of the economy and what's going out there in the market, I think these new business numbers actually show that we are making really good and solid progress in this regard. And again, the IFA support for me is actually the greatest way of encouraging that we are on the right track. Now, if I was only allowed one slide today, I would have put this slide up. Because I think this slide, and Johan will use it in his presentation as well, is one that we believe is what is putting our retail business on the footing that it is at the moment. But more than that, this is literally what we are using as a basis to grow into the future. So where does this come from? When you look at it in 3 blocks and it sits in a triangle, and what's so special about it? Well, maybe just taking a step back. One of the things that Hilly didn't mention this morning, in terms of our reset targets or our reset initiatives that we had way back, in the retail business, we had a massive difference or reset that we needed to make in terms of our structure. Many of you will remember the old segment-led or matrix structure model there was a lot of talk about it way back at the time when we joined. Now, in the retail business, that was most profound. And what that model entailed was that it pushed product houses back into what was called centers of excellence. I often wonder where the excellence was at that point in time, but anyway, it was centers of excellence. And like Johan would say, it was almost like wholesale product providers or reinsurers that sat at the back. But we had a complete de-link or decouple from the client and the advisor that sat at the end. And that was, as far as we're concerned, part of why we had so much loss of market share at that point in time. So that, for us, the biggest reset that we needed to do across the retail business at that point in time. So what have we done? Well, firstly, we realized the incredible importance to re-establish our end-to-end product businesses. And I'm going to spend a little bit of time on all of those product businesses so that you can see the progress that we've made there. But more importantly, was to also put our arms around distribution and actually bring our distribution partners, IFAs, our agency force, much closer to how we think on a daily basis. And I can tell you that for myself and my team, not a day goes by that our conversations are not about what our distribution partners need from us. Linking back to advisors, finding out that we're still on the right track. And re-establishing that link, firstly, was for us most important. But then if you also think back about, I can say the old Momentum before I was over 40, was actually a time when Momentum was completely advisor-led. Complete advisor-centric business. We didn't really care much, to put it harshly, about the end client as we cared so much about the advisor. So complete advisor-centric business. We designed products for advisors. On a daily basis, when we thought about our business, it was about how do we keep advisors happy. In fact, up to not so long ago, in many of our business, most of our businesses, a client could not buy from us directly. It was all about the advisor. The first question was, where is your advisor? You need to come through the advisor. Now, What we've tried to do through advice-led is to move away from advisor-led to advice-led. Now, is that just a play on kind of an R, or what does it actually mean? It means that we've brought the client back into that equation, and that we've realized that we needed to think about the client when we design our products, but also think about that important link between advice, the advisor, and the end client. And that the stronger we can make our advice-led propositions, the better for advisors, but certainly that will lead to much better outcomes for the end client. And actually, in many cases, where our advisors were kind of sales-led businesses, being an advice-led business gives them much better longevity, and certainly has helped them to hold on to many more of their clients because their advice proposition is so much better. And that intricate link between the product house, the advisor, and that end client is what has actually brought all of that together for us. And we believe that this is also going to lead to much more client loyalty and brand loyalty over the long term. Because in this process, and the best example for us is vertical integration. Now, what is interesting is this is probably the first time that we're in front of you talking about advice-led, but also the first time that vertical integration has become a reality. I was amazed when I joined the business and started working here again 3 years ago that we had an agency force, but we weren't very particular about the type of advice that they were giving. We were actually not prescriptive at all in terms of the end investment advice that those advisors were actually distributing to their clients. So for me, the best example of a good advice-led business is where you have well-researched, with great outcome, products, investment products that you actually put into the hands of your advisors, and you do that in a digital way because you've completely integrated it into the entire advice process. Now, when I say integration, that is what Johan is going to talk about. Johan will talk to you a lot about the fact that this is impossible if we don't deliver it digitally. Because you can't go to people and tell them to do things. You have to integrate it fully into the entire advice process. This slide is one that I think bring the entire retail business together, because all of us actually have these 6 different focus areas in our delivery or interpretation of the Reinvent and Grow strategy. I will specifically focus on our channels, so I will spend some time on all of our different channels, our product houses or product leadership, and how we're going to find growth through this partnership and through this advice-led strategy that we're bringing together. And then also how we're going to deliver that in terms of brand and culture. Johan will talk about similar themes like this, where he'll bring the digital delivery of that in, while I'll focus on advice. Now, if I start with our channel focus, then the first thing I actually want to do is just maybe spend a minute on the advice landscape in South Africa and how that is evolving. And I think this is quite important from our point of view because it frames how we have positioned and how we will be positioning all of our different advice channels and support that with our product leadership in order to make us stronger in this market. Now, the first thing I can say that I'm very proud of is that Momentum competes across this entire landscape. And we do because of the distribution footprint that we have and all of the different distribution channels and focuses that we have. And on top of that, our comprehensive product range. Because actually there's not a product that these clients or that these advisors need that we do not have on offer. So that makes us strong. It gives us that strong distribution footprint that we can compete. And maybe to just explain what you see in front of you, you'll firstly have your traditional IFA. Traditional, independent financial advisor who has choice. What we have seen happening over the last few years is that there's a lot of specialization starting to happen in this space. It's becoming increasingly hard for one advisor to sit in front of a client and offer him risk, investment, short-term, and all of the different product options or all of the different products that's available in the market. So we see a move or a shift on an individual basis towards specialization. However, what we've also seen are that these practices are growing bigger and bigger, Because what a practice owner will do is make sure that he brings those individual specialists into the practice so that they can offer a holistic financial plan to a client, but not necessarily delivered by one individual. So more and more specialization happening in this place. And you have your risk specialist, more and more investment specialization taking place, specialization across corporate and short-term as well. Then your networks. Networks probably the fastest growing area. We didn't manage to kind of show this, relative to each other in terms of size, but certainly the network area has been growing very, very fast. And there really you have two types of networks. The top block is owned by advice firms, and the bottom one mostly owned by life insurance companies like ourselves. Now, this is the area that has actually traditionally not spent much money at all on growing new to industry advisors. In fact, all those little arrows show that they have been great to actually go and poach from everywhere. Saying, let insurers grow those advisors. I'll go with my value proposition, I'll go get them when I need them, but rather than to spend money on growing those. So actually, in terms of all of our other value propositions, you are actually quite exposed to make sure that if you've grown someone, you need to hold on to them because it's quite easy for those networks to poach them. But it also means, and you see Momentum Consult in that space, that we are positioned very, very well to also grow in this specific network space, but in a very competitive environment. So your value proposition actually becomes incredibly important. What is also important about the networks is the fact that they actually all have lots of rules that we as product providers now have to play by. You can't just take any product in there. Often they have limited product lists. All of them, most of them have vertically integrated solutions for investments. So the more people join networks and it's not your own, the more limit there will be on the space that you can play in, which is actually something that we need to take into consideration in how we position ourselves in this market. In terms of the bank space, in the days before I left, I distinctly remember that I think between ABSA and FNB, that was probably really 60-70% of Momentum's, probably even more, of Momentum's entire distribution force almost out there in the market. Today it's minuscule. And it simply is because the banks have come in with their bank assurance models where there's less and less opportunity for advisors who work for banks to actually support anybody outside of their own bank assurance models. Most of them actually do have the kind of private bank offerings where there's still some opportunity for us to play. But in this case, to the extent that we think post-RDR, the retail advisors in banks will probably actually be classified as product supply agents because there's so little choice left for them. So this has been a shrinking market for us in terms of where we can play. And then lastly, insurer agencies, where most of the growth in the entire financial industry or financial advice industry is taking place, because all of us are still investing a lot of money on growing this industry and growing new to industry planners and bringing them in. Now, I want to start with our different distribution channels and start with Momentum Financial Planning, or MFP. And again, I think if you hear these plans, I think they are incredibly exciting, but they're also quite demanding in terms of what we want to deliver in our agency space. And an area where we really needed to make some profound changes in order to set us up for the future. Now, there's been some fantastic growth for us in the last 3 years in the financial planner footprint growth. Most of it came from new to industry advisors. So this is where we put our money where our mouths are, about growing our industry and making sure that we keep on bringing new planners into this fold and into the industry. But it also means that you have to make sure that you vest these people properly. Takes a long time. I think, in my view, 5 to 10 years to properly vest a new to industry planner that has started off with that as a career and has never done it before. So a great opportunity for us, but certainly one that we have to keep on investing in. If you look at the strategic objectives for MFP going forward, then really we've kind of boxed those strategic objectives into 3. The first one is what to do to help them grow their footprint. Secondly, what they need to do to give their planners the right knowledge and skills and tools to be able to do their jobs. And then lastly, how can we assist them in their efforts to actually grow their client bases? And really that is what an agency force is all about. So in terms of the footprint growth, how do you do that? Well, you attract new to industry planners, you vest them and you hold on to them. You try and get as many experienced planners as you can, but that's a little bit harder because there you compete with whatever the value proposition is where that person is at the moment. But also make sure that you protect the experienced planners that you have already, because you've already spent that time and money and effort on them, and most of those clients are yours. And then lastly, you need to make sure, in our case again, that you transform your planner footprint. That's the way for us to expand our future target market. And this is certainly a great challenge for us in terms of making sure that we can attract more and more. And there was a great question from you, Warwick, this morning about, is Peter's people, allowed to support Momentum or sell Momentum product? Well, actually, in MFP, we need to grow and invest in that market ourselves. In a way, maybe competing with Pete a little bit, but making sure that we attract more and more and transform our agency force in this case as well to sell Momentum products. Now, really in this space, the second part is what we're doing with business continuity partnerships. And you'll see it again in put planners in front of more clients. But really the idea there is that we use the databases or the client bases of our experienced older planners who is about to retire and was not really into client acquisition anymore. And we take those new to industry planners, put them in front of those clients and help them grow their client base by doing that. So actually kind of a double positive for us, because you start to work those old books, but at the same time, you also allow your new to industry planners to actually vest themselves and become successful. Give them the right knowledge, skills, tools, and solutions. And this is entirely a digital approach that Johan will talk about a lot. But really important in this space, how we actually manage to get the digital footprint out there so that it's not all a manual process like we used to do in the past. Vertical integration, I've spoken about that a lot. I will talk about it some more. So it's not the end of hearing about that. But it's getting more and more important for us. And, for those of you that doesn't know it by now, let me say it. Nobody makes money from an advice business. Go check any network out there in South Africa. You make money the moment you start to actually get the benefit of those clients, of those advisors investing in your own product. That's where the real profits start to emerge. So more and more important for us to have vertically integrated businesses. Is that not true? I see the three going on here. We can have that conversation later on. But vertical integration, making sure that the offerings that we have is actually there to ensure that we get more and more product and that we have consistent advice that is delivered through our advisory force. Put planners in front of more clients, demand generation through brand building, through people recognizing the Momentum brand and wanting to have a product with us, open new lead sources, and then retailization as well. So really, this is the picture of the agency of the future. We've already launched Momentum Institute of Financial Planning. We are very proud of that business, of that area in our business, and that really is where we are going to grow and invest and ground the knowledge and the advice capabilities of these new to industry planners that we are going to bring in. Segmentation, we've specifically segmented MFP, and Hilly mentioned it this morning, between what we call our contracted channel, I channel, experienced advisors, employed channel, which is our red channel. This is our really new and exciting initiative to vest new to industry planners, and then our franchise channel as well. And we've segmented it because there are distinct differences in how you support these different businesses, and they have distinctly different areas where they actually go and recruit new advisors and the way in which they set up. Supporting that with what I've mentioned, the business continuity partnerships, where you actually leverage off the client bases of your more vested advisors and you put new and young advisors into those practices to ensure that you have business continuity. I've not seen in my years in the industry many successful selling of advisor practices where you sell it and then the person walk away. Why not? you're not at an advisor practice because of the practice. You're there because you have a personal relationship with an individual. And if that individual leaves, it's often very, very hard for those practices to hold on to those clients. But where you've over time gotten to know the successor in that practice, the chances of your success is actually just so much bigger. And that's exactly what we want to do there. And then again, the vertical integration of all of our advice processes and products. And vertical integration, Johan again will talk about that, is not just offering a product. It's actually integrating it into the pre-planning for that client, into the advice process, into the reporting. Because if you haven't integrated it fully, there's no chance that the client will actually stay in that product and use it successfully. Then momentum distribution services. And maybe to just quickly, I hope I'll remember it all. So MDS is our support base to independent financial advisors out there in South Africa. And they support Momentum Myriad, Investo, Momentum Platform, Momentum Unit Trust, Momentum Securities, Momentum Corporate, Momentum Health, Momentum, who have I missed? Funds at Work, and Short Term. 9 different products, and I might actually have missed one. So 9 different products that they actually take out to independent financial advisors, networks, and banks, as I've shown you in that advice landscape. Now again, here's the reset and growth strategy that MDS embarked on, and there were some reset areas we needed to fix and look at our footprint across the country. We also set ourselves some kind of internal targets around our management structures and panel management and how big a broker consultants panel should be, how many advisors they should look after. And at that point, we had that elusive number of 2,000 productive brokers or productive advisors, and we set ourselves a target to actually reach and exceed that 2,000. So here at the bottom, you can see how we've measured up our growth in productive intermediaries. Healy said it's around 2,200 at the moment. So great growth, about a 12% growth that we've had. Our target is 3,000 supporting advisors in 2024. So again, we believe we've got great momentum now. It's going to be easier for us to achieve that now that all of the building blocks are in place. And again, I think the success of MDS, which is entirely the independent financial advisor space, is in the APE growth that is round about 47%. So what is it specifically that MDS is going to see as their strategic objectives? And I've mentioned many of these words already, but the first one is to establish this advice-led strategy. It can easily just be something that we talk about. And that can't be done unless it is in a very close partnership with the different product houses. Because in the entire value chain, we need to make sure that we work very closely together to put this out there and to establish it and to execute on that partnership model. Keeping the independent financial advisor independent is actually very high on our agenda. If every single IFA go and join a network or a bank or an insurer, it will actually severely limit the areas that we have to play in and the products that we can take out there. And why is that important? Well, in terms of the advice know-how, IFAs are lonely people. They're often 1 or 2 people in their own offices. They need a lot of help and partnership from us to help them run better practices, to help them with business continuity, to help them with how they can run more sustainable practices. And that really is the partnership model that we're talking about here. Multi-segment IFA proposition. I've spoken about all of those different segments. Now the point is each one of them have their own rules. Certain networks have vertically integrated products of their own. You're not allowed to play there. You've got to play by their rules. So more and more we need to make sure that our key account management, the way in which we focus with surgical precision on each one of these networks and IFA practices are almost according to their rules and that we know how to specifically play there. And the way for us to make us stronger than ever is to actually integrate our back offices into the back offices of these networks so that everything can happen electronically and they can almost not do business without having us as their partners in those businesses. And then lastly, one that I'm certainly very excited about, and that is specialization per product type. So when I named the 9 different products and product sets that MDS support, you can only imagine how difficult it is for one individual to walk into an advisor's practice and actually having to talk about 9 different products with confidence and with knowledge and being able to add value. And on top of that, they've got technology solutions they need to drive. They also have to do practice management. There's a lot more. So we are embarking slowly but surely into a total specialization, but not breaking the footprint that MDS gives us. So within MDS, transforming ourselves into a specialist product house to be able to actually combat the increasing competition that we have from single product houses or single product competitors that we have out there. You know, many competitors only have one product and that's all they take out. Where actually we need to compete with that, with knowledge, quality of people, and with the quality of our propositions on a daily basis. So a very exciting proposition for us, and one that we will do with caution because we know that we have a lot to lose. Advisors don't like change. So make sure what you do well, and make sure that they can see the benefit to themselves in that space, and that they're also happy with that. Then Momentum Consult. Now Momentum Consult, as I've mentioned, probably operate in the most competitive of the advice landscape areas that we've spoken about. We're very happy. It's a business that's now 7 years old. And if I can give a challenge to Hannes, who's here, who leads or heads up that business, then it is that this is the business that need to change from a little advice shop into a full-blown network, and one that will be recognized in the industry as one of the top networks out there. Competitors like PSG and the Efficient Group, AdviceWorks and so forth, so no mean feat, but certainly a business I think that have shown across many different measurements the growth that they've already achieved and that they've had over the last while. Assets under advice, that's where we earn our fees. It's almost 30 billion now. Assets with Momentum. Now, I have to just say that there's absolutely no obligation on Hannes or any of his people to ever support a Momentum product. There is no obligation. But what we do is help them to build vertically integrated solutions for them. For instance, my team, my DFM, actually run a set of investment solutions for them with great success. And we've seen, in fact, 22% of their assets are now in those consult-owned solutions that they also earn a fee on. APE as percentage of IFA, APE for us is now from 1 to 9%, which already make them a proper seeded player for us as a network. And then lastly, again, just something that warms my heart is we've had more than 1 billion in net flows onto the Momentum platform, a wealth platform, from Consult over the last while. So really, what is it that they're focusing on? Growth and financial planners must be it. How to go about it? Again, that absolute focus on specialization, realizing that we need to go and recruit risk and retail advisors for what they do. We've got a very recently launched private wealth management offering. Great challenge for Hannes and his team to go and attract with a best value proposition all of the best and the top private wealth managers out there in South Africa. Convince them to give up their independence and become part of what we offer. And there your value proposition actually plays an incredibly important role in order to attract and retain. No longer can we write checks to buy out books and do all sorts of funny things. You stand there, I can almost say naked, competing with all of the other networks, and only your value proposition, the product, the brand, and what you have behind you is what's going to help you gain those advisors and hold on to them. Then, and again, you can see there that our target is to actually grow to 400 advisors by 2024. And also, sorry, I haven't mentioned, but the commercial short-term advisor space is actually a fast-growing space for us and one that we're also very focused on. Client focus, very simple client proposition is that we do want to strive to be one of the preferred, or at least the preferred, advice and financial advice provider in South Africa. And with a specific aim that Hannes has for his team and for all clients is to say that we want, by 2024, every single one of our 100,000 clients to have their own unique financial plan. And you get that through market-leading client value propositions, make sure they experience your service, have a good experience when they're with you and with your brand, and of course create an advice brand. And I'll share with you a little bit more about our efforts at the moment to create an advice brand for Momentum as a whole. And lastly, the integrated financial planning. And the one here that I like a lot is actually just saying, apart from the fact that we want each client to have their own financial plan, we also want to make sure that when we report, we stop reporting on clients' product holdings, but we actually report back to clients in terms of their plan and how every product fit into that plan. Because that client experience actually, we think, will distinguish us from how our competitors in this space does it. So really something, and again, that can only be supported by digital. Johan, do well when you talk about digital here, because that would be the way in which we could deliver this. And then lastly, grow assets in Momentum Consult Solutions. I've said it already, but advice businesses on their own struggle to make money. You have to make sure that you bring those assets into your own solutions in order to be able to sustain the investment that you need to make into that business. Where are we going to find our growth? Now, I have 10 minutes left, unless I steal 5 of Johan's minutes, to talk about my business and Johan's business. Momentum Retail Investments, advice-led go-to-market strategy. Again, you can hear it here. You can see that it's embedded in how we think. And I just wanted to quickly share with you this kind of illustration. But really, for us, and we know that platforms platforms everywhere in the world are very low-margin businesses. So you've got to have scale, and you've got to have as much consolidated onto that platform in order to ensure that you have enough assets to make it sustainable. So really what it is for us is an ambition to partner, and especially partner through our 3 advice channels, to be the leading long-term investments and savings partner to all financial advisors and their clients by partnering closer and offering personalized and tailored solutions. Again, you can hear this underlying technology and digital coming through, because that's the only way in which you can do that. The platform-led strategy that we have says that we need to integrate into all of the different financial planning, consult, and advice networks that we have out there in South Africa. If you have a platform and you do it by people and by paper, there's no way that you can ever run it efficiently. So you need to integrate back into your distribution channels. And at the same time, this is a business that we have changed radically and completely over the last 3 years. From many different little operating units, a unit trust company, an asset manager here, an investment manager, and a platform, and a DFM, we've actually consolidated the entire investment business into one operating unit. And all of that you see on this slide. So the platform becomes the basis for all of the products that we want. And then it's all about vertically integrating all of these solutions into the different distribution channels we have. On the left, by using our own DFM, Momentum Investment Consulting, their only job is to create advice solutions, investment advice solutions, or model portfolios if you want, or their own white label solutions for advisors in order to take care of their investment advice. And by doing that, vertically integrated it even more into our own balance sheet products and into our own single manager unit trust. Now, when you work with MFP, your own agency force, right now, and we're busy with the implementation of that vertically integrated solution, 50 to 60% of the funds in these solutions could actually be Momentum-owned solutions in our single asset manager. In Consult, that's around about 20 to 25. The tolerance is a lot less. And then you have bespoke solutions for your independent specialist advisors, where you actually go one-on-one and you create bespoke solutions for them. And there you hope to pitch at least some of your funds, but the vertical integration is not so easy. So if I really talk about the reinvent and grow strategic objectives, then I'll talk about it in the 4 kind of quadrants of this business and the 4 operating units. I've said a lot already about the platform and the balance sheet area of the business, but maybe a little bit more. And the first one, Risto touched on it this morning, is our platform has to be totally, radically overhauled with a digital, completely different, integrated go-to-market strategy. A platform does not have the margin to have expensive people or paper touch anything in that process. It has to be completely straight through. So in that business, we will see quite a big investment in technology in order to be able to achieve that. And for a very long time, in fact, I was part of the team that started this platform in 1995, and we're still running on the same technology. So you can imagine that there's a lot of work that we need to do in this space. But that's our greatest challenge and greatest excitement in our business for the next year. Over the last year or two, we've actually gained and we've benefited a lot from that flight to safety, where clients have started to actually use and make use a lot more of guaranteed annuities, an opportunity for us to reinvigorate, reinvent, and to actually build some new solutions there to increase our earnings potential in that space as well. So we don't believe that it's necessarily going to stop, but we do believe that we need to create more opportunities for us there. We will do this in collaboration with MFP and MDS, our channels, to regain more market share. Retail investments is an area that we don't talk about a lot. But this really is Momentum Investment Consulting, our DFM, as well as Momentum Collective Investments, our unit trust fund manager. And here specifically, focusing on the single managed capabilities that we have. And I've already shown you how we're going to use that in our vertically integrated go-to-market strategy. But really, our DFM, it's a small business. It's grown phenomenally well over the last 3 or so years, but we need to help them to get scale. We need to help them to deliver it digitally. We need to be able to help them to have all of the efficiencies that they need in that business. Single asset capabilities, we've never been strong to actually go out and market our single asset capabilities to third-party platforms and other DFMs. So that's a focus area for us, and continue to build an investment brand for our business. Investment management, which really is our asset manager or investment management business. Maybe one of our still best kept secrets is the fact that we actually have a great single managed business or single management business, and not just multi-management. It's been kind of widely reported that we are multi-manager, but actually we have some fantastic single management capabilities that we're building out. We focused on growing our distribution force there. We're re-establishing it as a separate unit so that we can focus on it. And there maybe to just say we have a great range of fixed income products. We have a listed property offering that we have there. We have some passive funds in the form of smart beta and passive funds that we offer. And we have a alternative business with a real asset program, with a hedge fund and with private equity offerings as well. So a lot that we have to offer, but something that we've certainly not really focused on a lot in the past. And it's always been perceived as just being part of our multi-managed business. So great opportunities for us to explore there. Transformation, something that always have to be on our agenda, but more so in an investment management space. And here we can make a contribution on 2 levels. Growing our own team, making sure that we're representative, but also through our multi-managed offering, make sure that we support transformed managers in our industry to also help them grow. Outcomes-based investing as a philosophy, we believe, is a fantastic way to help advisors manage investment products. Maybe not something that is easy to sell when it's housed in one single unit trust fund, but certainly a philosophy that has worked really well over the last few years for us in terms of that advice offering. So we will collaborate there more and more and provide that infrastructure and provide the research to our DFM and to Momentum Investment or collective investments to take those out. Brand building again. And then lastly, in Momentum Global Investments that we also not often talk about, develop and grow our global single capabilities. A fantastic business that we actually have in the UK, great footprint, wonderful way of actually managing, great track record, but one that we've not actually really in the past. In fact, up to very recently, none of those were even available on any other platform in South Africa. So fantastic growth opportunity for us. Use our Seneca acquisition. We've spoken about it briefly this morning, and especially the UK distribution footprint that we've gained by this acquisition. Use that to also grow our domestic market in the UK and use that as a distribution force to actually grow our market. Increase our local South African offshore market share. We have this platform, we have our distribution channels, not done enough, at least in the past, to actually grow our market share of the offshore growth that we've achieved in our market, even just on our own platform over the last few years. So a fantastic growth opportunity for us. And then lastly, grow our UK investment consulting business. We've acquired that business 6 years ago. It's a beautiful business. Very successful business. It's been winning awards in the UK a lot of the times, and grow that with some large DB schemes. Then if I talk about Johan's business, Myriad Momentum Trust, Investor and Traditional, really a business that has also had some profound change over the last few years, along with actually moving it back into end-to-end businesses. This business actually also provides a lot of building blocks for the rest. Peter's very successful new funeral product that has been launched is actually running on the new generation Myriad product there. We've just completed the move of the migration of the Metropolitan old funeral book onto the traditional platform there. More than 1 million clients that was actually migrated there. So you can see here that it's a business that also support a lot of the other businesses in Momentum. Myriad, Johan, in his words, will say that this is the business that is going to see the most profound change over the next few years. And not just because of a new way of having to look at this business in terms of digital, but more than anything, new ways of looking at underwriting due to COVID. I think we will have to actually look at this business quite differently. And lots of digital innovation that is going to take place here. Onboarding innovation that need to take place, new generation risk selection and underwriting. Underwriting of the future will not look like it does today. And again, Johan will talk about that a lot more. And direct to client is not actually something that you've heard much about up to now in our presentations today. But in this area, we believe that if we establish ourselves well, the growth in the direct to client market will be profound and it will be quite big. But not for a moment think that we will lose our focus on the advisor as a delivery mechanism for our products, but we have to start vesting ourselves in this area as well. Momentum Trust, very fast growing business. Over the last 5 years, it's actually grown by 14% per annum in terms of just providing a very essential service, and Consult is a great partner there to actually help advisors with the essential part of estate planning that they have in their businesses and that they need to deliver. Expand their capabilities to high value estates. It's a great growth area for us. Our estate liquidity benefit, and again also having to be able to grow in a direct to client basis. They've launched the online will system. Johan can give you more details about that. But again, something that we see a lot of uptake from individual people saying, let me try and see whether I can do it myself. Investo is our life-based recurring premium savings product, and probably the one area where we can also see that a lot of change is going to take place. Johan calls it a radical reinvent, not just a normal reinvent that needs to happen in this place. And because of the thin margins there. So everything needs to be done digitally. Otherwise, a business like this will not survive. We don't believe that the current industry practices or business models is actually going to survive the way they are right now. And again, therefore, enrich your client value proposition, do everything digital, and make sure that that is the way in which you position that business. And our traditional business, and this is our, Johan says it's the best team by a long or by a wide margin in South Africa that has the ability to actually migrate product and consolidate product and systems onto old legacy, or from old legacy onto one system. So here you would find the old Southern Life and Life Grow and Peter's old funeral products and old Momentum, old generation products all sit on this system. So if there would ever be further consolidation in the industry, this is the team that will actually be able to execute on that. And again, so important that while you administer millions of clients' contracts on this system, that you actually do it in a very efficient way. So this is my last slide. And if I was only allowed 2 slides, then I wouldn't have gone over my time. Sorry, Johan. Then this would be the slide that I would have also put up. And this is a brand new slide, and one that when Etienne saw it the first time, he actually sent me a little WhatsApp and he said, you know, you're not great at praising me, but this is the greatest praise I've ever seen in public. And this really is, so NMG does an annual risk, kind of a risk-led survey amongst big IFAs, and a lot of IFAs actually. So it's quite a big survey that we subscribe to. And this is literally hot off the press. We saw it a week and a half ago. And I would believe that this is the illustration of advice-led partnerships in action. when you have a product house and an advice or a distribution channel coming together and working closely together and understanding each other, this is the kind of result you get. So in 2018, and you can see there's 9 different aspects across which advisors rate the insurance companies in South Africa, and they're all there. All of those little triangles and blocks and goed is somebody. And what you can see there is the movement. The green arrows show you the movement of Momentum as a distribution channel and a product house over the last, since 2018, over the last 2 years. And in all but one of those 9 aspects, we've actually moved from 6th or 7th place to the number 1 place. And I do not believe that this is possible unless you have those partnerships. But I also believe that if we keep on doing this, if we can do this for our investment business, for our corporate business, for all of our other businesses, then this is the kind of result that you can see. So to end off, Momentum is not just a name or a brand. It's also got its own scientific formula. For those of you that have forgotten your science, not many of you in this room probably, but anyway, mass times velocity gives you momentum. Momentum is, we think, an unstoppable force. So today I could have said, may the 4th be with you. Or I can say, may the unstoppable force of momentum be with you. And then I will play out by just, to put this all kind of together, this is the year of the financial advisor for us. We believe that our business, certainly, and South Africa would not have been where it is if it wasn't for financial advice and financial advisors that actually do a fantastic job in South Africa. So probably the first time in history that a life company has actually come out with a TV ad that doesn't talk about themselves or their own products at all, but it actually talks about the value of advice and how those partnerships can create an unstoppable force. So I'll play out with that. Thank you very much.
I'm just a shade without a shadow. I'm just a freak without a freak show. Mr. Nobody, that's me. We came into the world together, you and I. But even as I saw you grow, I watched you fade away. But I still see you. And what I see is not just someone different. I see someone who can make all the difference in the world.
Thank you, Jeanette, setting the bar for how to end a day like this. But have no fear, Johan is not afraid. He says he is unstoppable. Johan Leroux has been the CEO of Momentum Life since April 2018, and like others who have appeared on the stage today, has a long tenure at Momentum, having joined the company 23 years ago in 1998. He was appointed the CEO of Momentum Retail in 2010. So you have to admit that there is something special about a company that fosters this kind of dedication, where they leave us, but they always come back. So well done, and thank you to you, Johan, and the other long-termers. Today, Johan represents the Momentum retail businesses, and just a reminder, this is the last presentation of the day, after which there will be another opportunity for Q&As. Johan, we are eager to hear what you'll share.
Thank you. Good afternoon, everybody. I certainly have my work cut out for me. After the previous 2 performances, I see Peter is having a little chuckle here. Yeah, you know, 2 natural stage personas and on-stage walk and X actually, so I'm in real trouble. But yeah, if I can quote Jeanette from James the Butler, very famous 60s comedy sketch that they often play on New Year's Eve, Dinner for One. I don't know if most of you would have seen. What was his last words? I will do my very best. So I will definitely try and do my very best. And of course, sticking to the theme, if you also know Dinner for One a little bit, it will not be the same procedure as every year. So we do expect some change. But yeah, thank you. It's also my privilege to share with you my take, on the Momentum Retail Reinvent and Growth journey. But more, from a digital business transformation perspective. And the title of my slide, Enable Digital-Led Distribution, was chosen quite deliberately. And as I go through my presentation, hopefully it will make a bit more sense. I won't repeat, Jeanette, what you've said, so I'll make up some time. But yeah, I think I couldn't stop Jeanette, on the roll. Yeah, so Jeanette interrogated our strategy from an advice filter or using an advice filter. I will do exactly the same, but using a digital filter. And to some extent, these are just two sides of the same coin. So you actually need to read these two presentations together. But at the start, what should you take out of my presentation? What are the main themes? And I will say probably three things. Firstly, digital transformation is first and foremost a business transformation. It's not just an IT story. So you're radically changing the way you do business. And secondly, it's about launching a new way of work within an organization. You radically change the way you do things, how you complete tasks and so on. And that's not an easy thing to do for any leadership team. You have to challenge, many existing habits, so to speak. And lastly, it is quite a complex technology journey also. Okay, it's not just about people, it's also about technology. And if you look at the complexities if you are dealing with the complexities of legacy or the breadth of product suite, that Jeanette also referred to in the Momentum case, and channel diversity, this is no easy task. So, yeah, it is about rewiring legacy product platforms and changing completely the way you work with data warehousing, getting product businesses to deliver new digital processes, thinking end-to-end, value chains, launching new and fresh engagement platforms for clients or for advisors. It's actually a hell of a job. But yeah, how things come together, that's actually where the magic will sit. And then maybe just two caveats from my side. Firstly, I'm not going to share all the how. I know we're talking to investors today, but I would also like to surprise our competitors every now and then. So we'll keep some stuff we'll keep confidential. And then secondly, just from this presenter, I'm not 20 anymore, so don't expect a modern, agile, digital native, gamified UX presentation, from me, but what you see is what you will get. That's my promise, at least. But yes, connecting with Jeanette's most famous slide, I think, we made the point that Momentum seeks the position of product leadership in all our respective industries, but we appreciate the fact that the magic actually sits in our ability to connect, or the product business's ability to connect with the various advice worlds, out there. So for all our product businesses, it's very important for them to have a deep understanding of what's happening in the distribution and in the advice space, and they get those insights by partnering, with our various channel executives. They actually take the lead from that perspective. And this is really, I cannot but emphasize this. This really defines for me the competitive Momentum DNA. If our product businesses are all in good shape, if our channels are all in good shape, then they actually play together. And it's how they play together actually that I think defines the competitive sweet spot, in the Momentum brand portfolio. And obviously that's the place, as Jeanette also mentioned, where the advice story, comes alive, where the client experience and the client relationships often, is the most important. So that's how we play. Now, in future, obviously, it's not only advice, but the world of digital that will connect all the stakeholders. And I think you'll agree with me, in our world today, digital has become, the ultimate connector, in our society. And for Momentum then, in particular, given our strategic ambitions, how digital and advice plays together actually will be the most important thing, for us to get right. So, going digital is not a new journey for us. It's not like we've never done digital. I was actually part of the business 20 years ago, when we launched one of the first electronic new business and capturing onboarding solutions in the industry, just to be told by our stakeholders, no, that's it's too soon. Just give us paper. So we went back to paper. That was then. But yeah, that was then. This is now, and the world now is about digital. So we've got many digital platforms running, electronic new business submissions and so on. But what we've realized is where we want to go now, almost the next level. We have to almost reinvent many of our existing digital game plans. And yeah, I think the group already acknowledged this, say, 4 years ago, and so started investing in this. And many of those things are actually coming of age, in the next year or so. So the good news is that we do not expect significant additional investment, in our channel engagement, digital platform. So that's actually, in fact, we expect some savings in 2 to 3 years' time to come through. But we now need to secure our digital future, and that's where the reinvent and grow strategy, actually comes together. Connecting the digital ecosystem in which we play is no easy task. Again, if you take into account the breadth of the Momentum product portfolio, and I'm talking about client sites as well as advisor sites, Momentum Funds at Work, short-term health, Momentum Multiply Money, Momentum Securities, Momentum Investments, the life insurance space, judicial as well as the savings, as well as the legacy book, and of course Momentum Trust. This is not an easy thing. And that's why we often say that, our digital strategy inherently is empowered by the product businesses. But the channels themselves obviously demand and need various digital solutions, practice management, advice solutions. Jeanette, you spoke about the financial plan and integrating for consult, advice and reviews. You can only do that if you've got appropriate digital platforms. So the model is actually quite simple, as you can see, but how you connect all these stakeholders and using digital, that's where the real magic sits. And what I can say today, of being back in the business now for 3 years, looking at all the business unit strategies, we definitely have a very clear and coherent plan. And now it will all come together, acknowledging the respective business unit strategies on their own, but also how they want to play together. In terms of strategic response, again, Jeanette, this is my favorite slide. That again shows you, and it actually makes even more sense, when you apply a digital filter on our reinvent and grow strategy. But it just shows you the way we think, or at least cluster, maybe a better word, our digital projects, across the portfolio. So you can actually take this model and superimpose it on any business unit, and you can tick some digital strategies, in each of those specific blocks. And I'm also again going to use those elements as an agenda, similar to Jeanette, to guide my presentation. I think in doing this, we acknowledge both the independence and interdependence of the various business units in the place under the Momentum brand. And I think what excites me, and I think the penny sort of dropped a year ago, you can see how these things come together and the coherence in plans that you need to effect. So I will now discuss each of these in turn, starting with the channel focus. What does digital mean for our various channels? Dropping in a little bit in the product leadership space, although Jeanette, you have shared something, so I'll save some time. Quite a profound change for us in the retail space in particular, and the Momentum Life business even more so. Our plans regarding our future service model. What does digital mean in terms of growth strategies? The hard slog, how we set the table. Some resetting we need to do, and most of those things actually coming to the fore in the next few quarters. And obviously the change in culture, which we often underestimate when you start a digital journey such as this, and the impact on how we work together as a team. What I can say is to implement any strategy such as this, your operating model and your IT architecture, how we deliver things, need to be rock solid and well aligned and well managed and coordinated to deliver on a strategy such as this. And this is exactly what we expect our new way of work, to deliver for us going forward, which I will refer to later on in my presentation as the Momentum Way. So let me kick off with channels. And when I say channel, it's obviously channels for clients, for advisors, for our own sales teams, distribution teams. Sales Connect will do that. And we also see our contact centers clearly as a channel. They also leverage specific technologies. The key for us, obviously, going digital. If you don't go digital in future, you're not going anywhere at all. That's as simple as that. So you almost need to rethink all your existing service models from that perspective. And for us, it's quite important to ensure what I will say great architectural consistency, also between the various channel platforms, as one specific theme. Then dropping into the product business space, allow businesses to develop their new digital service. They've got the insights, but they must only do it once, and then redeploy those service capabilities, across the different channels, because then it's also cost effective for the various product businesses. I think within a channel, how you ensure some user consistency in experience, that will be important for us. That's where the channel guys actually push back into the product ecosystem and say the look and feel, must be as follows, as an example. And then finally, obviously from an IT perspective, how you connect everything. The IT rules of the game. And you talk about, now, do you build yourself? Do you insort? What is your security protocols? What's your APIs? Your integration layers, how you use data and all those kind of things. Quite formal rules around that you need to put in place. But if I do drop into the financial advisor space, maybe a little bit further, I think Jeanette spoke about this, but I honestly believe that as a product provider, any product provider, your future relevance in this industry will depend on your ability to deliver digital services, to the advisor community. If it's a smaller advisor, it will be different, from a major advisor network. Jeanette, back to your presentation. But talking about advisor networks, I think, if you're not able to digitally integrate with their own digital platforms, you won't get any business there going forward. So how you set up your own shop at the back and then plug into their specific digital platforms is going to be quite important. And remember, it's all different. So you need to almost create an environment within your own house that you can actually do that, going forward. And the needs are different, If speaking about our own agency, Momentum Financial Planning, very different than dealing with a traditional retail independent financial advisor out there. Again, very different from an advice house or an advisor network. And you almost need to have those digital insights also going forward. Jeanette, you spoke about account management. That will involve quite a profound digital understanding also. So in our business, what will happen is the COO of the channel, whether it's now, let's say in Etienne's case, the distribution shop, they will go with the product businesses and partner with those, stakeholders in the world out there. So quite a change, I think, that we need to almost deliver on. What I want to show you a little bit, I also want to play video, Jeanette, and I'm going to play one video, which is basically a video we play to advisors. It's called our VIA strategy. Now, VIA is not a brand for us. It's not a trademark. It's also not a DSTV program. It's just the name of an in-house platform, that we run and that we give to advisors out there. And we've got an existing one. It's called MDS Online, Momentum Distribution Services Online, that's been with us, Etienne, I think 20 years almost. Well used, well known, well entrenched, but VIA actually replaces MDS Online. And it's therefore our new digital engagement platform. I think Gilly also mentioned this when you responded to a specific question in your session. Now, VIA is already in the market. It's been there for a year or so, year and a half. Actually, a lot of lessons. We're actually taking the second version out, touch wood, beginning of June. And then the third version, which is a real one, towards the end of this calendar year, which will be the cloud-based version. So Rista asked me, you must talk about cloud. We've got a mixed bag in our business. Many of our channel engagement platforms will use data that you park in the cloud, but most of our product systems actually use our own boxes inside the building, and we're okay with that. That's just how we roll. So, but VIA is a cloud-based solution. But let me read you a proper definition of VIA, as drafted, by one of our channel COOs. VIA is a strategic momentum platform for us that provides advisors, their assistants, administration teams, etc., with a single user interface to perform their tasks. It is a momentum-powered digital channel engagement platform where FSPs, financial advisors, support staff can initiate and complete tasks to service and support their clients electronically without having to seek assistance from another Momentum support center. In short, Via so becomes our future first level service delivery model for advisors. Now that's a profound change if you've got deep insights in how we work today. And obviously Via is not just a piece of software, it's almost a toolkit of various capabilities. So in our agency, we'll package it in a certain way. Momentum Consult also use the appropriate building blocks from the Via strategy, but then it's got a different look and feel. And obviously in the Momentum Consult space, they need to talk to other product providers also. That needs to link into the client data. So the client data environment for a brokerage is clearly very different from our own insurer agency. And Via can allow us to do all of that. So I'll always tell the teams in many ways, the success of Via almost grounds our new way of work, or it's almost in the next 2 years at least, set the table for how we want to play, going forward. And it's solving many other problems for us, about inefficient admin processes, the fact that the advisor now doesn't have to go back to a contact center, to fulfill a certain task, those kind of things. And I think very important for the distribution guys, I think their broker consultants currently gets bogged down with admin. They run around with admin queries and stuff. Via works properly, they can actually focus on what we actually want them to focus on, is to support their advisors with growth outcomes. That's actually where we want to go. So, yeah, but let me play you a quick video. This is a video we play to advisors today to show you what Via actually is about.
Introducing Via by Momentum, a digital ecosystem for financial advisors. As a financial advisor's digital partner, you can use Via to make your advisory practice more efficient, simpler, and smarter. Via is a sophisticated yet simple ecosystem, giving access to the innovative suite of Momentum digital solutions. With Via, you'll spend less time on paperwork and more time on building relationships with your clients. You can also use Via to streamline your operations and get valuable insights about your clients. Via is your digital partner, allowing you to take control of your clients' solutions and operations. Via allows you to find new sales opportunities by taking control of your practice with Book Report, an advanced analytics tool for looking at your clients and products in new ways. Campaign Master enables you to grow relationships with your clients through customized communications and tailored campaigns. What's more, this advanced tool will help you create unique opportunities to grow your client base. Your practice will be more efficient with notifications about your practice, clients, and product solutions. With Via, you can track the progress of your operations. Add value to every client engagement and learn more about your clients and prospects through intuitive search and filters. Help your clients understand their finances. Step into a comprehensive 360-degree client view that helps you make the most out of each communication. We're continually adding to the range of advanced tools and calculators already available. With Via, you can find forms and brochures in our easy-to-use and searchable document library. Access a client's digitized documents in the Client 360 view. Do business digitally. You can easily transact with your clients remotely. We're adding new tools to transact digitally, as well as allowing clients to sign documents electronically. Reimagine the way you do business with Via by Momentum. Learn more at via.momentum.co.za/4.
Yeah, so let me skip to the area I can't give my game away, but it's actually quite important to talk about general industry trends, I think, in this space. I think all the protection businesses, be it life, health, harness, or in the short-term insurance space, the role of digital in terms of underwriting, data collection, scoring, processing, I think it's just going to change these industries all, completely. In the life insurance space, I'm not just talking about, using fitness data, wellness tracking devices. I mean, you had a question about Multiply earlier. I mean, what Multiply stands for in terms of wellness outcomes, how you leverage that in client improvement, that stands firm as part of our strategy. But I think there's a lot more, and the fintech technologies and the health screening technologies that's coming to the fore, it's just phenomenal. You look in your cell phone and you don't even have to do a medical potentially on a client anymore. So all those things make the process of getting clients to access risk pools and to enjoy cover actually so much easier and better. And I think that's where this world will change completely. I think, Brunt, in the short-term insurance space, you spoke about the safety game, what you do on safety and how you use technology in it to almost reward clients better. I'm not a short-term insurance expert, I can say that, but I can imagine, Herman, in the commercial short-term insurance space, the use of digital technologies is actually next level in terms of where that industry is going and leveraging, the underwriting capabilities from a digital perspective. In the life insurance industry space, Jeanette, you spoke about the market share of Myriad in the IFA space. I think the battle will soon begin, digital battle, about who's got the best underwriting, quote, onboarding and alteration process. And I think that's going to be a firm differentiator for any business. Savings platform, Investo, you spoke about that. Again, I just can reiterate, I cannot see a traditional insurance-based recurring premium platform surviving. That's not mostly digital. The margins are just too small. I mean, if platform business got under margin pressure where you get massive single premiums, imagine a recurring premium platform going forward. So we need to do things very differently, and that's where I think the advice-led strategy is actually quite important for us. So what is advice-led? I think we're also scratching our own head at times, I must admit, and how to solve this problem, but this is the opportunity. It's how you almost integrate, it's the best way I can describe, how you integrate your product outcomes with a financial planning environment and make it an integrated experience. And you can only use digital to do that. So it's not just about a product quote. A product quote becomes a financial planning outcome. Maybe if it makes sense what I'm trying to say. And whether you're in the protection space or in the investment space, doesn't matter. That's how you're actually going to gel things together. And nobody's got it right in this industry. I think this position is up for grabs. And Momentum, given our strategic ambitions, clearly wants to own the space. But every product business will then have to sit down with their channel partners and actually unpack what that actually means. So that's why the advice-led strategy, I think, can only make sense if you put the word digital in front of it, because you need that glue and the systems to connect it. In terms of our service model, this, I think, is the part of the transformation that's probably the most profound from a people perspective. So what's it about? I think Momentum historically leveraged, I think, contact centers as its primary service model. That's how we rolled in the past. That's how we still roll predominantly. And we've given great service, I think, using contact center models in the past. But contact centers, in our case, live at head office. They use technologies, platforms that you cannot give to the external world. It's bespoke for that specific contact center environment. You can't export those technologies, I think, firstly. Secondly, unlike Peter, in Metropolitan, we don't have walk-in client branches out there on the Momentum retail side. So our branches out there are fundamentally geared to support advisors. And they're actually part of the admin process also. So there's a lot of admin traffic between branches, and head office, just to collect requirements and, where's my stuff? Is it finished? I need this from you. It's almost how that rolls. But everything gets fulfilled in the end in the contact center environment. So that's the old model. When I say, eliminate the post box, it's actually the previous point I made. The admin traffic, and we pay people for that, between branches and head office. I think half of that is just, where's my requirements? Simple requests. So it's a very inefficient post box model, effectively. So how do we plan to change this? So going forward, I think maybe in two ways, to change our business from what is essentially a contact center-led or dependent model to a digital-led or digital-dependent model. And secondly, direction of the change from a head office locus to what is essentially a channel locus or decentralized service capability. That makes sense. And yes, you will still have contact centers, but their roles will change. So as the product business build new digital services, they'll put it on Via, they will put it maybe on the Momentum website. It's something we want clients to do. They will put that same service into the contact centers. They will effectively drive the same car as the users out there, and the role will change to more of a support function getting the users out there to adopt, our new technology. So they become part of the business transformation in the external environment also. I think for a product business, thinking process, and not just product is probably the biggest paradigm shift. I think your processes, your product service processes becomes part of your product offering. So it's not just about offering market-leading policy benefits. It's actually also about offering market-leading end-to-end digital processes out there. And that's quite a change in mindset for us. And product providers, obviously, or product businesses need to understand that both clients and advisors can engage them, from different platforms. Advisors, clients can start these conversations anywhere out there, and they must be able to cope with that. So quite a radical change, I think, for product businesses to think process. Just a few slides on digital. It's happening in the business. I think Brunt was very modest. Brunt, I think 10% of the Momentum Insurance new sales actually come from a digital perspective, 20% in the old Momentum short-term days. I think Health Day also about 10%, if I'm not mistaken. On the life side, it's low single digits, so we're just getting out of the blocks. I think Jeanette referred to that also. But there's quite a lot happening, in the business. And if I can just quickly drop into the tied agency space again, they've got their own digital leads or demand generation also in that space. I cannot see a tied agency in South Africa surviving that's not 100% digital led. Whether it's digital advice delivery, digital advice governance, product servicing, digital advisor development, in the case of MFP in particular, digital leads generation. And I think that's quite important. So actually quite stunned, during the COVID period, we had some very experienced advisors, in their 60s, will still be with us for a while, changing their practices from bricks and mortar to basically going digital. Amazing to see that. So yes, the guys are willing to adjust out there. Our electronic signature solution, M-Sign, we launched that, I think, early last year. No idea that COVID was coming. It allowed all our advisors to keep working. In fact, part of the sales successes that we showed today, even during the lockdown period, was actually as a result of that. Quite a simple solution, but you need to connect at the back, to the different product businesses. The point is, we are leveraging digital already in one way or another, to grow our business. And I think if you really showed 7.5% of new Myriad sales in your slide, that's probably 20% of new clients. So premiums are smaller in this space. So, but quite a lot of intentionality to also get business, from the non-advisor space. But many of these leads actually get fulfilled, in the advisor space. So the investment and life leads actually goes, into the MFP channel also. Again, I just want to just flash Momentum Trust. I think we never speak about that. Thank you, Jeanette, for your intro. I think it's phenomenal. It's a break-even business at best. They make their money, well, they can make a bit of money, but it's to actually make their money through estate administration and the fees that they earn on that. But it actually sits at the middle of the estate planning value proposition, where advisors sit down with clients and look at their will and their stuff. And you'll be surprised to see how the top investment financial planners can't do proper estate planning. It's a very bespoke skill. And doing a proper will and see that as part of your financial planning experience, I think that's a value prop that a financial advisor has in this industry that's just next level. And for us in Momentum, where we've got the product businesses and Momentum Trust and the channels working together, I think it's one offering that really gets into that advice space and gives us quite a unique competitive advantage also. Jeanette, you spoke about that. If they've got a very specific solution, actually a Myriad building block, adding the will to that, anointing Momentum Trust as the future executor of my estate. Now we can also solve your estate liquidity problems for you. But the real exciting story for us was the digital wills. So they launched a digital wills offering. You can go onto the Momentum website if you want to. If you want to do your own digital will, it will guide you to the specific solution. About 30% of wills are now digital through this process. A lot of them are in terms of downloaded wills. And it's quite phenomenal to see how there's great awareness in the industry around the relevance of a will. Obviously, COVID contributed to that. But I think the digital capabilities and slab bang in that advisor product business space, I thought it's just worthwhile to again show you a few things about the success stories of Momentum Trust. If you've got a very complex balance sheet, various trusts, and other funny business interests, the solution will guide you to the experts, in Momentum Trust. But you can definitely have a look at it. It's quite a smart solution. Excuse the pun, Dumo. Yes, legacy and IT reset. If I had a day, I will I will spend 8 hours to you guys talking about legacy and IT reset, what we have done in the business in the last 2 years. So it's not what we have to do. It's a bit that we still have to do, but we have done a hell of a lot to get us here. And this is really what the reset element was about. Jeanette, you spoke about getting product businesses fighting fit, getting channels fighting fit. In this world is getting our delivery environments fighting fit again. IT teams, how we set them up, mandates, accountability, how we enable the broader portfolio to go digital. Really a exercise in resetting business accountability. We've re-established COO forums. We've re-established digital forums. We almost changed the agenda of our CIO forums, which is your IT heads in the various business units, to almost focus on this, to make sure you've got a clear roadmap at a portfolio level. The competitive energy in the Momentum portfolio is a federal one, really. Gives us the muscle. But obviously, how do we empower the muscle to run, and how we empower them to play at a portfolio level? This is the key outcome here. Almost the digital delivery game plans of the various BUs come together in this specific environment. And we've actually solved many of those delivery priorities from a channel perspective, but the product houses must then do their stuff. We completely reconfigured our data architecture, data warehousing, client, product, etc. Now, if you're an IT guru, and I would say to you that you must do this, they will say you're mad. They will look at such a product with great trepidation. We're 90% there, done. Big one falling, I think, in the next 2 weeks, and nearly another one just end of June. This is a massive endeavor. So we could have stitched it together using digital language in a different way, like many product providers do, but we wanted to do it properly, because in 3 years' time, you're going to run into problems again. Then you lose speed and complexity. You want to be adaptable in 3 years' time. So you wanted to do it properly. This was a real hard slog. Yes, spoke about IT governance, a big thing for us. We are switching off many legacy channel engagement systems, existing digital channel engagement systems. The real big one, the VIA one that I spoke about. It is not an easy task, because it's not just about the software delivery, it's also about the user community adopting the new tools. And there's quite a business transformation element to that the channels obviously need to drive from their perspective. I think in one line of business, we've got 4 quote engines running currently. We want to drop that to 1. So as you remove these complexities, making system changes, testing, regression testing becomes so much easier, and obviously you can take out costs. That's really what this is about. I think this is a phenomenal achievement where we stand today. You spoke about product platform migrations also, Jeanette. I think from a digital perspective, why that's important to us is not just the cost of running the product platforms, but most of them need to make some changes to their front-end layers to connect with the digital toys in the front. So if you've got less of those product platforms in the business, there's less work, and actually becomes more cost-effective. So that's also part of this reason we're doing the legacy system migrations, to make digital also easier for us. I think for me the key here is to be future fit, but it's really to remove complexity, I think, from our portfolio. And as I've said, that will bring in future what we really need, that agile, speed of delivery, adaptability, and do it right now, take the pain now, and be ready for the future. Time is running out, but I will speed up a bit. Culture, I think by now you must appreciate the culture change in the building. I think the most important lesson that digital teaches us is that you need to think outside in. It's not about you, but it's about the stakeholders out there. That fits the Momentum DNA, but I think digital just cements that mindset so much more. You must embrace a full value chain mindset. Again, how we make the muscle work in the Momentum building, the federal model, working together then in a certain way. And I think it's actually a new partnership mindset. I think what digital brought to the equation, the product channel, foxhole, competitive sweet spot of Momentum, it actually forces you into a new kind of partnership mindset, which is quite exciting for me to see how that lands in the building. We often speak about analytics, but analytics starts once you've got digital processes. Then you can actually start the journey. So the funny thing about digital, there's no end date. There's only a start date. If it makes sense what I'm saying. Once you're in, and then you actually start the real journey. And that's why it's not so important for me to give you an answer what things will look like in 3 years' time. I'm more important to know that we've set the table, we've got the capabilities, we've got the architecture to adjust as the world changes. And that's actually going to be why you will remain relevant and stay future-proof and stay competitive in time. That's why a business such as Momentum needed to affect, all these changes. So digital is funny. Nothing lasts in digital. The moment you launch an app, it's already outdated. You start with a new one. Technology changes every 2 years, and you need to live. That's the world you live in, but that's okay, because your system and your architecture is properly, and you can plug and play as you wish, going forward. So, we plan to drive digital the Momentum way. Now, if you're a little bit tired by now, you can imagine what's happening in the business to affect all these changes. It's certainly not easy. And yeah, sometimes we miss a tackle or two and you have to recover, but you get stronger. Every day you get stronger. And I can say today, after 2 years, we are a hell of a lot stronger, Jeanette, than where we were 2 years ago. And I think for me, that's quite energizing. But as I've said, digital is the ultimate connector in our world today, and Momentum in particular. If I can re-emphasize a few points, how digital and advice then plays together will be our competitive sweet spot. And it's not only connecting, I think, advisors and clients to businesses, also connecting employees, I think, with those stakeholders. That's quite important to us. We don't require any significant additional investment, Risto, from a channel engagement platform. Some product businesses will require some investment, to make sure they can deliver those digital services. But if you look at the numbers, the savings they will get from a cost of service and a cost of distribution, now in time, it's actually, the business case stacks up. You don't have to do many sums around that. But it is actually exciting to see how things are coming together. The main purpose for us doing this is not to cut costs, though. I just want to say that. I think, Risto, you also spoke about that, in your presentation. We're actually doing it to empower the businesses and to empower them to be competitive, going forward. But there is a windfall. As you change processes, I think, Healy, you spoke about it, the economics of end-to-end processes in your presentation. We actually think we're going to radically, drop the cost base in various areas from a servicing perspective. But it's actually a windfall. The real reason is to be competitive. And as an executive standing here today, I think it's a real opportunity. It's not often you get into a space where the projects that you launch, that's essentially designed to drive growth outcomes and competitiveness, actually also give you process efficiencies. It's obviously not something that we will waste in doing things properly. So yeah, Jeanette, you finished your presentation with a bit of a Star Wars theme. I think, 4th of May is Star Wars Day. I think you're right, yes. Your words, the unstoppable, force of momentum. Yeah, so I thought I will also steal something from Star Wars, from The Mandalorian. This is the way. Don't know if any of you are Star Wars fanatics. Now, when you start a journey such as this and you launch new ways of work and new software, you continuously challenge, existing habits. And, you launch a new thing and the guy comes to you and says, listen, this is not the same as the old thing. This worked for me. He says, no, this is now the way. This is the way. And you show the old and the new. You say, there's actually more stuff on than, it's good. This is the way. And the moment that person leaves your office, can you believe it? 30 minutes later, there's somebody else walking in there and say, this new thing, I don't know. Okay? This is the way. And you explain again that this is the way. But digital forces you to have a bit of a this is the way mentality, because there's lots of discipline needed to run digital. Data, quality, you can have exceptions, but the process needs to be rock solid. And it's all about quality of experience. You need to have those discipline, in place. I think currently we accept incomplete application forms because the Oaks want the process to start. And then we go back and, you go. So what could be a 2-hour or 1-hour process actually becomes a 2-week journey just to get a case through because things haven't been, submitted properly. What digital allows you to do is to manage the process at the front end. Say, I need this. I can't go ahead. And obviously in your agency channels, a world where you can be a bit more prescriptive. But that is what it means to say, this is the way. Now, I think what I'm looking forward to, maybe if I can close, is actually that yourselves as investors, but our competitors also maybe in 2-3 years' time, looks at us and say, they've done a really great job to stitch together such a complex portfolio in a certain way. The way they've used their deep understanding of channel environments, segmentation, specialization, different digital needs, and to turn that into a competitive advantage. How the product businesses change themselves, digital leadership, and new service processes that came with that, how they had the courage to do the right thing and change the legacy IT environment to set themselves up for success properly in the future, not fake it like many oaks might want to do. And obviously also how we almost sat down and changed the culture in the organization to move from just people-centric to people and process-centric. That's a hell of a transformation journey, guys. And maybe at that stage, if I may say so, even the Mandalorian can change their payoff or their mantra from this is the way to this is the momentum way. So Jeanette, momentum is unstoppable. I want to agree with you, and to use another Mandalorian quote, I have spoken. Thank you.
Thank you so much, Johan. The force is clearly with you. That brings to the end our 8 presentations for today, which means it's an opportunity for you for Q&As, your last chance, if you have any burning questions. There's one question up here from one of our virtual attendees, and this question specifically for Jeanette. Michael Christel is asking, if your advice proposition has shown such improvement in the NMG Distribution Insights Survey, where you are now first in 8 out of 9 segments, how do you improve further from here?
Oh, okay. Thank you, Michael, for that question. This feels like you've kind of set me up for that one, so great to answer that. Well, I think firstly, the NMG survey that we've shared with you is only a life risk one, and we're only embarking, literally tomorrow we will see the kind of first version of us participating in the NMG survey for Momentum Wealth. I suspect that, because it will be the first time, I suspect that our numbers there will be a lot more middle of the pack. But again, for us, our own internal goal will be to be in the number 1 spot, similarly to the one you've seen here in 3 years' time. So that's the first part of it. And then I believe this was just the beginning for us, and that going forward, being able to deliver on our segmentation strategy means that we will have far more tailor-made plans for every one of our advice networks and big advisor firms, linking that in with our advice-led strategy in our different product houses. So I think that will enhance that proposition a lot more. Not to even mention specialization. Right now, I think a lot of our engagements are still quite generalist and not necessarily always with the right match of skills or the right knowledge levels in our broker consultants, even up to manager level. And that will change completely in future. So I think a much kind of higher level quality interaction that we'll be able to have. And then, I'll kind of do a little Johan thing and be a bit arrogant and think, for us, it is about rewriting the rules and the way that advisors look at us and that advisors judge us against our competitors. That's our aim, is rewrite those rules.
I think Johan will want to continue or respond.
No, it's spot on. I think it's you have to get stronger every day. And where you are now is where you are now. But where you want to be in 6 months' time, 9 months' time, 12, and so on. So it's a never-ending process. And I think there's a lot of things that will come together for this business in this calendar year. But if you take a 12-month view, Jeanette, it's going to be quite a new place already. So we're almost at that junction where a lot of things are starting to come together. And I think the teams themselves, if you take a 2-year view, we look back at this business, our own staff, and say, yes, this is still the same place. And I think that's where we are now. So I think that's where the reinvent theme also comes through, because we've realized it's a little bit more than reset now. You almost now need to acknowledge the fact that there's a new game plan, new culture, new realities. And I think about digital is none of this is possible, actually, without digital. But that's the whole thing that my sense is that everything gets stitched together now in a certain way. And that's where the magic will sit. So there's a lot of house to solve. But if you're a business and a portfolio such as Momentum, that's maybe the point. Given the breadth of portfolio, that's actually where we can do things quite in a special way. And you'll find that some businesses are ahead than others, some product businesses, but that's fine. Our model allows us to do that. But the platforms are there, and they will come on board as they get more digital savvy, the various product businesses. So health is quite far out of the blocks. I think the fund member experiences that Dumo spoke about in funds at work. I mean, I often use your platform. It's phenomenal.
Well, and lastly, our competitors aren't standing still. They see, they hear, they see what we're doing, and I mean it's a dynamic market. We just look back at the incredible changes in the advice space in the last 3 years. I mean it's such a dynamic world that our plans of today is already going to look, differently and have to be more refined a year or so from now. So yeah, it's exciting space.
Thank you, Johan and Jeanette. From the audience, who would like to have the last word by posing the last question to our panel? Any takers? No, you've met all expectations.
Thank you.
Thank you so much for joining us today. Before I call Hilly to the stage to close the event, just 2 words from me still. If all the presenters of today can just stay behind, we'd like to take a photo. And then if the rest of our guests, you are welcome to join us for some drinks and light snacks. Hilly, the last word then belongs to you.
Thank you, Charlene. Before I close off, I'd just like to come back to Michael's question. It's just something that occurs to me, and it's maybe a point worth making. I think the IFA space is more important for us as a business, and I'm talking about the Momentum portfolio, than probably anybody else. Johan, you will know the numbers, but Discovery's own, let's say, agency force probably write a lot more than what they get from the IFA space. And the same would apply to Sanlam, everybody else. But in our case, partly because our own MFP distribution force sort of, we were a bit of a Johnny-come lately in terms of investing in that. I think that represents, 25% of your business, maybe 33%, and even less of yours. So I think, IFAs are more important for us. So that's why, we will never rest on our laurels, even if we do well. It is just that much more important for us. I'm not going to say much. I'd just like to, maybe conclude by acknowledging that, strategy is one thing, and you can talk, and it's interesting, we're all influenced by the same factors. I'm talking different industries, and often when you read companies' strategies and so forth, there's a bit of a similarity, because we are influenced by the same things, and we read the same things, and sometimes you use certain words, and you have maybe something else in mind than, let's say, another player. And I mean, even here, as we talk about some of these concepts and so forth, we will fine-tune some of it, but ultimately, it's around delivery. And I would say even an average strategy that's delivered very, very well is probably better than a great strategy that's not really implemented. I mean, that is a bit of a, it's not a profound statement. It's an obvious statement. Yeah. Just finally then, thank you very much, especially the guys that were here physically. It's nice to, have a bit of personal interface, interaction. It was really nice to host you. But also, I think the guys that dialed in and, virtually attended, thank you very much for your interest. We really appreciate it. And then just finally, to the Momentum Metropolitan group, the team, the wider team, I mean, a lot of effort went into this. But more importantly, the strategic planning process, looking at competitors and trends and stuff, that started, more than a year ago. A lot of effort went into it, processes and, putting all the plans together. And I must say, it's really just the privilege to lead this great team, and I really look forward to us implementing the strategy. Thank you very much.